Good morning, everyone, and welcome to Traders Corner Stocks and Options Special Investor Summit. Just to throw it out there, my favorite. With the presidential election, the escalating Israel-Hamas conflict, and high interest rates and rates of 2024 promise to create some great trading opportunities. On our panel today, we handpicked the industry's top stock and options trading experts to join us today. They've agreed to share their most consistent and profitable trading strategies with us in a free online educational forum. Today's show is packed with overly great information and special discounted offers, so let's get started. You may have seen our first presenter on Fox News, Fox Business Network, RT America, Cheddar TV, or CBS News. She's an expert stock market analyst and the founder and owner of an international education company where she teaches people how to successfully trade the stock market. Her traded methodology is based on one strategy called Golden Gaps, which pinpoints institutional money in the stock market. Here to present Gaps for Big Moves is Melissa Armo of the Stock Swoosh. Welcome back to Traders Corner, Melissa.
Thanks for having me. Great to be
Thanks
here.
for being here.
Super Bowl weekend. Here we are. Well, we're going to talk about trading. Thanks so much for the nice introduction, Rob. And yes, I'm going to talk about trading gaps for big moves. I can see the questions in the chat, I think. Rob, the thing is clicked. It says show answer questions. Do I click that or unclick that? Do you know?
Show answer. That will just take them out after you or I type the answer and back to the asker.
Okay, great. All
so
right.
Probably leave it checked.
Okay, very good. Well, if anyone has any questions, they can write them in the chat and I will see them in live time. Welcome. Thanks for being here, everyone, today. And as Rob said, you can watch me on TV. It was just on Cheddar the other day and Schwab Network as well this week talking about the stock market. Of course, it was a big week for the market. The market hit brand new all-time highs again. SPY finally hit over the $500 number. So it's been an interesting time to trade so far this year to start out 2024. If you have questions after my lecture here today, you can, of course, call me at 929-3200-GAP. You can also email me at melissa@thestockswoosh.com, and you can follow me on Twitter, Facebook, YouTube, or Skype. So it's hard to believe, but it is February already. I feel like I just, celebrated Christmas. So the year has started. We're already full on into the second month of 2024. I think it's a good time to kind of recap, especially in weekends. I usually do my recaps and analysis for how good I'm doing, what kind of week I had, what improvements I could make on Saturdays or Sundays. And it's a good time to look at how your year is going so far for 2024. If you're not having a good year, you can make adjustments. It's not too late. And again, if you are having a good year, you want to stay on track. You want to stay focused. Sometimes what happens is with people, they really just are not on the right track and they let it go too far into the year and then they feel like they're never going to catch up. And then people tend to take crazy trades or gambling in order to catch up for the year. Don't let that happen to you. Set your goals early. Be realistic with your goals. And I believe then you can make them happen. So I put in our stats for last year, even though again, 2023 now, it seems like far away. But this was our day trade results for 2023 for the whole year. These are trades that I did on margin. Okay, my average risk last year was around $3,000 per trade. And again, these are trades I called in the live room. We were at 569,970 for the whole year for last year. We're already doing better than that this year. Again, the trades have been there this year. It's been good trading. There's no other explanation I could say other than the fact that there's been great trading so far this year. And for last year, I also trade options. I risk more in my options. Our newsletter results last year were over 2 million. Now for the options, I don't have an options room. The options are a newsletter. We will discuss some of those newsletters in this lecture today. Well, you'll see what the newsletter looks like. The newsletters get emailed to you in live time. In the trading room, we're doing day trades on margin, and I'm calling the entry, the stop, and the exit in live time as well. And these are our stats so far for this year, 2024. And again, we're already having a really, really good start to the year because we're only 1 month into this year and a little bit. 139,699. It's been a really good year to trade. And again, the interesting thing, and we're going to talk about this today, is as bullish as the market has been, I'm mostly short. So Snap actually was the most recent big one we had this week. Snap was a short. And Snap was a really cheap stock, in my opinion. So you could have really loaded up on the Snap, and it had a very, very, very large move. And these are our results so far year to date for the options. Again, we had some huge trades in VA, which we bought puts, Tesla as well. And we're up over 500,000 this year to date on the options newsletter. So far this year, 2024, we've had a great start to the year. And again, it's just about staying on track, continuing to do well, taking it day by day. I say chunking it out. Again, sometimes people start out the year and they're not where they want to be, and they don't even evaluate where they're at. It's not too late to change what you're doing for this year. And, you know, I was just talking to Rob before I jumped on here. You know, he's doing different things with his life. For years and years and years, I did mortgages, and I liked it when I was doing it and the money was good. And then things started changing, and they had nothing to do with me whatsoever or how hard I worked. It had to do with the industry itself. Trading is something that if you want to do it, if you love doing it, you can work for yourself. And I know from doing a career that I didn't love, which is why I quit doing mortgages, that it's miserable to get up and go to a job that you don't like every day. Absolutely, absolutely miserable. It pays the bills. That's great. That's true. But the fact is, loving what you do counts. In a couple of days, it's Valentine's Day. There's a lot of things to celebrate on Valentine's Day. You can celebrate people that you love, family, friends, your spouse, a girlfriend, a boyfriend, a pet that you may love. It's also important, I think, to love your career. And if you don't love your career and you don't love what you do, it's tough to get out of bed every morning. You pray for the weekends. And again, trust me, I was there. I love what I do with trading. I love shorting, which is what I mostly do. And I even love teaching, which I teach a class once a month, which we're going to talk about here at the end of the presentation as well. So what do? I rate gaps. Okay, so I get up in the morning and I look at the gap. So for example, so that was a gap. Okay, how did I know Snap would fall? I rated Snap per my 26-point checklist. So I take a look at the gap and I say, okay, what's going to happen here? Is this stock going to fall today? Is this stock going to rally today? And that's how I figure it out. And then I wait to the open and I take the position. You can take a short position on trade on margin, or you can buy a put. A put is a short. Again, I have people with me that are doing both options and day trades. It doesn't matter what you do. The benefit of doing options, basically, though, is that you can trade options and hold options overnight, which we're going to talk about some trades here. And the other benefit of options is you can open up an options account, and it can be a cash account. It doesn't have to be a margin account, and you can open up an options account with as little as $2,000. So for many people that don't have the margin requirements to open up a retail brokerage account of the $25,000 that's required, people can trade options and they can still short. Okay, so again, it's a vehicle, it's a way to make money trading. One of the other ones that we did recently, this was a really good one, was UPS. Now, again, this seems like forever ago, but it was only on January 30th where we shorted UPS. This was an earnings trade. Stock closed here, gap down. Stock closed up here around 158 and change. Then it had earnings, then it gapped down. So what do? I evaluate this based on a 26-point rating system to determine what? If it's going to fall or rally. We shorted it. Okay, it was a short. So how did I know it was going to drop? Because of the rating system. And all of that is everything that I do in the pre-market. It's all the work I do before the open. Again, you could have bought a put in this, you could have done a day trade in this, and we did both. It's whatever works for you. Okay. We also did, this is another earnings, DFS. This was January 18th, and this was a day trade. We did not do an option in this, but you could have. So we shorted this. And again, I'm calling this trade live in the room. Entry was 115, boom. I took 2,500 shares. Risk was higher on this because I did an add. So I added the position at 101.10 as it was backing up. I'll go over here in this chart in a minute. Total shares was 5,000. Here was the average price. This was a beautiful move, a really, really nice move. Almost $4. Profit was huge. So this is a day trade. You have to have a margin account to do this. You could have taken 1,000 shares. Okay. You could have taken half this risk and made almost 10 grand. So here was the trade. Stock closed here, gap down, open, rallied, dropped. And we shorted it, got the drop. Here it is. Here's the chart. Actually, this is a 15-minute in here. But anyways, shorting is something that I love to do. Why? Because most day traders, most retail traders like to go long. So actually, probably a lot of people are doing very well with the bullish market we've been in the last few weeks. It's not going to last, meaning do I think the market trend changes? Not necessarily, but I don't think we go straight up all year. Nothing goes straight up and nothing goes straight down, but you can make money very fast shorting. Panic comes in quicker to a stock than it does in the opposite direction. Panic buying is something that's very, very rare. You might see that on certain stocks occasionally, like NVIDIA, for example. But the fact is that when you go long, okay, it's something that for whatever reason, people just generally love to do. They say, oh, I can buy low and sell high. And that's very well and good. But most trades that I take, you don't need the market. So as strange as it sounds, I prefer to short because it gives me a niche. I get large moves, big moves, and they happen very, very quickly. It's not that I never go long. I do sometimes go long. We went long certain things this week. But the fact is I prefer to short because shorting gives me a niche, because most traders prefer to go long. And then when the short setups happen, they don't know how to do it. They don't know what to do, or they're not taking the good shorts, or what I call the shorts that would have the very large moves. Here is this daily chart here in DFS. Again, what do? I trade gaps. Stock close here, gap down. Okay, this was on the 18th. But again, we shorted this. We did a day trade in this, but you could have also bought a put. So the stock closed here, gap down, open, rallied, dropped. Okay, so it fell. So I'm specifically focused on what? Trading gaps. And I'm specifically focused on what? Shorting. Again, it doesn't mean I won't go long, but I rarely go long. And when I go long, it's really, 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 really good. Okay. So again, I'm looking for the best possible trade, the best possible stock to trade. And what's very dangerous is sometimes traders will go long and short the same thing the same day. You can't ever get good at anything or become an expert or really define what you need to do in becoming an expert if you're doing a million different strategies and a million different things or a million different ways all day. So again, all you need really is one trade a day, maybe two, and you put on the size. And again, you could do it as a day trade, you could do it as an option. So anyways, you can trade options and day trade gaps. Now, I specifically am in and out of my day trades on margin, but you could buy a put and basically trade it as a day trade, like get out of it quick. Again, I tend to hold my options, but you could do that. That's an idea. Here was another gap that we did. Stock closed here, gap down, dropped, boom. This was Tesla. Tesla's have been having a lot of issues. I know pushback with the market the other day, but Tesla's having tons and tons and tons of issues. Anyways, this was a good short here, and we also did a put. This was back on earnings, okay? And we had a lot of trades actually in Tesla this year. So this is one we did back the 17th. We bought the 205 Tesla puts. So if you wanted to buy a put, you just pay the cost. And again, that's the nice thing about doing options. It's like the insurance. You can't lose any more than you risk. If you bought one contract, again, a beginner risk would be two. If you keep it under $1,900, even if the trade rallies and if the whole thing went bust into the last day, you would have only lost $900 versus doing a swing trade. Anyways, this was a nice trade. You could have bought it at 450 and sold it at 900. So let's take a look at the chart. 17th, the 205s is here. Oh, this was before the earnings. So here's where I called it, got the drop. Okay. So again, a put, okay, is a short. It's just cheaper than, for example, if you wanted to short Tesla on margin, which I do. But this is for people, again, that don't have the ability to open up a margin account with a broker. But again, my focus is based on, number one, the gap. But what's the concept? What's the philosophy? If you really want to understand the whole meat and potatoes of what I'm doing, I'm looking for institutional money. What is it doing? Is it buying the stock? Is it selling the stock? Is it shorting it? In the case of Tesla, it's being dumped. It's being sold off, or it was, okay? I still think it's going to be, actually. When, I don't know. We'll see. NVIDIA, again, I was talking about, is getting bought, okay, made new highs on Friday, and we were long that stock. We did calls, which is an option, which is a long. So again, I'm looking for institutional money, and I'm aggressively getting in, okay, aggressively meaning very, very quickly into the open, and then whether you hold the trade or get out of the trade early is really, really up to you. So for many people, again, we were talking about this because the Super Bowl's tomorrow. People love to watch the Super Bowl. You know, even people that aren't into football, you know, I'm not really into the teams that are in it this year. I watched the Eagles and they lost. They didn't make it. But I will watch the halftime show. I'll watch all the pregame fun stuff. And again, it's like an American tradition to watch football and play it, you know. But it is also the American dream to trade the stock market. And it's also the American dream to become rich, successful, financially independent. Many people want to do it, but they really don't have a plan to make that happen. So again, a lot of people go into their trading days and they have no idea what they're going to do. If the stock market opens at 9:30, I'm there and I know if I like something or if I don't like something, if I'm shorting it, if I'm going long it, or if I'm not doing anything at all. I have my picks, I have my ratings, I know what to do ahead of time. Having a plan of action helps you so you don't make any mistakes, so you don't trade on the fly, which is very dangerous, okay? And remember, you're risking money when you trade. It's your hard-earned money that you earned doing some type of job or savings, and you don't want to just take crapshoot 50-50 trades. And again, while the market's running up, you could go long virtually anything, even weak stocks. Even stocks like I talked about, like Tesla, rallied this week with the market, but it doesn't mean it was a good trade, and it doesn't mean it's a good trade. It doesn't mean it's going to last or work. And that's the tricky part about trading, particularly this year, because again, we're in an election year in 2024. But you need a focus, is my point. You need a strategy also, and my focus is gaps. So while not everyone may want to trade the stock market, that's true. Like my sister, she has no interest in trading. She has no interest whatsoever at all in what I do. She's never going to trade. That's fine. But if you have an interest in trading, and if you want to do it, you absolutely need a strategy to trade. And if you're losing money, you absolutely need a class like mine in order to learn a strategy to trade. There are many strategies out there. Some work, some don't. You need something that doesn't work every once in a blue moon. You need something that works consistently, Monday, Tuesday, Wednesday, Thursday, Friday, where you will have more winners than losers. As you saw from the stats at the beginning, I have some trades that lose. It's absolutely true, but I have way more winners than losers. And I also have some big winners. Rob was in my trading room, actually. He did a trial the other week. We had some big winners, you know, and the thing is that you have to have some big winners to cover then the losers. And the reason that I use stops is because I know that there's a possibility that a trade may lose. So therefore, I use a stop. It's a hard stop. It's a limit order stop. I put the stop in. If it goes to the number, then I'm going to get hit out. Anyways, let's talk more here about what is a gap. What is a gap? A stock gap on the opening price today is different than the closing price of yesterday's trading. A gap is a break in price action from one day to the next. Simple. But how do you know how to find gaps? How do you know which are the one gaps to do? How do you know to go long a down gap or short a down gap or vice versa? How do you know what direction to trade it? Well, that's what I do. This is what I figure out. This is again, the whole thing that I teach in my class. It's a rating system to determine, should I trade this stock this day? And should I go long it? Should I go short it? This was another big winner that we had this week. This was PayPal. This was earnings just a couple days ago. Stock closed here, gap down, open, fell. We shorted it, okay? So we shorted PayPal, and we also did a put, and there it is. Again, down here's the volume. So again, PayPal had earnings, and then I got up in the morning before PayPal even traded, before it even fell, before it even did anything at all. And I said, wait a minute, I like this. It's a good one. It's a short. And we shorted it, and we were in it early and aggressive, got in, got out, boom, done. You could have held it all day, but I think it's easier to hold puts actually than to hold a day trade, because when you're doing an option, and again, we're doing the weekly options, you have a couple of days, you have a week. It's not like an emergency, like a day trade where you gotta get out by 4. But again, you gotta learn how to do it. You know, you can't just do whatever. And I think it's shocking to me. Again, I've had the stock swoosh business where I've been teaching people for more than 10 years now. It's shocking to me how many people trade the market and risk their own money and don't know what to do. Again, they have the dream. They have the dream of being rich and successful. They have the dream of working for themselves. They have the dream of trading, but they don't know how to make it happen. They don't know what to do. And then they throw themselves in the market, and some trades work, some trades don't, but overall they're losing, and they need a sense of direction. So what I give people is not only the strategy that I teach in the class, but I give people a sense of direction. One, I'm calling the trades every day live in the room, telling you I like PayPal. PayPal is the one today. PayPal is a short, 100% conviction, we're doing it, or whatever. And then again, I send the newsletters out where I'm calling the options trades, and those get sent out to you usually in the pre-market way before the open. I could send an options trade out at 7 a.m., 2.5 hours before the market's even open. You can't do the trade until after the open. But getting back to the philosophy behind this whole thing, there is only one thing only that can move the direction of a stock. It's money. Not a little bit of money, but a lot of money, or what I call power money. Power money is in charge. Power money is always in charge. Power money is in charge of the stock's direction and the overall market. And trends are set and moved by the power money people, of which there is a lot of in the market. So I'm looking to trade with those people. Earlier I was talking about BA. BA was a huge short for us to start out the calendar year of 2024. We did puts before the stock fell off. If you've been following BA, it has had a massive sell-off since the beginning of the year, since 2024 started. And while this has backed up as well, I still believe that this stock is lower. I was on Schwab Network the other day stating the same thing. They're having issues. But again, we did puts in BA. It's kind of an expensive stock, and you could have bought a put. So we did the 245 puts I called the 3rd to start out the year. Let's go back and look at it. January 3rd, BA here. So I called the 245 puts here. Now, how did I know this would work? Again, I got up in the morning and I rated the gap. I applied the system. There was no guesswork. If the gap rates 20 points or more, I'm taking this in the direction of the gap. In this case, it was a bearish gap. Stock closed here, gap down. So I called the puts. I sent the newsletter out. And again, you see it right where we are, snug as a bug. And then, boom, this happened here within the week that we had the trade on. And again, you actually could have held this down even more, but I got out of it when we had that follow through gap. It expired on the 12th. This was just a huge trade. The cost was $3, which I thought was cheap for this. And then again, 30 contracts, risk was 9,000, sold at 19. This wasn't the best exit. People always say, well, you'll get the best exit. No, you can't ignore a profit like this when you get that kind of gap down. Yes, you could have held this more, but this is a huge, huge, massive trade. This pretty much started everybody's year out huge on the right foot that was trading options with me. And if you took 4 contracts, you could have risked $1,200 and made $6,400. People always say to me, well, I have a small account. How am I ever going to grow it? Trades like this is exactly how you're going to grow it, making over 500%. I also get this question a lot. How do you say, well, how much should you expect? I'm looking for 1-to-1. That's true. That's normal. Anything I do, day trade, option, anything, I think 50% is good in option. However, if you're in a trade, how are you going to get the big move? You're going to get the big move because you're going to be in the trade. You got to be in it to win it. And you're in it and something happens overnight. And did I know BA was going to have mechanical issues? No, but I rated the gap on the 3rd. I said, this is going to drop. This is going to fall. And then if you're in the trade, poof, and there it is. And there's all the money. So you don't plan on having 500% wins. It just is going to happen because you're in the trades. Some people are asking questions. The expiration date is in there. I'm usually doing the weeklies. Frank, that's something I go over in the class. We don't have that much time today. In fact, I got to watch my time now. Yeah, the date was the 12th. And again, so I called it on the Wednesday, and theoretically, whoever asked that about the date, you could have exited it the same day I called it and made money if you did the Fridays of that week. But this was the big trade. This was the big trade. Okay. Then we also did the 11th. We did the 119 expiration, 330. I mean, these were so cheap earlier in the year. This was an even bigger one. Okay, the 11th. Let's go back to the chart. 225. Here. Boom. There it is. There was the trade. So you see where it went all the way down to 200 and change. Again, huge trade, monster trade. We were in it early. We were in it perfectly. So again, your goal is to get the trade in the right direction. Your goal is to get the perfect entry with me, which you're going to learn in the class. I teach you the targets, but no one knows. I mean, it's so hard to try to get out at the high of an options chain or at the low in a short in a day. I mean, it's almost impossible. It's like if you're long a video, where are you going to get out? Well, you got to get out somewhere. You pick a place and you get out. I mean, there's a million targets. So, I mean, 200, felt confident. I felt confident that 200 was good for the BA in this time frame here that I called it when I see the momentum coming in. But sometimes things go bigger than I think. And again, these are times where you're trying to get as exact as you can, but it's really about making money. So this was a huge trade. Return investment was 658%. again, this is a lot of money to risk, but I'm taking my overnights with a larger risk than my day trades. You could have split it up in half. You could have risked 13.20, took 4. You could have taken 1. You could have risked $330 and had 1 contract. You just said, well, I'm going to do Melissa's trades and I do 1 contract. It doesn't matter. This is how you build your account up. Okay. You take it, you book it. You take it, you book it. We also did that on the Friday, the 215s. These were super, super cheap, which is why the return on investment of these was 900%. Let's go back to the chart, the 215s. So on Friday here, so we took it over and we took it down. And again, did I know this was going to happen overnight from the Friday to the Monday? No, but I could predict that the stock was lower. And then poof, it did. And then I got up in the morning and rated this gap. And then I said, boom, we're doing it. And we did it, and it worked. And that was Monday. And I think that was one of those mechanical things that was happening with it. So then we did the 215s. Any other questions here as I'm going through? Again, you need to use your brain to trade. I can't tell you that enough. It's like, I don't know what happens after. I was having a conversation. There's a video actually on my YouTube with a student was having a conversation. Like, I don't know what happens to people after a certain age that they don't want to learn anymore. That's crazy. That's crazy. The more you read, the more you learn, the more you know, the better you're going to do, the more money you're going to make, the more educated you are, the better you're going to do. There's so many people that are competing in the market that want your money, because when you go into the market, you have somebody else against the other side of your trade, okay? It's not like you're knitting scarves and selling them on the street for a profit. You're not creating anything when you trade. It's who's the smartest, who's the richest, who's going to get in first, who's going to get out, and take it and get the money. And that's what it's about. And that's why my whole philosophy of trading with professional money makes so much sense. Let me see the questions here. Brianna, you can use whatever platform you want as long as you have day charts and live data. You don't have to switch brokers. I'm not sure I understand your entry criteria. Well, you learn that in the class. You learn in the class what my criteria are. I am not discussing the 26 points here, whoever asked that. That is a 14-hour class that I charge money for, and that you would learn if you come and pay me for that class. We are not discussing that today. I'm telling you that I knew that BA was lower. Tesla, UPS, DFS, PayPal, everything we've done, because I have a system that you can learn, which is a rating system, which is 26 points. And you rate it, and if it rates 20 points or more, then you can do it. Why would I offer my class for free, Robin? That would be ridiculous. That would be absolutely ridiculous. My class is worth the money that I'm charging. It's worth even more. I'm running a business. I think this industry, it's very, very interesting. Again, I started out the business in 2012. I started trading in 2008. But I mean, it's really, really interesting. If you are invested in yourself, if you're committed in yourself, you're going to be successful. If you want stuff for free, you're really not invested in your own success, quite frankly. So you know what? You get what you pay for when you go to classes. Sometimes people charge such little money for classes, I'm almost shocked. I say, well, how good can the information be if the class is so cheap? And then people take trades that people call that are bad trades and lose money. And they end up losing more than they would ever pay by taking bad trades for cheap classes with other services. People are making money with me. People are making money with me, hands down. People are already making money with me that signed up for the class in February. They haven't even done the class yet. So, you know, again, you can come into the room and take the trades before the class, but learning is extremely important, and you've got to know what to do. And I would never give away my information for free. That would be ridiculous. Hard stop. No, I don't trade in the pre-market or the post-market, whoever asked that. I get ready to trade in the pre-market. Sometimes I rate gaps in the post-market, but I prefer to rate gaps in the pre-market. But anyways, it's a real stop. It's not an imaginary stop. You can't put real stops in the pre-market or post-market. You're trading the wild, wild west. You also can't trade on 4-to-1 margin. You're either on cash or 2-to-1 margin in the pre or post-market if you trade then, which I don't. And you also can't do options in the pre or post-market either. But again, getting back to what I was saying, trading isn't gambling. It's not gambling. It's putting the odds in your favor. Matthias is asking about checklist item. No. again, you know, the people that come to me, this is it's such a big world out there, trading educators. Again, Rob's having me on this morning. I've presented with Rob before. I do these webinars and things like that. The trading education industry, if someone had told me what it was all about before I got into it, I'm not sure if I would have gotten into it. But the funny thing is true, but the same with the mortgage industry. When I started out doing mortgages, my background was banks. I was a branch manager for 2 different bank branches. And then the president of the bank offered me a job to do loans for the bank because I was at the top of the bank for loan volume. And then I ended up getting into the president of the bank actually called me and offered me the job and had to talk me into it. I was afraid of losing my base salary as a branch manager at that time. I was in my 20s. I took the chance, I took the risk, and I quadrupled my income. But I never would have done it if the president of the bank hadn't called and talked me into it to take a job that was at that time 100%, commission. If you want to be successful in life, you have to understand that life is about risk. Part of the risk is paying for a class like mine without knowing any of the information at all ahead of time. And people that are willing to take risk are willing to be, actually believe in themselves and be successful. People that want things for free are never going to be as successful as me or other people in the market. You have to understand that trading is about risk. Again, it's calculated risk. It's not about gambling. Was that a soapbox? I'm educating you a little bit about what I do, whoever said that. If you don't want to hear it, I don't know why you came. I don't know whoever said that. And yeah, well, maybe what I have is not for you then, whoever wrote that, Peter, Matthias, whatever. Yes, I'm selling my product. Yes, I run a business. I'm telling you a little bit about what I'm doing. If you're interested and want to learn more, then you will email me. That's what this is about. You're never going to learn how to trade in 45 minutes, and I don't know why anyone would even think that. I don't even know why anyone would think you could learn how to trade in 45 minutes. Even people that take my class, which is 14 hours long, still have to come back and ask me questions after the class. The fact that anyone thinks that you could even learn my system in 45 minutes is so unrealistic. But again, it just goes to show you what we're talking about. To have the American dream is realistic. You have to put in the work. You have to put in the effort. You have to put in the investment. You have to put in the time. You have to be willing to take risks. Otherwise, you're never going to get there. You're never going to get there. And part of it is having confidence in yourself. If you have confidence in yourself, then you will do what I just said. Okay? If you don't, you won't. In which case, then maybe you're not someone that should be trading the market. You know what I mean? Like I said, trading isn't for everyone. Like I said earlier. Anyways, let's continue on here because I think I'm going to have to rush through this now. But I think these were good points that I made, and some of you need to learn some of this stuff. I mean, meaning the philosophy of what I'm saying here, what I'm projecting. Anyways, I use one strategy daily to stay consistent, the 26-point system. Again, how would you learn that? In my class. It is a paid class. But the benefit of trading gaps and the reason you're here today is to find out, well, maybe there is something to this. Maybe I want to learn how to short. Maybe I need a strategy that I can trade fast and be done. And again, that is what I do. And we're going to go over the trades here. This was the last week of, Jeff, Rob, I think this was the week that you were in the room. Rob, I think this was the week we're in your room. It was no trades on the 29th. The 30th, BA, we made money. UPS, we made money. The 31st, we lost in Tesla. Then we did Google. And then the 1st of February, here, I'll go over this trades here because we're kind of running out here of time. 129 was a checklist, no trades, didn't meet the criteria. 130, we did BA. And again, I'm going to go quickly through this. This was the short. Fell, dropped. That was a day trade. UPS was on the 30th. Fell, dropped. There it is. We shorted it. We took the stop in Tesla on the 31st. I shorted this here, got stopped. Then we did Google. This was a big trade. This was earnings. We shorted it, got the drop in Google. See where this fell. We also did a put in Google. That was the 31st. QCOM, we got stopped. This was February 1st. Shorted it here. I was up, but I didn't get out. Got stopped here in this ding. Then we did BA. Shorted it here. Got the drop in BA. That was a day trade too. I think this was the day that you were in my room, Rob. We did Amazon. This was the one
Melissa,
off. Yeah.
if you don't mind me, chiming in, we had the trades on QCOM, Boeing, Tesla, and I believe you called a secondary trade on Apple because not everyone was able to take profits on QCOM. But ladies and gentlemen, I was privileged enough to have 2 days in her room, and let me tell you, the profit percentages and amounts she is posting, they are absolutely very real. I made a considerable amount of money in the 2 day trial that I was able to see her room.
Yeah. Thank you. Anyways, it's about chunking it out. It's about chunking it out, taking the trade, getting out. And again, those were margin trades. But again, getting back to the philosophy, how did I know that any of those trades were going to work? Because I went through and rated the gap and I knew what to look for every day. I'm trying to find momentum. Okay. I'm trying to find what's going to go and have a big move. Again, Amazon had a big move up and BA had a big move down. So you don't need to whop on the size in trades. If 1,000 shares, 500 shares is enough, again, to make money if you're going to get a big move out of something. And again, depends on the stock. Again, something like Amazon, a big move in Amazon is different than maybe something like Tesla, okay? But I'm looking for a minimum of $1. But the whole philosophy, and again, the point of today is to see, do you know anything about gaps? If not, maybe you want to investigate it because there's something to be said for gaps, because if you can trade gaps, you are going to get big moves. Not everybody knows how to trade gaps. Unfortunately, people might trade a gap, lose on a gap, don't know what to do, and then never trade them again and get scared of them. The point isn't to be scared of them. The point is to learn more about them so that you can capitalize on the moves that gaps make. Anyways, understanding which gaps are meaningful and which gaps are not meaningful in the market will help you to know what to do and when a change is occurring. And that's how you know when the power money will flow with you. But the whole point is to find the flippers of institutional money. How am I doing that? In the gap. So I'm not predicting the gap. I had no idea Amazon was going to gap up on earnings. I wait, I see the gap, then I go through, then I rate it. And again, getting back to what I was saying, power money is the key. It's the key for you making money. And again, we don't do cheap stocks or low float stocks or anything that's a penny stock. I get this question a lot. Can you do this if you are a beginner? I have a couple new people that are signed up to do the class with me in February. Yes, they're going to be learning everything hands down, candlesticks, everything from the beginning. Again, your learning curve is going to be different from everybody. Everybody's new when they come and meet me. I wouldn't be afraid of it. Sometimes people that are trading for a while do, not as well as new people because they have bad habits, like buying dips and things like that don't consistently work. Buying dips is working right now for many retail traders. Why? The market's bullish. Everything's rallying. It's not going to last forever. It's not going to last all year. It probably doesn't even last the rest of the month. Really quickly here, we did another Tesla 230 put. Oh, this was the day of the earnings. No, this was the 11th. We did the 230s here. Again, this is a gap down. So that was another put. But for me, it's about finding momentum. For me, it's about shorting. So again, getting back to where we're talking about the industry itself, if you have two choices, if you want to be successful as a trader, you can do what I did, okay? I taught myself how to trade. Took me years, a lot of my own money. I worked trading full-time and a full-time job where I did it. That is always an option for anybody that wants to do it. It's a rough, tough road. I wouldn't want to relive that point in my life. Or you have to pay someone like me and take a class. The problem is that many people, no one's born and just wakes up one day and picks one class and then learns everything. You have to go through a series of taking classes and maybe some bad classes until you figure everything out. And the thing is that you don't know until you do it. So you kind of have to take it as a grain of salt. It's experience where you go through and you learn things. And what's helpful about programs like today, like Rob is running, where you're listening to different speakers, is if something I said resonates with you, then maybe you're interested in learning from me. You have to find someone that you connect with, and you have to find someone that has a system that you believe in, and you have to believe in it before you pay and sign up for the class. And then you move forward and you invest in it. Or like I said, you teach yourself how to trade. But that is the longest road, the most expensive road, and the toughest road to go on. And I found that most people don't have the stamina or confidence in themselves to be able to go down that road, let alone the money behind them to do it. Anyways, why is shorting so profitable? Fear, panic, all those things that come into a stock, like we saw even in the PayPal when it dropped, and the BA earlier in the year. And again, the checklist is what you will learn in the class from me. This is how you're going to know what stock's going to drop. This is how you're going to know whether to do Amazon, PayPal, BA, DFS, any of the ones that I'm talking about. The whole point is to look for stocks to trade that have, number one, a high probability of directional bias for the entire day. 2, big moves on the day. 3, early confirmation of my bias in the move between 9:30 and 10 a.m. Eastern time. And number 4, precise entries with follow through and a good risk to reward. And again, I think 100% is my goal every trade, but sometimes I got out of options at 50%, and sometimes trades are much, much more. But if you don't have a plan of action for why you're taking a trade, if you're going into things trying to figure out what the market's doing today to take a trade, chances are you're going to lose, okay? While the market's been bullish, it may not last all year. There's a lot of things that could affect this market this year. The election is only one of those things. So anyways, if my system sounds like something that you are interested in and want to explore, it is called the Golden Gap 26-point rating system. It is a rating system that helps you pick which stock to trade each day. It pinpoints ahead of time, so you know before the market even opens what stock will have the move of the day with volatility to trade. It makes it less stressful to trade when you have this all planned out, when you have the checklist, when you know what to watch. Otherwise, you're scanning into the open, and by the time you figure anything out, the move's already 80% done, and it's 10 a.m., okay? Having a checklist forces you what to look at when you should be looking at a chart and a stock to make the correct direction. And again, having a checklist helps you assist you with directional bias. Everyone has a checklist. If you went and got an operation, if you wanted to fly a plane as a pilot, you have a checklist. If you're a nurse, if you're an accountant, okay, you have a checklist that you go through and you check everything off. It says, okay, I did this, 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 and this, and then you know what you're doing and that it's right. But anyways, getting back to what I was saying, don't waste time trading without getting anywhere. It makes no sense. I teach a class once a month. This class teaches a rating system, how to play the stock, all the entries and exits. It teaches you chart analysis on an advanced level. And remember, this is an investment in yourself. If you want to learn how to trade, you're never going to learn how to trade by watching free webinars and free videos all day long. You could spend the next 25 years doing that and never be successful. And it's just a waste of time and a waste of your life. I'm the type of person, when I decide I want to do something, I'm just all into it. I realize that everybody has the same personality as me, but I really was like that with trading, and it's one of the reasons for my success. If I had quit during the time when I didn't know what to do, when I was trying to figure this out, when I was losing, I never would figure it out. And again, looking back, you say, well, I did it. But again, if you're not willing to invest in yourself to be successful, how could you possibly expect yourself to be successful? So you need to get value out of your education. And part of it, again, the benefit of that is following me in the room. So empower yourself today to trade. It's a complete system that teaches you how to trade gaps. I focus on shorts. The class is called the Golden Gap course. It's a full 2-day course on how to strategically find, pick, and play stocks that are professional bearish gaps. Class is online. You can be anywhere in the world and take it. Class is February 24th and 25th. This is the February class. It's $69.99, 9 a.m. to 5 p.m. Eastern time. Class is online. You can be anywhere in the world and take it. And again, the trends course is the 27th. You get a bonus for this. If you want to sign up for the Golden Gap course combo, this is $74.99. I'm doing a Chinese New Year, which starts today. I live in Manhattan, I live in New York, and there's all kinds of parades and shows and everything going on that start today. I'm doing a special. If you sign up by the 23rd, Chinese New Year is going on through the 24th. Then you will get the trading room free to the end of the year, the options newsletter subscription free to the end of the year, basically all my trades for the year, the market report subscription free to the end of the year, and the gap options course free too. And the Golden Gap course combo includes the Golden Gap and the trends, and this ends on the 23rd. Let me see if there's any last minute questions. I'm looking at my time. Any other questions from anyone about anything? Well, John, you have to make your own choice. You have to make your own decision. And that's what you need to do. Thanks so much for having me. Thanks so much for having me, Rob. Have a wonderful weekend, everybody. Enjoy the Super Bowl tomorrow.
Thank you, Melissa. And if you don't mind me saying again, you know, like I was privileged enough to spend Thursday and Friday last week in her room, and she thinks she called 3 out of 4 profitable trades, but she actually called 4 out of 4 if you use the limit order on the first one. It was a wonderful experience, and like I said, I did make a few $1,000s. It was a beautiful thing. So, Melissa, I want to thank you for making such a generous offer to our audience today. It's always a pleasure to have you on Traders Corner. Ladies and gentlemen, Mrs. Melissa Armo of the Stock Swoosh, an expert at trading gaps. And I will also add the fact everybody knows stock takes the stairs up, they take longer to get there, and they take the elevator down because that panic and disorder does make down moves faster than up moves. If you're interested in learning a rules-based strategy that has the potential to garner fast profits that I have personally seen trading in just 30 minutes a day, you can find her offer in the chat box, and she can always be found at thestockswoosh.com. I'll put that in the chat as well. Thank you again for joining us today, Melissa. We hope to have you back. Have a great weekend. Ladies and gentlemen, our staff at Traders Corner sifts through hundreds of pro traders to bring you only the most credible and qualified traders to participate on our shows, and our next presenter is no exception. He's our decorated Navy fighter pilot, graduating from the Navy Fighter Weapons School Top Gun. He was also selected by the largest options trading firms in the world to be their managing director of strategies. He's the founder and CEO of Options News Network, and in 2010, he founded Top Gun Options to trade retail investors of all skill levels how to trade options. He's trained over 10,000 people to date, and here to present Solo Amazon, the only stock you need to own, is Mr. Matthew Whiz Buckley. Welcome back to Traders Corner, Whiz, and again, thank you for your service as usual.
Thank you, my brother.
Get you promoted.
Intro, man.
Brother.
Awesome. All right, everybody, you got me loud and clear. Everybody, give me a vertical or a head nod there. Everybody, good?
I give you a vertical thumb.
All right, there we go. Robin, I'm not Tom Cruise. I'm a little taller and much better looking. So let's go ahead and get it. I was going to
add that. If you didn't say better looking, I was going to throw it in there.
Yeah, I appreciate it. Just ask me, right? So, all right, folks. All right, here we go. No distractions. Let's go ahead and get airborne. Welcome aboard my brief. I guarantee you, there's a lot of guarantees around the financial training space, right? There's no such thing as financial education. It's training. Training gives you a skill, right? Fighter pilots are trained. Options traders are trained. Doctors are trained. The world is full of educated derelicts. So I guarantee you in your financial training, you've never heard what I'm about to tell you today. Okay, so sit up straight, and we're going to talk about the Death Star. Now, if you're sitting here going, okay, what's this have to do with trading? Everything. I'm not going to age myself, but let's just say I was a kid when Star Wars came out, right? Now I raised a couple Star Wars nerds in my family. The Death Star, everybody remembers the Death Star, right? Giant space station taking over the universe and destroying everything in its path. It got attacked a couple times, but guess what? It emerged bigger and stronger. That's the stock we're going to talk about today. The only stock you need to own. And you heard me right. Real quick, though, as Rob said, former Navy F-18 fighter pilot. So I'm going to start with a multiple choice test right now. Which fighter aircraft would you rather fly? And if you're sitting here going, I'm not a pilot, I have no idea what you're talking about, it doesn't matter. Take a look at that picture. Folks, that's the cockpit of an F-4 Phantom, right? Look at that. Over 300 switches and dials in that cockpit. The pilot would spend a lot of time what we call heads down looking at all this stuff instead of eyeballs out of the cockpit looking for enemy aircraft, surface-to-air missiles, AAA anti-aircraft artillery. This jet was so labor-intensive, they threw another dude in the back seat to just run the radar. So would you rather fly that aircraft in combat or this one? Look at that, folks. 2 flat panel displays. 2 flat panel displays, folks. No steam gauges in that cockpit. We call this jet the Wonder Woman jet, right? It's invisible to radar, and you want to talk about something creepy? This jet is learning. It actually doesn't display info to the pilot at various portions of the flight. Why? The pilot doesn't need to know that right now. I got it. So it's learning. So trading is a form of combat. Somebody's going to win and somebody's going to get the rear end handed to them. So which one would you rather be flying in combat? Obviously, the answer is clear. The F-35 Lightning, the Joint Strike Fighter. By the end of the brief today, I'm going to give you an up-to-date intelligence brief, what's going on in the world, show you the only stock you need to own. And if that doesn't hit you right, sit up straight and pay attention. And a good substitute to trade, as a buddy of mine says, often that shrimp are a vehicle for eating cocktail sauce. So this substitute is a vehicle for eating the only stock you need to own. Okay, so here we go. Real quick, why should you listen to me? I don't even know who you are yet. Well, here's the Barclay Hedge Fund Index through the end of last year, right? Everybody's like, oh, I wish I was in a hedge fund. Okay, 9.29% the average hedge fund return last year. The smart money. How did I do? This is my personal brokerage account. Look at the market through the end of the year real quick, though. All over the place, and then a big implosion, and then a rip your face off rally that we're in right now. Look at the volatility on your screen. Okay, so that was the smart money. Here's me. This is my personal brokerage account. 150% return last year. And look at when I really started outperforming as the market got crazy. Look at that, September through the end of the year. I absolutely crushed it. Why? As an options trader, I love it. I love volatility. Most folks don't. I do. I thrive off of it. So this is why you should listen to me, because I embarrassed the smart money last year and for most of my career. As Rob said, my name's Matthew Buckley, folks. My call sign's Whiz. I earned that call sign flying the F-18 Hornet for the United States Navy for about 15 years. Graduated from the Navy Fighter Weapons School. That's a lot of words. Yeah, that means Top Gun. Graduated from Top Gun as a bad guy. I was an adversary pilot. I also deployed for Operation Southern Watch, Noble Eagle, and Enduring Freedom. What's that have to do with trading? Everything. As a young aviator, okay, now I'm really going to date myself, over 30 years ago, I started investing. You don't join the military to get rich, folks. You join the military to, see the world, especially the Navy, to see the world and deliver justice to bad guys. So I said, you know what? I probably should learn to invest. And guess what I did? I applied everything I was learning as a fighter pilot to my trading, having a strategy, implementing tactics, contingency planning, knowing when to get out of a good or bad situation before it got worse, managing risk. Okay, this guy's inverted over Top Gun in the desert, and he's talking to me about managing risk. Yeah, as an options trader, as a fighter pilot, I want to minimize all known risk. I love myself too much to let anything bad happen to me or to fail on my mission. Guess what happened? I applied all of that stuff and it worked so damn well that I popped up on the radar of one of the largest, actually it is the largest now, the largest volatility options trading firm on the planet. Everybody should know this building. That's the CBOT, the Chicago Board of Trade. You see those big, beautiful windows? That was my trading firm. I helped build a hedge fund when I was there. I helped build the retail brokerage called Options House, and I was the managing director of strategy for this multi-billion-dollar vol arb firm. And I also started the Options News Network. We'd shoot on the floor of the CBO and the CBOT, giving folks like you a behind-the-scenes look at what was going on in the options market. I jokingly tell people that I'm dating myself with this movie reference, but I jokingly tell people that I was Valentine, Eddie Murphy in the movie Trading Places, right? Little old retail trader trying to make it in the big leagues. And I made the smart money look pretty damn stupid. Wrote a couple books along the way, from sea level to sea level, my transition from essentially the cockpit to the trading pit. And then I wrote a book a couple of years ago about the market crash due to COVID. I destroyed it. It was insane. I'll never forget that day, January 22nd, 2020, Donald Trump in Davos with all the beautiful people. Joe Kiernan, CNBC, final question in his interview with Trump, Davos. Oh, wait, one more question, Mr. President. What's this China bug or flu? Dumb question, Joe. Why you ask me that dumb question? You're so stupid. Not coming here. I trust ye, good dude. I looked into the camera in a live trade brief and said, get out. I had a deep throat in the White House, a buddy who told me everything, and I knew it was coming, and I did, unlike Nancy Pelosi and other politicians, I did outsider trading. I told all of my members, and we made about $2.5 million in a couple weeks. So wrote a book about it. I also have a podcast that's ranked in the top 2.5% of podcasts in the world. It's called the Max Afterburner Podcast. Right there, it's in the top 2.5. So make sure you check out that podcast. What do I talk about? This. We're going to get into trading right now. I just want to give you a quick intro of who I am. I'm the chairman and founder of the No Fallen Heroes Foundation. In the hour-ish that we're together, 2 veterans are going to take their own lives. Anywhere from 22 to 44 veterans take their own lives in this country every day. It's a mass shooting, folks, and the government's doing little to nothing about it. I am. This will blow you away. Almost 4 years ago, I went to Mexico. If you've ever seen the movie Lone Survivor or read the book, I went there with Navy SEAL Marcus Luttrell. If you drink Black Rifle coffee or you trade the stock, Jared Taylor, me, JT, Marcus, another Navy SEAL veteran, and an NFL player went and we did psychedelic assisted therapy, and it saved and changed my life. I got home and I started a foundation. So we provide healing grants to veterans, first responders, and their families to heal their PTS and their trauma. And that's what I do. That's when we left Chicago in 2010, 2009, and we started Top Gun Options. That's who I am. Let's go ahead and get airborne, folks. So you ready for this? Thank you. I appreciate that, Horwitz. Let's get airborne. This is going to be, I don't know if it's going to be shocking to you or not. Half of you are going to be shocked and half of you aren't going to be shocked. You ready? What's the news? Here's the shocking news. Wall Street is lying to you. Now, of course, half of you just rolled your eyes and said, duh, and the other half has said, what? How many of you have heard this since day one of investing? You can't put all your eggs in one basket, right? You heard that, right? I heard that on day one of investing. You must diversify. Diversification is important. The 5 tips to diversify, diversify, diversify. Ladies and gentlemen, that's a lie. It's an absolute lie. Who's been lying to me, Whiz? That guy. Ladies and gentlemen, whenever you use the word broker, whether it's stock, real estate, yacht, aircraft, delete the word broker and insert the word commission. Ladies and gentlemen, they want you in as many names as humanly possible to make money. It's actually in industry practice, it's called churn, ladies and gentlemen. Did you see the movie The Wolf of Wall Street or Boiler Room or the movie Wall Street? All right, guys, pick up the phone and let's call the little old ladies in tennis shoes. Get them out of the stock we got them into yesterday. Get them into this one. Cha-ching, cha-ching, cha-ching. Ladies and gentlemen, they want you in as many names as possible. In and out trading. They make money. Now, before you even type it in the chat box, don't. Because there's always somebody who goes, what? Well, Whiz, you're not so smart. I trade with Robinhood. And this is what I say to that person. You're not that smart. Ladies and gentlemen, if you're not paying something, you're not the customer. You're the product. You know who the customer at Robinhood is? Ken Griffin at Citadel or Steve Cohen. Ladies and gentlemen, it's called payment for order flow. If you don't know who the idiot is at the poker table, it's you. So don't give me this, I don't make, pay commissions, Whiz. That means you're the product. So ladies and gentlemen, and I'm going to be blunt. I'm a fighter pilot. I'm direct. I have no time for niceties. So you ready for this? Diversification is for stupid people. Now, if that offends you, I'm going to have a little old man clean it up for me. You ready? Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. I said it more direct. He said it a little nicer. Ladies and gentlemen, you do not need to do anything for the rest of your life except buy this stock. If that makes no sense to you, buckle up, Buttercup. I'm a political science major from South Jersey. I like drawings. Take a look at this drawing. Look at the net. It's not updated with the most recent earnings. Did you see? We're going to talk about earnings last week. Did you see the earnings last week? Ladies and gentlemen, this is a hockey stick. I need to update this chart with the 2023 because it's insanity. Ladies and gentlemen, the net revenue in billions for Amazon is disgusting. Straight up. Look at I need to update this chart too, obviously. Look at the net revenue by segment. AWS, I remember years ago, folks, AWS didn't even exist. Today, AWS is Microsoft. All of this looks like this. AWS is massive. I remember Andy Jassy, the current CEO, and Jeff Bezos came up with the idea like in a condo one night, like, hey, let's do this. It's huge. Now, when you think cloud, what do you usually think? I know a lot of people go, well, Microsoft, big in cloud, or Google, or Apple has a big cloud. You're completely wrong. The cloud infrastructure market is owned by Amazon, period. Now, I'm going to get political for a second, but it's going to be political neutral. This chart is why Democrats hate Jeff Bezos and Amazon. Let's dig into it. And let's delete the word Amazon right now. If you just drop me in this brief right now and said, Whiz, would you buy this stock? I'd look at this chart and go, wow, look at the sales. I love it. Well, hold on a second. Free cash flow, that's a big difference between the sales and then wait a minute. They barely make any profit. I would short this stock and I'd be broke. Why? And why do Democrats hate this? Ladies and gentlemen, Jeff Bezos is brilliant. Love him or hate him, Jeff Bezos is brilliant. He doesn't know what the word dividend means. He says, wait a minute, if I make $1 at Amazon, I'm taking that dollar and buying an airplane, putting a competitor out of business, buying another business. He takes every profit, every dollar, and goes back into the business. So that's why when some Democrats are, AOC or whatever, like, we need to tax Amazon and their massive profits. And he just kind of laughs and goes, well, that's weird because I don't make any money, even though I'm the richest man in the world. So ladies and gentlemen, look at that. So it's just awesome. In my solo Amazon service, look at JG with a small account trading Whiz Amazon trades netted $8,900 in a week. Kristen, you guys are amazing. I trade a smaller account and have done 22 Amazon trades this year for 31 grand in profit. Christine, month-to-date profit on Amazon, 107 grand with more to go. Thanks, Whiz, for all your expertise and guidance doing day trades with short calls to protect my Amazon profits, learning from the best. And then Anne, one of my star students, Monday through Wednesday, in 3 days, I made $90,000 on short calls against her 30 contracts, utilizing Whiz's guidance. She made me look like I'm brand new, man. It was awesome. Now, before I just sit here and preach sunshine, lollipops, and unicorns and everything's great, I'm a fighter pilot. I'm an options trader. What are the threats? What are the risks of just trading a single stock? Anybody hear of a small mom and pop company called Lehman Brothers? How about Bear Stearns? Jim Cramer remembers Bear Stearns, doesn't he? At the height of the financial crisis, he looked like Khrushchev at the UN, a bald guy frothing at the mouth, slamming his shoe on the table. You're an idiot if you don't put your money in Bear Stearns. It's safe. 2 days later, it was at zero. Good call, Jim. How about Pets.com? How about Enron? Ladies and gentlemen, I could take the next 27 minutes of our time together and walk through the graveyard of stocks that have gone to zero, but let me summarize it real quick. What's the common theme between these four examples? They owned nothing. Enron didn't even own the building they were in, folks. Pets.com owned a URL and a stinky sock. Bear Stearns and, Lehman Brothers didn't even own the sign on the building. They didn't own a thing. Stocks, ladies and gentlemen, can go to zero. Can Amazon go to zero, the stock? Theoretically, yes, but technically, no. What do I mean? Ladies and gentlemen, they own things. Not a stinky sock and not even the build. They own. I did consulting for an Amazon fulfillment center years ago, south of Miami International Airport. It made an aircraft carrier look pleasant. It was massive. Robots, people, it did. I've been on an aircraft carrier before for a lot of years, and it was insane. So they own things. Full disclosure, I flew for FedEx for about 10 months. I hated it. I hated showing up in Memphis at midnight and flying until 8 in the morning and trying to sleep during the day. Why do I bring this up? Because I left couldn't stand it. But a buddy of mine went into management. He called me like, when was it, 7 years, 10 years, however long ago. He called me. He's like, hey, you trade, right? Yeah, what's up? Who's Jeff Bezos? I'm like, he runs Amazon. Why? He's like, well, a buddy of mine at GE Aircraft Leasing called him and said Jeff Bezos is leasing 5 jets. And I said, he's going to do it. And my buddy's like, what's he going to do? I'm like, put you out of business. And he laughed. Guess who's laughing now? Amazon is now shipping. Look at the dates. This is February of 2021. Amazon is now shipping cargo for outside customers in latest move to compete with FedEx and UPS. Look at the date. Amazon poised to pass UPS and FedEx to become the largest delivery in 2022. And then this one last month. The biggest delivery business in the US is no longer UPS and FedEx. Years ago, I told Top Gun Options members, I'm like, you want to short stocks? You short CVS, Rite Aid, and Walgreens. They are taking over everything they touch. Oh my God, why is this guy on the screen? Don't freak out. Why is he on the screen? Because in the first year of his presidency, he grabbed his cell phone one morning and started tweeting like he always did and said what? Amazon, it's a monopoly. Somebody should break it up. Jeff Bezos monopoly. What happened? The stock went down just a little bit. And then what happened? Nothing. 3 years later, again, he picked up his phone and did what? Now it's really a monopoly. Somebody needs to do something. Jeff Bezos, Washington Post, bad. Nothing happened. So, ladies and gentlemen, yes, there is political risk. Amazon is in the crosshairs of the DOJ, the FTC, blah, blah, blah. I am old enough to remember this. I am old enough to remember Standard Oil. I'm old enough to remember Microsoft, IBM. How about AT&T? When Uncle Sam starts looking at you going, are you a monopoly? And they start poking around. On average, it takes 5, 10 on the outside, 15 years to come to a decision. And guess what? It's too late for Amazon. Amazon is Mercury. If you tried to smash up Amazon right now, you'd make like 12 little monopolies. The Amazon is better as a whole, but it's actually worth more if they broke it up. I'd buy the 12 companies they break it up into. So, ladies and gentlemen, it's Amazon. So, yeah, there are threats to, just trading one stock, but, and I tell people I'm bipolar, and so am I. I'll tell you how I feel as Whiz, fighter pilot. I can't stand Jeff Bezos. He makes my skin crawl. At the height of COVID, he wasn't paying his employees well. They didn't have personal protection equipment, and also I just can't stand it. Last week, they upped. Now I'm watching Amazon Prime. I got to pay an extra $2.99 a month for to not have ads. They're like squeezing me. And then I'm bipolar, and I'll put on my $10,000 Armani suit and go, good. I love Jeff Bezos. I love everything he does because he maximizes shareholder value. Now, let's talk about the benefits of just trading Amazon. You trade the same name and potentially profit no matter what direction it goes, up, down, or sideways. You stay focused on Amazon instead of a bunch of stocks and ETFs, which essentially makes you an expert in Amazon, reducing time spent on other positions. Let me tell you a quick story. When I moved to Boca Raton from Chicago, I met a doctor down here, orthopedic surgeon. He's like, hey, I hear you're a good trader. Help me. I'm like, all right. Met him at a Starbucks. Booted up his computer. He showed me his E-Trade platform. You ready for this? 33 positions. This is not a joke. Hand to God. I'm glad he's a doctor. I passed out and hit my head. I'm like, what is this? He's like, this is my brokerage account. I'm like, dude, you work like 8, 10-hour days, surgeries and office hours. He's like, yeah, in between, I kind of look at my phone and see what's going on. I'm like, are you insane? What is this? He goes, well, this one's like a pot stock, I think. I'm like, did you just say you think? And then, well, this one's a surgical stock, and my buddy got into it, and, it's down 50%, but, I'll get out of it when it gets back up to where I bought it. I'm like, doc, you're a doc, right? Yeah, why? You're supposed to be smart? Yeah. Do the math behind how much it has to go up. I'm like, stop talking. You're done with all of this crap. Sell everything and get into Amazon because it's diversified in and of itself. Everything you have in your portfolio right now is essentially what Amazon does. Simplify your trading cockpit. And he's crushing it. And you can look at the chart of Amazon. So if you're sitting here going, you know what? I think he's kind of talking to me. I got a lot of positions. Folks, I had a research desk and that trading firm in Chicago, we had like 25 analysts sitting over there. They had to know, a junior analyst could focus on 1 or 2 names, but a senior analyst could have like, was it 3 to 4? At most 5. They had to know everything about that stock. They'd eat, breathe, sleep it. Do you know how many times I got up from my desk and walked over to that research desk and looked at an analyst like, how come you missed this? Your only job is knowing the stock. So they did that for 8 hours a day, folks. Please tell me as a retail trader how you do it if you're managing 5, 10, 15 positions. Even if you're doing it full-time sitting there all day, you can't. Now, if you're sitting here going, man, I like what this guy's saying, but Whiz, I got to diversify. It just doesn't, I can't. Guess what? In this service, I also trade XLY. It's an ETF, folks. It's an exchange traded fund. As I said earlier, shrimp are a vehicle for eating cocktail sauce. Amazon, ladies and gentlemen, is 25%-ish of the XLY. Here's your diversification. You get some Tesla, Home Depot, McDonald's, Nike, Starbucks, Lowe's, Target, Booking, TJX. So ladies and gentlemen, we also trade XLY in this service. So technically there's 2 positions if you want. So how do I target Amazon and XLY for max profit? When you become a member today, we do the solo Amazon brief every Monday at 10 a.m. Okay, I work for a living during that time. 80% of my members work, folks. I send out text and email alerts, and you can watch the replay. Okay, but anyway, I'm going to hop in a time machine. We're going to do that right now. Let me look at the clock. Yep, I got time. I'm going to show you my brokerage account. We're going to fly into the future, 2 years, 3 years on the Amazon options chain and get long-term bullish on Amazon all the way out into the future. We're going to be the Marines. We're going to establish a beachhead, a base position called synthetic stock. Once we establish that bullish position a couple years out into the future, then we're going to trade what I call the front months. What's a front month? You're sitting in a front month, February, March, April. So right on your screen right now, folks, is technically 2 trades. We have a long-term bullish position on Amazon, and we're going to trade the front months. Hey, Amazon's going up this month. Yay, we'll trade some bullish spreads and maybe buy some calls. Uh-oh, Amazon's going down. Who cares? We're going to make money. As an options trader, I don't care which way the market's going, up, down, or sideways, I potentially profit. Amazon's going down? Okay, we do some bearish spreads and buy some puts. We can even do a tactic called an iron condor when it trades sideways. I'm going to show you Amazon. For a couple months there, we were making $10,000, $20,000 a month as Amazon was range bound. If you just bought the stock, folks, you know how you make money 3 ways? It's called the buy, hope, and pray. You buy the stock, you hope it goes up. If it doesn't, you pray. Not me. If Amazon's moving sideways, folks, we can make money as it trades sideways, okay? Okay, now let's go pull up my brokerage account. I have synthetic stock on, this is the primary portfolio. We're up about 11 grand year to date in our Amazon position. Here it is right here, folks. It is called synthetic stock. Let me pull up an options chain here on First of all, look at Amazon. Amazon in this range right here, we printed money. Let me open up the chart a little bit. Every time it gets range bound, like in here and here, you do iron condors. It's going down, you do bearish spreads. It's going up, you do bullish spreads. But ladies and gentlemen, look at the options chain. Let me delete the front month here. So if you're new to options, I'm going to teach you how to do this. This ain't rocket surgery. Let's go all the way out. Look at how far into the future. June of 20. Do you know the average holding time for most stock people nowadays? This isn't your father or mother stock market. You're not buying shares in Amazon. getting share certificates in the mail and putting them in a shoebox in your closet. The average holding time for a stock is about 13 months. But look at what we can do with options. We can fly all the way out to June of 2026 and get long-term bullish on Amazon. So I can click on that, and we can create a position called synthetic stock. If I wanted to buy 100 shares of Amazon today, it would be $17,500. Okay? Remember that. Now, ladies and gentlemen, remember, one contract, one options contract allows you to control 100 shares of stock. So let's remember 17.5, okay? We could go all the way out to June of 2026 and buy one Amazon call. Buy one June of 2026 170 call. Actually, I'd go to the 175. Because look, the stock is currently at about 175. I could buy one June 26, 175 call. Ladies and gentlemen, that's spending $4,100. You are controlling 100 shares of Amazon stock. This is the point in the brief when I look at people and go, why would you ever trade a stock again in your life? If you are long-term bullish on Amazon, would you rather spend $17,500 or $4,000? You don't have to write the obvious answer. But I can do also in addition to this, and if you don't understand this, don't worry about it. Most of you know, if you buy a put on something, you've heard this, right? Even if you don't trade options, you've probably heard like, uh-oh, the market's really high, I'm going to buy some puts. Or NVIDIA is going to the moon, it might pull back, let me, quote, buy some puts. So buying a put is usually bearish. Somebody who sold that put to you is bullish. So in addition to buying this call, we could sell an at-the-money put, the same strike, the 175 put. So ladies and gentlemen, instead of spending $4,000, it's down to $1,600. And let me just show you the P&L diagram here, folks. Look at this. This is the P&L diagram for long stock. I bought 100 shares of Amazon, Whiz. That's your drawing. Mine is the same exact drawing for the options, ladies and gentlemen. This tactic is called synthetic stock. What's the word synthetic mean? Two things that you don't care about with Amazon. The word synthetic means you actually don't own the shares. You're not a shareholder, which means you don't get two things, and you shouldn't care about these two things with Amazon. The first thing is a dividend. If you're trading synthetic stock, you don't get paid a dividend. Duh. Jeff Bezos laughs at the word. He doesn't know what the word dividend means. He's never paying a dividend. And the other thing you don't get if you're trading synthetic stock and don't own the shares is to vote. You're not a shareholder. Last time I checked, Jeff Bezos and his ex-wife owned Amazon, a little bit more Amazon shares than your 100 shares you might buy. So who cares about the two things you don't get doing a synthetic stock trade, folks? How many of you want to spend 17 grand today? Nope. How many of you want to spend $4,000 today? Nope. How many of you want to spend $1,600 to get synthetically long Amazon? So, John, great question. What I'm going to teach you, let me go back to this slide real quick. What does this say, John? I love John because he's smart. Hey, what's the margin requirement? We put on what's called a wrong color marker there, a protective put, John, to lower margin requirements even more. So because of that short put, we're going to buy a downside put that I call a protective put. So John, absolutely. We're going to lower that margin requirement significantly by buying what we call a disaster put. Let me show you my current position. Let me show you in my personal brokerage account. That's our model account. Here's my synthetic stock I put on a couple weeks ago on Amazon. It's up 73% or close to $4,000. Let me open up the trade and show you. hold on, I can click analyze. There it is. So look at this. I did synthetic stock back when Amazon was down at 150 a share. So to your point, John, I bought this put down here to reduce the margin requirement. I don't want to cover that real quick, but that's a great question since it shows you know what you're doing a little bit. But this is what we do. We go out and we buy a lower strike disaster put. So great question to lower your margin. Oh, sorry. Shit. Sorry about that. I'm sitting here talking to myself. Here it is right here. Sorry. I'm up $4,000 in the past couple weeks, especially, I mean, go look at the chart, folks. Amazon is on a tear. And let me close this down a little bit. Let me show you something when it comes to earnings. This is called a gap. They had blowout earnings and the stock gapped up. This is half the gap. If a stock gaps up on earnings and kind of hovers and goes up, it's incredibly bullish. If a stock gaps up and fills the gap and bounces, it's bullish. It didn't even do that. If a stock gaps up, fills the gap and goes lower, obviously it's bearish. So folks, it did the best case scenario after earnings. Pop, hover, up. That, folks, is getting ready for a rip your face off rally. And I get it. The tech names and the S&P 500 is up 14 out of the last 15 weeks. We are due for a pullback. I get it. But guess what? When you join the Solo Amazon service today, I'm going to show you a perfect entry point. But it doesn't matter. I don't care if Amazon, this trade, you only do synthetic stock, folks, on names that look like this, that are going up and to the right. Obviously, ignore COVID in the middle. That's just insanity going on here. But look at Amazon. You want to do synthetic stock on names that move up and to the right, and that's exactly what Amazon is doing. Even if we do get a little bit of a tech or market pullback here, I just told you I'll do some bearish spreads. And when I do those type of spreads in the front month, I lower the cost basis of my synthetic stock. If Amazon starts to get into a range up here, I'm going to trade that iron condor tactic. So technically, those are two trades. We have a long-term bullish trade all the way out to June of 2026, and then I'm going to trade these front months up here, February and March. Makes sense? If that doesn't make sense to you, welcome aboard Top Gun Options, because that's my job, is to teach you in our live trade briefs, in our training, how to trade options. If you kind of followed that, I can teach you. If you didn't follow it at all, I can teach you. If you're an options trader, or John's like, hey, what's the margin on that? I'll make you better. That's the motto of Top Gun, right? You think you're good? I'll make you better. I guarantee it. So real quick, because there's people asking, Solo Amazon, that's the name of my trade service, every Monday at 10 a.m. My other briefs where we trade volatility and psychedelic stocks and all sorts of stuff, they're $167 a month. Today, I'm going to give you all a special offer. You can do either $97 a month. I don't drink anymore after my psychedelic experience. It deleted alcohol. Why am I talking about that? Because it's $97 a month. I used to say, hey, that's the price of a nice bottle of wine. Maybe I'll just say it's the price of some nice. Oh, you did, John? Oh, man, that's awesome. John's, thank you for your service, bro. He's a fellow fighter pilot, F-105 Thunder Chief. Thank you. Well, he's Air Force. Air Force is barely on our side. I was a Navy guy. So, $897 a year, folks. I'll give you a 20% discount. It's essentially 2 months for free if you do the annual. Rob will throw the links in there. It's topgunoptions.com/solo annual, or I'll give you the $97 bucks a month link here in a little bit. That doesn't go up. That's not some surprise like, oh, next month it's $1 billion. It's $97 a month, folks, for the rest of your life. I don't raise prices on people. I super don't need the money. Most of the money I make, folks, goes to my foundation to save and change lives. That was my performance last year in the Solo Amazon portfolio, about $100 grand. Can of 10, Whiz, every Monday at 10 a.m. I work. So do I. Most of our members work. I send out, there's a screenshot of a text alert, for example, and then I send an email with a screenshot of the order ticket and the risk of each trade. And then about 30 minutes later, the replay is posted on the replay page. There we go. Easy for me to say. I'm so geeked, been a subscriber for almost 3 years now. This is the first time I've been able to see you live. I know you via the replays. Today, I'm going to throw in my manuals, your primary, intermediate, and advanced manual. Folks, I look at these things again every once in a while to brush up on what I'm doing. If you're a political science major from South Jersey like me, let me help you with the math. It's $97 for a month, but I'm giving you manuals today that are worth $197. Yeah, exactly. You just made $100. Keep the manuals. They're yours, man. But you're essentially getting a free month because of the manuals you're going to get today. So here's what you get today: access to the brief every Monday at 10 a.m., text and email alerts, the manuals, and access to, John would know this, I call it our Ready Room. It's our online forum. You can ask me questions in between the briefs and of me or your fellow traders as well. 37 grand profit. Goose, 23,800. Chuck, look at this, Chuck. Thank you, Whiz, for the Amazon calls. I closed 3 contracts at my 30% profit target. Cleared 15 grand. Also had 6 Amazon 2023 calls that hit 30% for another 50K. So if you want to test fly solo Amazon for a month or a couple months or however long, you can stay in here forever at $97, but that doesn't make sense. It's cheaper to do the annual, but there is the monthly link as well. And I think Rob just threw that in the chat box for me. So, okay. I feel like the Flex Seal tape guy. But wait, there's more. There is more. Just like when you check out of Amazon, they're like, hey, do you also want to buy something like this? I'm going to offer you the full throttle training. It's only $295, folks. There's other places that suck that charge like $5 grand for this. I don't do that. I charge for the practical application, you being in a live trade brief. But folks, you're going to get access if you do the $295 to the training. We take, and John knows this as a fighter pilot, we take a building block approach. When I got to Pensacola, Florida to learn how to be a naval aviator, there was a guy who his first flight in an airplane was from Montana to Pensacola to go to flight school. And in a short amount of time, the Navy could turn him into a fighter pilot just like me, who had some, civilian flight time. But we're going to take a building block approach. This is the market. These are calls. These are puts. These are covered calls. We take a building block approach. So if you don't even know what the hell a call or a put is, welcome aboard. Those are sessions 1 and 2. If you're kind of a Jedi master and know what you're doing, still go through these and watch them. And they'll probably tighten you up a little bit in some stuff that you hadn't heard before. And then obviously the little bit more advanced stuff is down the road, but it is a building block approach. Peter, it's called the Max Afterburner podcast. And I talk about a lot of the medicine work that we do on that Max Afterburner podcast. Speaking of naval aviation, this guy's call sign is Utah. His name's Mark Provo. He was a Blue Angel. He was a solo and the lead solo. Why do I bring him up? He's the village idiot. He'll be the first one to admit that. He's a FedEx captain now. He's like, dude, I don't know anything about the market or options. I brought him on board. He sent me this text recently. Good morning. Less than 20 trading days, I'm up 15 grand on my $40,000 account. So I'm like, well, shit, bro. If you can do it, anyone can do it. Most people would kill for a 38% return in a year. So there's Provo, Mark, Utah, former Blue Angel. Another testimonial. I'm not going to bore you with that. Like I said, my other briefs are about 167 a month. Since this one, we're only trading Amazon. Guess what? It's cheaper. It's $897 a year or $97 a month. And that's pretty damn cheap. Folks, if you didn't learn anything today, I failed miserably, but do me a favor, do you a favor. Go debrief yourself. Go look at your portfolio and go, man, am I flying around in an F4 Phantom? Or can I simplify my trading cockpit by maybe just trading Amazon or XLY? Remember, folks, Amazon is diversified in and of itself. Amazon Prime, folks, the entertainment division is Netflix. AWS is Microsoft. Amazon Air is beating FedEx and UPS combined. So, folks, again, don't sit here and look at, I can't just trade one stock. It's technically 12 different massive stocks rolled into one, and it's not going to zero. And again, if you just got bit in the neck by the broker and I can't not diversify, does not compute, we trade an ETF. It's called XLY, where 25% of it you can get some Amazon. So, ladies and gentlemen, at the end of the day, trading is a form of combat, and simplify your trading cockpit with either, Amazon or XLY. But come check out the service. Like I said, folks, $97 a month. If that's your last $97, don't come and do it. But if you can forego your bottle of wine this week or whatever to come check it out, we'd love to have you. Sandra, I don't recommend a particular broker. I have been at E-Trade for a long time, so I like my E-Trade. But you can use anybody. I mean, you can. We have Thinkorswim, we got Schwab, we got a lot of our international students are with the IB, Interactive Brokers. But folks, it's whoever you want to trade with, as long as you have options approval, you'll be good to go. So, all right, right on time, right on target. I love keeping Rob right on time. I had to be, as John knows, time on target plus or minus a second. I had to put a bomb through a window, so I'm going to do that right now. Thanks for having me, Rob. Everybody have a great rest of your day. Happy hunting. Make sure you hedge. Fights on. And welcome aboard Solo Amazon. And I'll see you Monday at 10 a.m.
Whiz, man, thank you for being here. I love you. Your product, you're just everything. And the fact that you're taller than Tom Cruise also lends credibility to you. But always on point, insightful, and relevant. Amazon is an absolutely exciting instrument to trade, and everything you said can be true is true. And there's plenty of money to be made on that one ticker alone. And being a military vet, I really appreciate the respect, discipline, rules-based strategy you bring to the table. Now more than ever, we need discipline in our trading. Thanks for joining us today, Whiz. Thanks for your service. Ladies and gentlemen, Mr. Whiz, Matthew Buckley of Top Gun Options. I put his link in the chat box below. You can learn more by going to topgunoptions.com. And I got to say, Whiz, you have one of the most colorful personalities that seems to mesh with mine well. And I've got a ton of respect for you, the veterans. If you won't stand behind them, stand in front of them. Thanks again for joining us, and have a great weekend.
Thanks, Rob. I'll see you next time, bro. Thanks.
You're very welcome. Ladies and gentlemen, I'm going to take just a second because we are working out a sponsorship deal with Mumu. I'm going to put their link in the chat box. They'll give you 5 free stocks if you open up an account and put in $100. They'll give you 15 if you do 1,000. I did it, and you'll get a 16th for using our link. I got about a free $100 worth of stocks by doing it. I know we're expecting Mr. Keen next, but he is having technical difficulties, so we have a replacement presenter for you. Mr. Rory Powers of Right Line Trading is a graduate of Syracuse University. He wears all the hats over at Right Line Trading, and he is always ready and willing to assist the Right Line Trading community with their systems, their things that they do, and stuff like that. Let me get him promoted over here to presenter. And I apologize that Mr. Keen is not going to be present, but we are going to have Mr. Powers from Right Line Trading in his place. Thank you so much.
Hey, Rob. Thank you for that great introduction.
Thank you, Rory. I apologize. You weren't on the list, and I thank you for filling in the slot for a presenter that's having technical difficulties.
Not a problem. And thank you for that great introduction. Hey, everybody. I want to wish everybody a happy weekend. And we're coming up on Super Bowl Sunday. So I know everybody's geared up for the Super Bowl. And I have a really exciting presentation. Today's presentation is on the AI Auto Trader. The AI Auto Trader is a fully automated trading system that has artificial intelligence that's been integrated into it. And before my presentation gets away from me, let me go back just a little bit. Let me see if I can refresh this. Okay. I want to get the CFTC, the alphabets of the federal government, out of the way. This presentation is for demonstration and educational purposes only. I am not a licensed financial advisor. If you're not familiar with the risks associated with trading, please consult with a licensed financial advisor. With that being said, here at Right Line Trading, I'm part of a very educated and distinguished team of traders and software developers. Our number one, our core mandate is to develop trading strategies that help predict the future direction of price. And what we do is, and man, let me tell you, that's very valuable information. To be able to know which way the market's going to move, that information can be leveraged in a number of different ways. And I just want to take a moment to acknowledge a couple of members of our team. And I really think that's what distinguishes us from our competitors, is the fact that we trade the market on the right edge of the chart every day in our live trading rooms. On the bottom left is Craig Emery. He's one of our futures traders. At the top right is our prop trader, David Kushner, who trades 6 funded accounts. And on the bottom right is Mr. David Wyse, who's our professional options trader. And he's in that live trading room every day, trading the right edge of the charts, leveraging our software signals on options positions. The top middle here, the top right is Mark Sachs, who also runs a number of different options alert services. Behind the scenes, we have Brock Miller. Charles Sider has a master's degree from UCLA in computer science and engineering. Sergio Luque Rodriguez is also a software developer. Myself, Rob did a great introduction, and our team is led and Right Line Trading is owned by Mr. Mark Miller, who has his MBA from Cal State. And I always like to do one personal picture of myself. I reside down in South Florida. I'm a graduate of Syracuse University. My wife and I have 2 beautiful children. We were blessed with 2 beautiful girls, a 5-year-old and a 1-year-old. And my passion, other than trading, is saltwater fishing. And you can see a nice grouper here that we caught just the other day. So the genesis of the AI auto trader was the lack of consistency in our trading. Over the years, the last 10 years, I've spoken to hundreds, if not thousands, of traders. I'm sorry, Pranya says you do not see any visuals. Are you able to see my screen and hear my voice?
Rory, just for argument's sake, I've got your screen and hear you loud and clear.
Oh, okay, thanks, Rob. So the genesis of the AI auto trader was the lack of consistency. I've spoken to thousands of traders over the last decade, and I think we all share in these common problems that we lack consistency due to these emotional errors that we make. We might overtrade, revenge trade. We take a winning trade, we feel great about it. Instead of practicing some capital preservation, we'll continue to trade and give that money back. Or we'll take a few losing trades and want to win it all back and revenge trade and swing for the fences. And it all leads to the same sad place, which is a blown out trading account. So we lack the proper tools to efficiently trade the markets. And I heard in one of the presentations on Traders Corner, in fact, that humans have maybe a dozen different personality traits that we all share, and maybe 2 of those dozen lend well to being a successful, disciplined trader that doesn't look at emotion, doesn't make these emotional errors. Well, let me tell you, I guess I'll blame it on my father. I was predisposed, genetically, to not have that, that clear focus and discipline, and not to run on emotion. And this was really the genesis of our AI auto trader, because what it does in essence is it removes all of these emotional trading errors. And it really allows us to build consistency by following the rules. These robots that I'm about to show you, they do not break the rules. They get into the trades where they've been optimized to enter at the most opportune moments when risk is at its lowest. So this is, let me lay a foundation. What I'm going to be showing you today is an automated strategy that runs on NinjaTrader 8. NinjaTrader 8 is now a free platform. You don't have to buy the platform any longer, and it's a very powerful futures trading platform. If you're in the United States, you can open an account with NinjaTrader Brokerage. And if you're outside of the US and you can't open an account with Ninja, then you would have two other options. You can go get with Interactive Brokers, who also supports NinjaTrader, or you can always open a prop account and not risk any of your own capital at all. So these are automated strategies that once they are enabled, they will execute and manage the trades for you. So we've narrowed it down to just two things that create trading success. Number one, we want to have the proper tool set that identifies risk and will get us into the highest probability entries. And ideally, we want software that can automatically get us in and out of trades to maximize our profits. And man, that would be great. Well, let me tell you something. We've got a trading system here that has really a lot of people excited. And I've got some brand new information. If you haven't seen this presentation before, we're integrating artificial intelligence. We're collaborating with really a world-renowned AI lab that's going to take this trading system to the next level. So stick around. I want you to see exactly how this system works. Now, I just want to go over the benefits of using an auto trader. If you don't have time to be in front of the charts, if you're working another job, I talk to, doctors and lawyers, truck drivers, nurses, they just don't have the time and the focus to be concentrating on their charts, waiting for an entry. So this is a perfect system to allow you to trade and have a supplement to your income. If you're on a fixed income, it'll supplement your income. And even if you have a full-time job, it'll absolutely supplement your income. So with this AI auto trader, there's no more overthinking or hesitating on a perfect trade setup. It's going to put your stops and your profit targets onto the trade automatically. There's no more cutting your winners short. There's no more mismanaging your trades. Listen, I'm the guiltiest party. I can't tell you how many times, that I see my P&L, start to go up in the green, and I just pull my stop up and squeeze that trade, and I just don't allow it to mature and continue up. I'll squeeze it too tight. It'll fake me out. It'll hit my stop and then continue in the direction I had the position. So there's no more mismanaging trades or over trading. This machine just doesn't make mistakes like that. So I just want to introduce you very quickly to a couple of our strategies that are in our portfolio. And we have a very diversified portfolio of strategies. The first strategy that I want to go over with you is our NASDAQ 2-minute data series. This runs on the NASDAQ futures. And if you're familiar, I know this is a stocks and options presentation, and I'm just kind of filling in last minute. But this system it trades the futures. So the NASDAQ futures, listen, I equate it to, trying to drive a Lamborghini or a Ferrari. It flies. It's a very exciting platform, a very exciting instrument to trade. And the retirement plan does trade a 2-minute data series, and it looks at momentum via our Laguerre oscillator. It also leverages the VWAP, and market internals is a key component to this trading system. Our purview really is our goal is to follow in the direction of the trend that the big institutions are creating. We're not trying to beat the large hedge funds and the institutional traders. We're trying to beat the other retail trader. We're trying to have an edge over other retail traders, and we want to follow along with the big institutional money. Well, how do we do that? Our market internals, we have a proprietary indicator. What it does is it looks at a disparity between uptick and downtick. And when it recognizes that there's more upticks than downticks, it signals us into a trade. And when the other conditions are met, the trade will fire off and manage it for you on your behalf. So the retirement plan, just from January 29th to February 8th, just the last couple of weeks, is up $2,678, $2,678. And that's over the last few weeks. A beautiful equity curve for that retirement plan. What's important to know is the retirement plan is risking 46 ticks to make 180. So you're looking at about a 4-to-1 risk to reward ratio. With a 4-to-1 risk to reward ratio, if we could just win half of our trades, we're going to be doing very well. And the system does win at least half. So at a 4-to-1 risk to reward, which is really, if you're a futures trader, which is really where we get killed, especially if we're cutting our winners short with those emotional errors that I mentioned at the beginning of the presentation. So with a 4-to-1 risk to reward, we're doing really quite well with the retirement plan. The next one that I want to introduce you to is our cash register, which runs on the ES 5-minute. The ES 5-minute strategy, we developed this strategy in collaboration excuse me, with Mr. David Wyse. David Wyse is our professional options traders. One of the core principles of his methodology is he looks at relative strength versus the SPY. So he's very well versed at trading the S&P 500 ETF. This strategy also looks at the market internals, VWAP, and momentum. And the profit target that we're going for with this strategy, we're looking to make 60 ticks and risking 20. So it's a 3-to-1 risk to reward ratio in our favor. Now, I want to just preface that these results that I'm going over now are all based on trading one contract. Okay, one contract on the E-minis, not the micros, but the E-minis. So trading one contract on the ES futures. From January 1st to February 8th, this system automatically trading one contract per trade is up over $4,300. $4,300. Okay. And you can see our equity curve on that, very consistent, very little drawdown. And the reason I'm showing a performance as I am, with the analysis showing a breakdown of each trading session, is because this isn't, these results are not a back test. I'm not trying to pull a smoke and mirrors show on you, a magic act. These are trades that were actually taken on a live market, on a live market. This is not a back test. These are actual trades taken on a live market. So the next strategy that I wanted to highlight is we call it our haymaker, and it's our haymaker for a good reason. It throws the knockout punch. It runs on a NASDAQ 30 range, and the hours that we run this, the strategy parameters allow us to optimize the hours that we trade it based on the results, and it also allows us to optimize all of the inputs and the ATM strategy, our trade management strategy, based on the market conditions. A little bit more about that in just a few moments. So the NASDAQ 30 range, we call it our haymaker. The reason being, the haymaker risks 40 ticks. 40 ticks on the NASDAQ futures, $5 a tick. We're risking 200 to make 200 ticks or $1,000. So we're risking 200 to make 1,000. All right, a 5-to-1 risk to reward ratio. And this strategy, like the retirement plan, two of our most successful and consistent profitable strategies are running on the NASDAQ with a tremendous risk to reward ratio leaned heavily in our favor. So the NQ 30 range, our haymaker strategy, and this will show you a chart. We've got a client, Leon. He's a truck driver in Massachusetts. And, the prop trading firms have kind of rushed onto the scene, and they've kind of opened the floodgates for traders, especially futures traders, to get into the game. It used to be you needed to be, rich or well off to have $20 or $30 or $1,000 sitting in your bank account to risk in order to trade the financial markets is all a thing of the past now. These prop firms for $30 or $35, you could buy a $50,000 evaluation account, and you've got a shot to pull money, extract money out of the financial markets. So old Leon, that truck driver, he told me, listen, I want to quit driving that truck and doing what I'm doing. He actually doesn't really want to, get out of truck driving. What he wants to do is not have to rely on it as his income. He feels spiritually his calling is to deliver food to the food banks from the church. So he takes the food from the food banks, delivers them to the churches, and spiritually it keeps him healthy and happy and active. So this system has allowed him to do that. The chart that I'm showing you, old Leon passed the $50,000 evaluation in one trading session in maybe 15 or 30 minutes. The system took a couple of these trades on the haymaker, first to the short side, then to the long side, and before you knew it, old Leon, got his $3,000 in profit for that session and passed his evaluation. So congratulations to Leon. So the performance from January 11th to February 8th, over the last month, this strategy alone has made $9,600, over $9,600 trading this haymaker strategy. Just on Friday, both the haymaker and the retirement plan took one trade and it was done for the day. Once it takes that winning trade, we're firm believers in capital preservation. That strategy is programmed to stop trading for the day. So at 9:30 a.m., when they get that big burst of momentum at that opening bell, a lot of days these strategies are done by 9:35 or 9:40. So from January 11th to February 8th, trading just one contract, risking $200 a trade, this strategy is up $9,631. Okay, so why are we having such success with our AI auto trader? That's the question that I want to answer. Listen, we have integrated some advanced technology into our trading system. The biggest knock on auto traders has been when market conditions change, they no longer work. They become stale. They'll do well for a week or 2 weeks or a month. And after that, they fizzle out and then they're garbage. You can toss them in the garbage can. They can no longer trade because the market conditions have changed. Well, guess what? We've found a solution to this. I mentioned earlier that we were collaborating with a world-renowned AI development lab. And what we've done is we've developed what we call a closed loop system. And what this closed loop system does is it continuously optimizes our inputs of our strategy based on current market conditions. Let me show you how it works. I mentioned at the top that I'm part of a talented team, and we've got a few developers with Charles and Sergio that have done just a remarkable job working with this AI lab. And what I'm showing you here is a diagram of how this closed loop system works, just to give you an understanding. I don't want to get too far into the minutia, but I do want you to have a clear understanding of what I'm talking about regarding the artificial intelligence and the closed loop system. The way it works is for every active strategy, for every active strategy that we have running, we attach to it what we call a drone strategy. The drone strategy runs in combination with our active strategy. So, for example, the Haymaker strategy is running in the background. It has a drone strategy running in the background. And they both take trades. The only ones that count, though, are the active strategy. The drone strategy is also taking trades. And what it's doing is it's looking at the maximum adverse excursion, how much heat we're taking on the trade, and the maximum forward excursion on a wider range. It's looking at a much bigger range than our actual trading strategy. And what it's doing, it's feeding that information into the database. Both the active strategy and the drone strategy are getting into the market, and they're feeding that information, that data, into our database or into your database that would be running on your local machine. And it's reading the data in the database, sharing it with the active strategy, and it's adjusting dynamically based on market conditions. Okay? So that drone strategy is optimizing the settings of our active strategy, and it's continuously doing it on every single trade that it takes. And it keeps running around in a circle, feeding it more and more data. And listen, today's trading, I heard Whiz just a minute or two ago. He mentioned Donald Trump would throw a tweet and Amazon, would go down and the market would react. It's a very news-driven market. The conditions change, on a minute-to-minute basis. And then the market is really good at these head fakes too. The bell will open, the market will drop, and then all of a sudden we're setting a new high by the end of the trading session. So those changes in market conditions that we're seeing with this news-driven market, this closed loop system, this technology is the future. And we're very happy and pleased to be able to be developing this with this world-renowned AI lab. So just to summarize, the benefits of this self-learning AI model is it provides our automation, our portfolio of strategies, the ability to adapt to changing market conditions. And as we accumulate more data, the model, what it does, this artificial intelligence, I spoke with Natalie, who's a representative of the AI lab. She told me that what it does is it starts recognizing patterns. And it starts forming biases, and it's looking for certain things because it knows when that happens that this is going to be the result. And the more and more data that this accumulates and runs through this system, the more accurate our output becomes. So it just gets stronger and stronger. So it's really, a complete change from the technology that we used to run and that mostly everybody else is still running, where it's good for a week or a month and market conditions change and then it goes south. Well, now on the flip side, the more and more this one runs and the more data that runs through it, the more accurate and precise it becomes, which is really the outlook that we were looking for. So, and then of course it lowers our risk. Listen, the number one goal is to make money, and this is going to make us more money, and that's the bottom line. So I want to get to my special offer because we've got some exciting things going on. We have, I always get some questions about the tech side of this. The tech side of this is really nothing to worry about. We have 3 professionals on our team that remote into your computer and set the entire thing up. The strategies, the chart templates, they're all just that. They're templates. All of the settings are pre-formatted and they load up, and the only thing left to do is to enable these strategies. However, our team of technicians will install the entire system for you. And on a daily basis, we're going to be running the system on YouTube Live every day, Monday through Friday. Join us on YouTube Live. Let me tell you, this system is a game changer, and we're so excited about it. And this goes into being transparent. Our transparency is really going to show Monday through Friday on YouTube Live. We're going to trade the system and the strategies on our YouTube channel at Right Line Trading. So if you decide to come aboard today, and I know that I have about 12 or 13 more minutes, and I'll probably be able to wrap up right on time, just getting to the end now. The special offer, and we always do something special here on Traders Corner. If you order today, you're also going to receive, it's a 2-module masterclass. The first module, it really breaks down the parameters of the strategy, just so you have a clear understanding of what each input is looking at. The second module goes into how to optimize it. Now listen, we know that this is only good for maybe 30 or 40% of the people that come aboard. Most people just want to set it up, enable it, and let it run. And that's what we're delivering. But we do have 30 or 40% of our members that like to get under the hood, and they like to tinker around with it, and they want to learn how to do it, or they want to trade it on an instrument or on a different time frame or whatever it might be. And those options are all available to you to be able to really build your own automated trading strategy. However, if that's not your cup of tea, we get it. We're going to deliver about 15 strategies that are fully optimized. So don't worry about that. So our special offer today here on Traders Corner is what we're going to include is both the discretionary and the automated systems. A lot of people ask me, well, what do you mean by discretionary? Discretionary, what I mean by that is discretionary system is one that you're going to make on a discretionary basis when to pull the trigger, when to take the trades. So we include all of our chart templates that have our full suite of indicators that really give you beautiful signals for entry. And on the discretionary component, it would be up to you whether or not to pull the trigger and take the trade. Now, we also are including our full automated system, our full portfolio of strategies. We have strategies on crude oil, gold, the Russell, the E-mini, the NASDAQ, soon ultra bonds, and we're diversifying our portfolio as to not to put all of our eggs in one basket, okay? So if you decide to come aboard today, you'll also be a member of our Discord chat group. We've got a beautiful server in Discord. Let me see if I can pull it over. Here in our channel, our AI Auto Trader, we have a general chat channel that all of our members can put in comments throughout the day. We have our resources channel where there's tutorials, there's videos, spreadsheets, all types of information in this resources channel. Our daily results channel. We have members as part of our community that all post their results. Listen, there's power in numbers. Don't be fooled. You know, a lot of people, they hear Discord and they think of, you know, a million messages coming through that, you know, don't mean anything. But what this does is it gives you in real time an indication of which strategies are working the best, and sometimes even more important, which strategies aren't working at all. You can avoid a landmine. So you'll be able to see in real time what our community of traders are getting for their results. So we also have problems and solutions. If you're having a tech support issue, we've got Charles and Sergio, myself. We're going to drop what we're doing and get you back up and running if you're running into a technical issue. And all of these different channels, that the strategy optimization and a hall of fame. So we have a number of different channels. You'll be part of a community of traders in our Discord chat group. All additional markets. Listen, we're going to be releasing a number of new strategies with this new AI integration. We're able to optimize them in real time, and it's really shortened the curve as to when we release these additional markets. So all additional markets will also be included. And I mentioned the software installation. So the pricing is for coupon code SAVE $200. And I'm going to put a link in the chat box to our special offer. And if you use coupon code SAVE $200, it's going to drop the price from $6.99 to $4.99 a month. And listen, I've had, you know, traders say to me, hey, $4.99 a month, you know, that's kind of steep. Well, listen, you know, it's to put things in perspective. You know, Leon, that old truck driver out in Massachusetts, he made $3,000 in 15 minutes. You know, he was very happy to pay the $4.99 a month. So, you know, listen, this has the potential to really run up the score very quickly. For the quarterly option, which is 3 months, of course, if you use coupon code SAVE $500, it's going to bring your quarterly. Let me put this in the chat box. Okay, I just put my special offer in the chat box. It's going to bring your quarterly subscription down to $9.99, or it breaks down to $3.33 per month. $3.33 per month. And then our best value is going to be the annual. With coupon code SAVE 50%, it's going to give you a 50% discount. It's going to take it from $33.99 a year to $16.99 a year. And just to give it a perspective of what that breaks down to per month, if we take the $16.99 and divide it by 12 months, it's going to break down to about $140 per month. So for about $140 a month, you're going to get the full system, all future markets, and all ongoing billing is going to be locked into that 50% discount. Now, let me tell you, I mentioned that this AI component, the integration is actually going to be released next week, this coming week. So the company's putting a lot of resources and time into this. And listen, if you've ever seen rate line trading, really the future of our company, on the futures side, we have two main equity streams, one being futures, one being options. for the future side, this is the future of right line trading. And we believe it's the future of trading. And we're pouring a ton of resources into it. The pricing is going to go up. This is kind of the last chance to get in at this lower pricing point. Once that new release comes out next week, the price will go up, just to give you a forewarning. And I'm not saying it as a salesman, I'm saying it as a friend. It's a fact. So get in now when it's $140 a month instead of a lot more. For those of you who just don't like subscriptions, we also have a lifetime membership, which again, right now is the best time to do it. You can own the entire system on a lifetime license for $39.99. $39.99, that pays a lifetime license for everything. Any future updates, add-on markets, tech support, ongoing maintenance, everything is included. And I just want to wrap up with, not to thank you, my presentation's been, I don't know why, it's just been going a little weird. Let me close some of these browsers. What I wanted to show you, because I alluded to it just a few minutes ago, and I just have a few minutes left. We're going to be on YouTube Live Monday through Friday. You don't see any other companies really doing this. And, you know, Mark Miller, who's the owner of the company, he's an Army veteran. Really, the core military values, transparency, honesty, and really good old-fashioned hard work. But I wanted to highlight the transparency. You can go to our YouTube channel on Monday. You're going to be able to see our AI Auto Trader. We're going to have 3 or 4 strategies running simultaneously on one workspace with the P&L in real time, and you'll be able to see in real time for free the potential that this trading system has, because it's really, you know, it's a mind-blowing system, and it really is, we believe, the future of our trading system. Hey, Dennis. I guess Dennis doesn't like truckers. Okay, no problem. Yes, you can trade micros. If you wanted to trade just micro contracts, the account size, to trade micros, listen, you could start an account with as little as $2,500 and trade micros with this system. If you wanted to trade the regular E-minis and you want to trade the full portfolio of strategies, then we recommend an account size of about $7,500 to $10,000. Okay. Well, I think that's about all of the questions I have for now. So listen, I really, I kind of got, you know, this opportunity at the last minute, and I wanted to first thank Rob for the opportunity to jump in. I guess the gentleman, Andrew Keene of Alpha Shark, was having some tech issues, but I do see the next presenter. So thank you, Rob, and I want to thank everybody here in attendance, and I want to wish you a very happy Super Bowl Sunday. Go 49ers.
Hey, don't you be biased on teams over there, Mr. Powers. Rory, I want to thank you from the bottom of my heart for being on call to fill in for a presenter that was having tech difficulties. And, you know, your strategies look amazing. We've been hearing about your automated strategy and how it's been crushing it lately. And the examples you gave absolutely prove that. You know, big congratulations to you and your team over at Right Line Trading on the new self-learning technology. Ladies and gentlemen, if you struggle with human error, over trading, inconsistent results, blowing up your live or prop accounts, Mr. Powers over at Right Line Trading has a solution for you. You can learn more by clicking on the link in the chat box below. Thank you again, Rory, for making a generous offer to our audience and for filling in for someone with tech difficulties. We wish you a great weekend, and we are unfortunately rooting the other way.
Thanks again, Rob. God bless. Have a great weekend.
Have a great weekend. Good luck this weekend.
Uh-huh.
Ladies and gentlemen, we're just getting warmed up over here on Traders Corners for our stocks and options special. So stick around because the information gets better and better. Our next presenter started his trading in 2006, trading firm money while attending the University for Finance and Math. After that, he became completely hooked on trading the market, working for hedge funds, prop firms, technology companies, and individual traders even. As a chartered market technician, he uses technical knowledge in combinations with years of quantitative and algorithmic trading to combine the best of these two worlds to create a unique trading style. Here to present the art of pullback trading, two proven methods to enhance your approach, is Mr. Michael Nauss of Trade Ideas. Welcome back to Traders Corner, Michael. And there we go. Got you promoted to presenter already.
Awesome. Well, thank you very much for having me. Hope all
No
this
problem.
is-
Thank you for being here and on time.
Oh, as always. If you're not early, you're late. That's what my dad always yelled at me about. So
Hey, coffee's for closers.
exactly. So I'm just getting everything set up here. Preferences.
Hey, Mike, you want me to give you the
Apologies, just
extra
one
plug
second.
that I like to?
Sure, I'll take any plug you got. How about that?
Ladies and gentlemen, Michael came up with a strategy or a tip that changed the strategy I use. He talks about RSI sometimes and buying things that are oversold and selling things that are overbought, and how the amount of the move does not always leave you in a profitable state. And the tip he gave on this show that really increased my profitability was buy things that fail to get oversold. And, it puts them in strong uptrends. And I thank him publicly for giving that tip. It has really improved my profitability.
Oh, well, I greatly appreciate that. And if I have time when I'm showing off the platform later, I'll show that scan as well, because that's again one of my favorites as well. So again, I greatly appreciate that. Now,
Hey, no
today,
problem. When good tips are given out, I like to make sure everyone gets them. That's makes our quality show.
I will also thank the chartered market technician and my good friend JC Pretz at All Star Charts, because I kind of got that from him. So I should pass the credit down, I guess. Okay, so again, thank you everyone for coming by. Today we're going to talk about pullback trading. So what I always try to do with my presentations, lessons, webinars, is to make sure that there is a certain percent of it, hopefully a good percentage, that will be purely educational, regardless of whether you want to check out trade ideas after the fact. This is going to apply to your trading, whether you're a Forex trader, a futures trader, intraday, daily, whatever it is. My hope is that the first part of this, I'm going to just show you some basic ideas. And then for the second part of it, I'm going to go into Trade Ideas, which is the software we're talking about today, and show you where we have these scans. And then with any extra time, we will go through it. I have my question panels open. So if you ask questions as we go, we can make this as interactive as you guys would like. So first of all, who am I? It's a good place to always start. Who's this bearded man in the middle of the woods chatting with you guys? My name is Michael Nauss. I'm a chartered market technician and a chartered alternative investment analyst. Basically just means I've stared at charts for long periods of time. I started trading back in 2006 when I was trading on the floor of a prop firm. Now, these were the old school prop firms. They don't really exist too much anymore, but not the prop firms today where you go and you pay up money. They basically would just hire young kids and teach them how to trade and then split the profits with them. That was the idea behind that. So that's how I actually started my trading career, where I wanted to learn by doing, which I always think is a good idea. So I went through and again took this experience, traded there for a number of years until basically the hedged or the prop firm had troubles, because this was all way before HFT trading. So that's basically what we were at the time. We were the HFT traders. We bought and we sold I think my record was 450 trades in a day. It was a wild experience and very profitable at the time. But as like anything with trading, as edges get worked out of the markets, it's time to move on. So I moved on to the hedge fund space, where I worked in hedge fund administration for 10 years. This was around the Bernie Madoff time, so people would come to us and say, hey, I don't trust anyone anymore, so I am interested in investing in XYZ hedge fund. I want to send you guys down to take a look at and see, hey, what are they doing? Is it legitimate? And then what are my risks as a investor? You know, I have XYZ investment. Is this something that's going to correlate with that investment or not? So long story short, that gave me a really great time looking at what different hedge funds did, spending a lot of time studying all of the variation of hedge fund out there and what they're trying to make money off of. And now I consult with Trade Ideas, which is a company that's basically trying to take this hedge fund technology and distill it down to what the retail trader needs to know, and giving you guys trading strategies that you can do yourself for a way more reasonable price than, you know, a hedge fund manager would pay something like a Bloomberg or something like that. So that is myself. Obviously, all through this time when I was working with the hedge funds and now work with Trade Ideas, I trade. I again started trading for a living, and now I trade while I work with these other things, again focusing more on that kind of swing or longer term time frame, because it's just better suited to my personality. So we are going to talk about how to nail the pullbacks in trends. But first, as always, I want to prove to you some things. I just don't want to sit here and say, hey, do this because it makes sense. So as always, I like to give a lot of data and studies showing that this is something that would make perfect sense. So here's just a definition. We always got to get those out of the way. Definition of trend trading is basically we're buying something that's either going up or selling something that's going down. We are trading with the trend. And there's my Microsoft Paint illustration of essentially what an uptrend is. Loosely defined and simply defined, you have higher highs and then you have higher lows, and that's how we are going to define a trend. Anything that's making higher highs and higher lows, it's in an uptrend. Anything that's making lower highs and lower lows in a downtrend, and of course this will vary based off your time frame. But so when I say trend, that's what I'm talking about. Here's a very basic example. I've picked on this one a few times. I think when I've been here, because the last time I was here, well, one of the times I was here was right around this area. Another time was right around this area. And then now we're up. This is I guess a discount makeup provider. The idea is, the reason I picked this one is because super clear trend, right? From May until now, you've got like a 10x return, and any time throughout this, if you had a trend pullback type of strategy that could even get you anywhere close to the bottom of these trends, you're a happy man. If you were ever trying to fade this, because a lot of people like to fall for that buy high, sell low thing, that's been problematic for you. So why trade with the trend? Looking to, again, let's prove why we're going to trade with the trend. I gave you one example. Anyone should kind of ignore that, and let's actually look at some data here. So this is a great study that you're more than welcome to read. It was called A Century of Evidence of Trend Following. Great study that was done out there, essentially looking at 100 years of price data and saying what happens if we are going to follow the trend, what happens if we are going to fade a trend, which of these are beneficial to us, because as long as we can have statistics on our side, we can feel confident that we are moving in the right directions. So simply put, is it L? Let's do this one. The study looked at, again, these 100 years of return and looked at the 60-40 portfolio. And for these 100 years, these were the stats of the 60-40 portfolio. 4.1% average return, annualized volatility of 10%. That just means throughout the year, you're going to get 10% up, 10% down on average. Max drawdown of 62%. Sharp ratio, that's just stats for nerd. Higher, the better for that one. And they said, okay, what if you just took that portfolio and 80% of it, you did the same thing, the 60-40 portfolio, and 20% of it, you put in a momentum strategy. And their idea of momentum strategy was simply buying 52-week highs and selling 52-week lows, some variation of that. But the study, the actual particulars doesn't actually matter. You can see we have a higher increased gain, a lower increased volatility, a lower max drawdown, and a higher Sharpe ratio, which again is just a measure of risk-adjusted return. So everything just got better the moment some amount of trend following was introduced to this portfolio or some kind of trading. This is basically the chart of outperformance, of applying that, of rebalancing that 20%. You can see every time they got higher, they would rebalance. They would basically liquidate the 20% that was making money and they'd put it in the 60-40 portfolio. That's how they kept it balanced into that 20%. Again, 1880. So we're talking a big, big study here. Oh, a little drawing tool. But this chart, this chart is the most interesting to me. So this is the 60-40 portfolio. And for those who don't know, that just basically means 60% of your portfolio is in the stock market, generally the S&P 500, and 40% of your portfolio is in bonds, generally TLT, kind of short-term treasuries. And this is the performance of trend following in these massive events that all occurred in this 100-year time horizon in which they looked at it, right? 1893, the panic 1893, you can see the 60-40 portfolio. I think it was a 25% drawdown, but your trend following makes a little bit of money. This is where the hedge of this comes in. Panic of 1907, same thing. You'll notice in these cases, pretty much, except the recession and the 1987 crash, in all of these cases, the trend following aspect of a portfolio saved your bacon where everything else kind of fell apart, right? So again, just more evidence that, hey, we should look at some sort of trend following strategy. Now, this is another study that I did myself going back until 1993 and just took the very simple 10-month moving average strategy. It's a very simple strategy that a lot of IRAs and investment advisors employ. The idea is if the S&P 500 is under its 10-month moving average and closes under it on a monthly basis, you're in cash. If it's above it, you're in the S&P 500, and that's the blue line that's shaded, and then the gray line is just the performance of the S&P 500. The idea is that these flat periods of time right here save you as the entire market is falling apart. So from the dot-com bubble, you're in cash while everyone else is having a bad time. 2008, you're in cash while everyone else is having a bad time. And then a couple other times periodically throughout the year. So the return is actually a little bit less. It's not as good as the S&P 500, but the idea is that it saves these volatility of return. So again, more evidence that that trend following is the move. Here's another study done by a company called Blackstar, where they took an idea and they said, hey, we're just going to buy new all-time highs. We're going to put a 10 ATR trailing stop on that. So just saying I'm going to buy an all-time highs. I'm going to put a trailing stop behind that. I'm just going to let it go. And then we're going to compare that to the S&P 500, blue line being the Blackstar funds, and then the pink line being the S&P 500. So they also found that buying new highs and then having some sort of trailing stop method so that when that trend changed, they were out, produced great results, again, compared to the overall market. And then here's just some trades that came from it. The next slide will show why these are very important. So let's go back. So EMC, again, up in the top here, or top left, you can see I think this went from $2 to 100. Taser went from, I think, $1 to 30. Again, all of these are amazing trades, and you can tell just by riding out this trend, you're going to be better than people who are generally trying to pick tops and bottoms. But this next slide, I think, is the most important of this Blackstar fund. And these are a lot of companies that you may know. So this is WorldCom, right? The same trend following method, just got them out right around here. As soon as the trend reverses, it's time to go. And we'll have some studies and some ideas when we go into trade ideas on how to do that. But the idea is that trend following works on the way up, and then it saves your bacon on the way down. This is at JDSU. I remember this personally. I think it went bankrupt around the time that I was looking at. Sun Microsystems, same thing, and then Enron. You'll also notice that none of the banks that have blown up and gone under, because I know we had one recently, none of them have been in uptrends. So it's very easy. I don't think there's ever been a single bank that's gone under that has ever been in an uptrend. So why? Why does trend following work? I hope that's enough studies. There's many more. I can send them to you if you want, that talk about how trend following outperforms buying low and selling high and doing things like that. But I hope I've given you enough evidence to at least go, okay, maybe Michael's onto something here. Maybe we should look for some sort of trend following strategy. Some people like to know the why trend following works. Again, we'll never know for sure the why behind why someone buys a stock and why someone sells a stock, but we can guess, right? And one is this delayed aspect of news, right? And this is an old, I think, it's the New York Post, or I don't know. It's one of those, I'm Canadian, so I don't know, one of those magazines that are about Wall Street. And, you know, the meme is just the guy saying, hey, this company could really excel. And then by the time it gets to the mass, it sells. And the idea is that there's a lag effect behind when news happens and when the market can disseminate the news and then act on it. I think the best example of that right now is NVIDIA. It was a year and a bit ago when ChatGPT was launched, and everyone looked at that and went, wow, this is crazy. And NVIDIA is definitely going to be the one to capitalize off this because they're selling the GPUs, the picks and shovels of it. And it's still going. It's just been a breakout after breakout, crazy after crazy. So picking something like that and using some sort of trend following methodology, that makes perfect sense. Again, this lag aspect of news. Also confirmation bias, and this is a big one as well, where I put some funny examples there where confirmation bias can hurt us. You like think of flat earthers and people who are still thinking. If you want to laugh, you go to Twitter and search for Bed Bath & Beyond. There's still a group of people who think they're going to make money off it. The idea is that people will continue to reinforce existing beliefs. Back to the NVIDIA example of every time anything cool happens with AI over the next number of years, you could expect some move in NVIDIA because of it, because people have this bias of NVIDIA is going to be the one to make money. Even if there are competitors at Rise, things like this, you're still going to get this move as this self-feeding prophecy, I think helps a huge amount. So there's two ways. So we have some idea that trends work. I've showed you that. We have some idea why trends work. Now we're going to talk about the two ways to trade trends. And maybe in the next one, I'll talk about these breakouts because they're just as a valid way to trade trends. I just want to focus on these pullbacks and talk about scans within this pullback as well. Yeah, I see people talking about SMCI and the same kind of thing, right? So one way to trade trend is just a breakout. So there's my Microsoft Paint drawing that I did earlier. And here's just how a lot of people approach breakouts. Nothing wrong with it. Just I'm going to wait for a new high in a trend and I'm going to buy that. Again, there's nothing wrong with it, but as I'll go all over, there's pros and cons to both these. The other one's a pullback. It's to try to wait for the stock that has reached a level that you believe could act as support. And when that pullback occurs, you're there as a buyer. And that's pretty much it, right? Everything is going to be a variation or a nuance of one of those two things, but you're either buying the breakout or you're buying the pullback in some variation up, right? So what are the pros and cons of both? So the pros and cons of breakout trading, and the reason why I think it's so popular, is it's simple. You know, you say, okay, what was it, 500 on NVIDIA was a big deal. So, hey, this thing's obviously in an uptrend. I learned from Michael and maybe read some of my own studies, and I know that I should buy things that are in uptrends because that will serve me in the long run. And NVIDIA had this really, we can go to the chart, but it had this really consistent level at 500. So if we break that, then that's a simple trade. I don't have to think too much about it. I need to go. And it's easy to identify the trend direction because if I'm buying breakouts, I'm necessarily buying in the direction of the trend. You're trading with the short-term momentum. So you're trading with the long-term trend and you're trading with the short-term momentum, and you have generally great risk reward ideas on this, because if they go something like NVIDIA, which is up 50% from that $500 breakout, that's a great risk reward if you use that level to play off of. What are the cons, right? Why doesn't everyone just trade breakout? Well, breakouts, as anyone who's traded them for any length of time, have a low win rate, and they just will, and that's kind of the nature of it. So a low win rate is not a bad thing. So I want to stress that I'm not saying that you should trade pullbacks because they're better than breakouts. I'm just presenting to you a different style. Low win rate's not a bad thing. Some of the most successful hedge funds on planet Earth, I can tell you, have sub 50-50 win rates. But like with that chart of ELF I showed you earlier, or something like NVIDIA, if you run the math in your head, you don't need a high win rate if, when you're right, you're going to make 10 times what you're going to risk when you're wrong. You only need to be right 10% of the time in that case to break even. So this low win rate, it's trying on our patience personally as traders, and some people might not like that, but that's the nature of it. And anyone who goes, oh no, we're the ones who will tell you which breakouts will pass or fail, doesn't happen, right? It's just the nature of it. Again, not a bad thing. Overall, if it makes you money, it's great, but breakouts have a historic low win rate when studied. And then diligent risk management is certainly required because of this low win rate. If you're not the one who can hold for that insane runner, if you're someone who finds yourself taking profits really quickly, then a strategy like breakouts with a low win rate is not for you, because you have to do this risk management because of the low win rate. That risk management sector will be the only thing that will make you money in the long run. Then I put fills can be hard, right? Because if you're buying something as it's breaking out, unless you're very fast, if we're talking slower intraday trading, or you're just not at your screen, or it gaps through, there's a lot of things, because when you're buying with that short-term momentum, you're basically buying at the same time everyone else is buying. And again, that can be hard to get a good fill. So then what's the pros and cons of pullbacks? So pullbacks will have even tighter stops than looking at the breakout, because you're picking an area, you're saying this is the pullback area. I've got some examples of how. So any move below that, you're out. You have a longer time to plan that trade because you're picking your area and saying, hey, if it pulls back into the zone, that's what I'm going to execute, and you'll get less slippage, which basically just means getting your price is a lot easier because, again, you're buying versus that short-term momentum. So the biggest con with pullback trading is some stocks don't pull back. And it's just one of those. There's the nature of breakout trading is you're going to buy a lot of breakouts that are going to just fail and move back. There's nothing you can do about it. And with pullback trading, you're going to look at something and you're going to look for it to pull back, and it's never going to pull back, right? Like, people are desperately waiting on the S&P 500 and the Qs to pull back right now. And the fact that there's so many people waiting for a pullback makes me think that there may not be a pullback. So you just have to be careful about that. And you are trading with the long-term trend, but you are trading against the short-term trend because you are buying pullback. So pullback tradings, how are we going to do this? We talked about pros and cons. We're going to focus on the pullback trading for this one, and I'm going to show you some stuff around trade ideas, how you could do either of these if you want it, but we're going to focus on the pullback trading. So first, you have to define a trend. Now, that's going to be different for everybody based off of, generally speaking, their time frame. The stock could have gotten absolutely hammered on the daily chart, but if you're an intraday trader, a uptrend to you might be on the 5-minute chart, that consecutive higher highs and higher lows. If you're an investor, you know, you're probably going to be looking at weekly higher highs and higher lows. So again, time frame is everything in this game. A buddy of mine on Twitter always says we could solve 90% of all Twitter fights if everyone just stated their time frame before they stated a position on the security. There are some people right now that are bearish stocks because they think we need to pull back for a week, and I think that's a perfectly reasonable argument. But then a bull may come in and say, well, what are you talking about? This is an insane bull market we're having in stocks right now. Just, again, different time frame. So we need to find what a pullback means. Where are we going to look for a pullback? Where are we going to buy a pullback if and when it occurs? And that's it. That's the whole kind of process here, right? Because if we're in a trend and we like the trend for whatever reason, we define a couple places that we'd be interested in a pullback in that trend. We buy the pullback in that trend. It either continues on up and we're good, or it stops us out. We move on to the next one. So there's two pullbacks that I'm going to talk about, and then I'm going to show how we can find and trade ideas, and then walk you guys around the rest of the system and do a lot of that one as well. So yes, I see Robin saying the turtle traders were breakout traders. Jerry Parker is a very great follow on Twitter, who is one of the ex-turtle traders, and all he does is this incredibly low win rate breakout strategy, and does very, 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 very well for himself. I think he may be a billionaire at this point. So we're talking about VWAP pullbacks is one way to do it, which is a good friend of mine who has popularized a drinking buddy, and Brian Shannon. And if you don't have his book, I don't have it around me, or I'd hold it up. He wrote a book about anchored VWAP, and I'm in it as a thank you, which just a little brag there, but yeah, a very good book. It's maximizing trading gains with anchored VWAP, and these anchored VWAP strategies we have in trade ideas, we actually build in conjunction with Brian Shannon, and you can check these out. So VWAP just stands for volume weighted average price, and ideally it is just a regular moving average that essentially incorporates volume anchored to a certain point. So why do people use the 200-day moving average? It's a question I get all the time, because it roughly is a year of trading. Now there's 252 trading days roughly in a year, depending on holidays and weekends, stuff like that. But when people started calculating these moving averages, they were doing it by hand with a pen and paper. A lot easier to divide the price last 200 days by 200 than 252. That's the reason people use the 200-day moving average. It's the reason why people use the 10-day moving averages, because the calculation for that is incredibly simple. Problem with that is it weights all of the 10 periods for the 10-day moving average completely equally, whether it's going to be a very important day or not very important day. So a VWAP throws volume in there. So a high volume day is going to be way more important than a low volume day. And again, this is my buddy Brian Shannon talking about anchored VWAP here, and basically said Ken Griffin, who is the top hedge fund earner ever, he's a market maker. So conspiracy theories aside, he buys and sells securities based off of to try to make a market. So when your order flow gets sold, he fills that order on the other side and tries to scalp out a cent here or there in order to take that profit. And they are in the business of filling large orders, and he does so with anchored VWAP. So anchored VWAP is essentially just taking a VWAP that we just talked about and anchoring it to a certain point. So if I am a massive RIA and I need you to buy me 10 million shares of this security, and the security only trades 500,000 shares a day. Well, what you can't do is just go to the market and hit buy. That's something we can do as retail traders, and this is our edge over the institutions, is we can be in, and then if we're wrong, we can be right out immediately. These guys can't. It takes them a long time to get into a position, takes them a long time to get out of a position. So I'm going to just hand that $10 million or 10 million share order over to a market maker. And how do I judge whether that market maker did a good job? Like, I have no idea, if he got me a good price or a bad price. So generally what they'll do is they'll say, okay, I want you to get me near the VWAP for a month. Say it will be a month it will take to fill that order. Or let's say I want to buy this stock because they had a good earnings report. So what I'll do is I will take the VWAP from that earnings report and I will give this order over to a market maker and I'll say, if you get me around this VWAP's price by the time you're filled, that's good. If you get me way above it, then you're doing a horrible job. And why would I pay you? Right? And a lot of hedge fund and a lot of execution brokers will actually have some sort of incentive structure on how close they got to VWAP. So what will happen often is you'll see VWAP acts as support and resistance, because if something pulls into a major VWAP and there's a fund there waiting to fill a large buy order, and they know if they get close to that VWAP price, then they're going to make money, they'll start buying when it gets there. And then when it gets too far above, they'll stop because they want to get in some area of that VWAP. That's the idea. Sorry, I had to sneeze there. I had to move away from the mic so I didn't scare anyone. So anchored VWAP pullback. Basic scan that we have in trade ideas, not only will it find stocks pulling back to an anchored VWAP from a major swing low level, in this case we've got a bunch of others, but it will draw it for you. So you click on the scan, it will draw that anchored VWAP for you, and you see if it's something that's interesting. So I really like these when I'm trying to buy reversals in downtrends. So AES here is a it's a utility power delivery company. Utilities got hammered recently because of the whole dividend arbitrage type thing. But instead of buying this thing, just guessing when it's going to come up, I'm going to look and I'm going to watch this anchored VWAP, because if there's a large institution that's looking to get into this, their target might be the anchored VWAP from this low. So as we come into this and I see that we're down here now, for me, I'm watching this one next week, and we'll go over some more names into this anchored VWAP low. I'm wrong if it breaks below. It's one thing I love about pullback trading. I've got a nice area here that for a week or so has acted as support. So if it continues to act as support, then I got a good level to play off of. This would be a pullback in this uptrend for my time frame. I'm a shorter term swing trader. This may still be considered a downtrend depending on your time frame. Another one is an anchored VWAP from a large gap. So there was an earnings gap on this GIII right here, and our system will just anchor a VWAP to right before it. Again, the same example I gave. If a company's like, hey, I'm really interested in this stock, I want you to get me this price, you can see kind of the support and the above and below that happened right here after that large gap. And when it broke out, had a good trade, pulls back right into, almost to the tick, into that anchored VWAP, and then bounces. So as a pullback trade, this is a good area to potentially take a shot at. And we have anchored VWAPs from, just takes a second here, a major event. So some sort of, this was also a, I don't know if it was an earnings report or something happened in pins, and I want you to look at the volume that occurred down here. Down here at the bottom, look at this volume, big volume spike right there. And then we have that candle. So we draw the anchored VWAP from that massive volume candle. And after this earnings report, when this bad news came in from pins, look at where it stopped, went right to a tick on that anchored VWAP. Obviously won't always work that good, but hey, I'll take it. Means Pinterest, if we're holding this area into next week, again, I like to look at that one. So that's an anchored VWAP pullback. It can be kind of hard if you're doing this without a system like Trade Ideas that will A, find these for you, and B, draw the anchored VWAP for you. But those are just 3 examples of places that you can draw anchored VWAPs. Big gaps, major turning points, and high volume events. For more, obviously, read the book from Brian Shannon. The other one here is polarity. So this is taught in the CMT. My personal favorite setup on earth is this polarity. It's when prior resistance acts as support. The way that we know that this will work is simply if we go ahead in future and we say, hey, there was a whole bunch of sellers at this zone right here. this high zone right here, that probably means that the second time it got here, you probably had a bunch of people shorting right here and a bunch of people selling their long positions. And it gets there again, you have a lot of people shorting and a lot of people selling their long positions. But then when it breaks through, you have all of those shorts that are underwater. You have all of those longs that I've probably sold right here, but didn't matter because it broke right through. So when we get back to that price, now you have those shorts that were very underwater coming back to even. They're going to look to buy. Then you have those longs that sold right at that area, seeing a second chance to get in. That's the psychology behind these polarity plays. Again, work until the end of time. I love them. Here's one that I actually had on when I did this presentation prior for Ralph Lauren, and I was talking about how much I liked it. And that's the chart right now. So that's the same chart, just kind of blown up with the same drawings in place. I got involved in this area right here. I got out most of my position when we were back to those all-time highs because I don't like carrying much through earnings. I've got burned too many times to do that, and earnings worked phenomenally on this one. So I just like that example because I showed it before. So this TPH, same thing. And again, we can scan for these in real time for you with trade ideas. The idea is that's prior high that I have the first arrow at. That is an area of resistance. And then we finally get through that area of resistance and we come back and we can see so far, this is holding as an area of support. So if this one can continue, again, I like the look of it because if I get a solid close below that area of support, I know it's time to go. This is what I love, absolutely love about these setups, is a lot of the guesswork is gone. So this is TFC. This was a regional bank, and they fell apart during this whole regional bank thing. And you can see a pullback here, and then a big area of resistance, call it, I think it's like 36 bucks, give or take. We broke that, and now we've come down and tested 36 bucks twice. So if we start to move off that level, then again, that's just a nice, simple trade. Long, if we move off the level, stop under this $36 a share, take that trade and move on. So I have another link I'm going to share with you in the chat, so ignore that link, but you can find me everywhere under the sun just using Michael Nauss CMT, a Substack that I write. I've got YouTube and Twitter and TikTok. Don't worry, with TikTok, you will not have to see me dance. But yeah, let's do this. I'm going to paste this, and this is going to go to all entire audience. So in the chat there, I just pasted a link. Let's just shrink that. And shrink that too. Get into trade ideas. So that link will take you. Let's open another tab to this page right here, which is a little bit about me. Right here, you can use Stats Edge to save yourself 15% off trade ideas. And then also, if you want to click right here, you can sign up for our Portfolio Master Challenge. We are doing trading competitions on the regular, where we are, you enter, you paper trade. If you win, we'll just send you money. And these things are so much fun. So the 27th to 29th, you can check that out. Again, I have a lot of fun with these things. I end up interviewing the winner. It's always a good time. And you can win some cash. And a lot of people, what they're doing with this is they are basically trying out new strategies. So for this time, you can only short the market. It's the only, you're not allowed to buy securities. You can only short them. And $2,400 grand prize. So you can go check that out if you go to that link, which is just trade-ideas.com/Nauss, my last name. All right, so I have a little bit of time, I think, but not a whole lot of time. So we're going to go through the system relatively quickly as well, where I'm going to show you a fraction of what Trade Ideas does. So I'm going to show you what I talked about, but I just want to let you know that so what I'm going to talk about is, I think, like 3 or 4 scans. You probably just the scans that we built that you don't need to edit, there's probably well over 100. And then if you want to build your own scans, there is a literal infinite amount of scans, all the way from a weekly long-term time frames to intraday scalping, wherever you exist. It's just, it'd be really boring if I just sat here and said, hey, look at all the things we can do, it's great. So I try to do some teaching, and then we're going to show and we're going to scan through some of these as well, right? So right off the bat, right, this is just my layout that I look at most of the time. We got a chart. We call this a picture-in-picture chart. So down here is a weekly chart, where up here is a daily chart, and as I switch through, both will change. This is a good way to keep an eye on the higher time frame and the lower time frame at the same time. And this is just my heat map that shows me all of the sectors, what's up on the day, what's down on the day, what's moving. This tan, actually, if we go to here in the weekly chart, is really interesting. I actually bought a little bit on Friday, just buying the support zone because of what I saw there looking at that scan. And again, this is something that I can customize to my heart's content, and so can you guys. But let's get into the scan here, and let's actually start with support and resistance. So these are pre-built scans for you. Like, you don't have to do anything at all. You just go in, you click on them, we'll look up support and resistance. You can see we have everything from 1 minute to weekly charts, but let's do a retest of the breakout, and we'll click on that. This scan will update every 30 seconds in real time. So just, and I end questions as we go. Again, I think I only have 5 minutes if I have my timing right, so I'll try to get everything done. But the question is, does Trade Ideas integrate with Thinkorswim? You can have it so that when you click on a Trade Ideas scan like that, it will populate your Thinkorswim chart. If that's what you're after, we can certainly do that. So this particular scan, this is what we talked about before, but you can see that all of these scans will meet this setup to some respect. There's that TPH I talked about right on the scan right here. So I can click on that. I can go to form, and we can see what's going on there. There's an area right here, this prior breakout zone, you can see is now acting. Let's draw that over. You can see that's now acting as support a few times here. And a nice push off that. That one may have been missed, but it's good that it's there to show us. And all I'm doing is I'm hitting down on my keyboard and then just looking for whichever one kind of strikes my fancy the most. And again, that's what we end up doing. If you want to, from there, just show you quickly, say I want to buy this AB on Monday, I can just click the buy button, I can click on the chart, and it will send an order to the market's closed right now, but it will send an order either to our simulator. If you're trying a new strategy, or maybe you're not a profitable trader yet, we highly suggest trading on the simulator. And then when you're caught up and you've got a trading strategy and you have the one the way you like, it can actually send the order in the same way to Interactive Brokers or E-Trade directly from the platform. You can do some funny things like, hey, I wanted to put the stop under the 200-day moving average, and I want it to risk, $1,000 on any given trade, and it will just do all that for you, right? That's the benefit of what we're doing here, is trying to simplify the whole trading process. And again, I'm just drawing in these polarity lines for you. You can notice that all of these are going to be in uptrends. Again, for my time frame, maybe not for you, but again, breakout, pull back to the breakout, looks like it's finding support there. And then from here, say you find one, let's look at one that maybe we'll like, CCEP. You don't have to leave the platform to do all your research. Let me just click on this tab above right here, and we can take a look, and this is what this company does. So Coca-Cola, Euro Pacific Partners, we know what Coca-Cola does. I don't have to read all this, but a couple things. So we have all the fundamental data in the world in the top right segment. I only have some things here, but for you fundamental guys, you can do whatever it is you want when it comes to cash or earnings, or again, I'm a CMT, I don't know much about this, but earnings per share, all of the accounting ratios, you can do that if you're looking for certain profitability metrics in companies. Down below here, we have what the company does, what sector it's in, all of that. In the upper right, we have all of the different names or all the news items. So it just scans all of the news sites out there for financial news, and it will tell you what's coming up. And then in the bottom, if you want to check out some of their competitors, say you like the trend in CCEP, but you want to look at competitors, you see the top one up here. If we click on it, that's PepsiCo, right? So you can then look at the competitors charts if you want to look around. So that's that one. And then I'm going to quickly, because I think I only have about a minute here, let's pull back and let's take a look at, I don't know, let's do one I didn't talk about, IPO. We'll go to a weekly chart. So this is the anchored VWAP module that, again, we built in conjunction with Brian Shannon. I see a question about an added cost. It's yes, because we have used Brian Shannon's mind and IP there. So that's an extra cost that we share with him. But you can see this purple line right here is the anchored VWAP. And as I click through these, it's drawing these in it. Now, these are looking for stocks that are near the anchored VWAP from an IPO, which is a different strategy than the one that I talked about. However, is a strategy that he uses and very much likes. There's that hollow that went crazy. And again, you can see it's drawing the anchored VWAP for me, and I'm not needing to do a whole lot of work. If I go into anchored VWAP, let's do just the pullback. This will be the pullback from, there's that AES, go back to the daily chart. This will be that anchored VWAP pullback from a major swing low. And again, you can see it's drawing these things in for me, which I love because it just saves a whole lot of time. This VSTS is actually something that I'm watching here as well. You can see the support point right there and this kind of dramatic sell-off. So if this sell-off is a little bit overdone, you can see it happened right after earnings, you know, maybe that's a place to pick that up. So I think if I've done this right, I'm out of time. So I just want to say thank you everyone for coming by. And I greatly appreciate, oh no, wait, sorry. Rob, are you there? Do I have 15 minutes left or am I?
No, it's a 45-minute slot. You're right on time.
Okay, perfect. I thought so. I just don't want to go over and take you away from the next presenter. So perfect.
If you go a few minutes over, you get a polite poke in the admin chat. But you know, Michael, thank you. I have to say that I love your presentations, and I wish I could find a way to use anchored VWAP on my platform because it looks absolutely brilliant. In the current trading environment, you know, everything you say is so relevant. You know, the art of the pullback, I always learn something every time I see you on the show, and you might as well have the whole alphabet after your name. You know, you are
at this point, yeah.
I have to give you credit for being brilliant. You know, it's,
oh, I appreciate that.
You know what I mean?
I don't know if
Listening
I'll
to your
take that one, but I'll
presentation
appreciate it.
and just the depth, the study, the everything, and you know how you've analyzed everything. I'm a big fan of yours. But great information, ladies and gentlemen. If you're interested in compounding your portfolio by always rotating into the strongest names and have the ability to exit trades that have lost momentum, then look no further. Michael who is a chartered market technician, has a solution for you. You can find his offer by clicking the link in the chat box, or I will put his link in, www.trade-ideas.com. Mike, thank you so much for taking your time out of the day and joining us today. I hope you have a great weekend, a great everything.
Awesome. Greatly appreciate it. Thank you very much.
You're very welcome. I just want to pause for a second and thank everyone in attendance today. We have over 1,000 traders from all over the world joining us. So regardless of what country you're from, I want to wish you a happy Valentine's Day with it coming up here in the US. And a wonderful holiday with you and the one you love. Today being our stock and options special event, we would be remiss not to have the author of the Bible of Options Trading on the show. And let me go ahead and make him the presenter.
Thanks, Rob.
That's all right. And where did I leave off? You'll want to listen very carefully to our next presenter because he's a professional trader, registered investment advisor, commodities trading advisor. He speaks on options strategies at many seminars around the world. He's perhaps best known as the author of Options as a Strategic Investment, the best-selling work on stocks and option index strategies, which has sold over 1 million copies and is referred to as the Bible of Options Trading. He's regularly quoted in publications such as the Wall Street Journal, Barron's, Technical Analysis of Stocks and Commodities, Data Broadcasting's Exchange Magazine, Futures Magazine, TheStreet.com, Active Trader Magazine, as well as others. Ladies and gentlemen, here to present McMillan's Market Outlook, what options indicators are saying now. It is always an honor to introduce Mr. Lawrence McMillan of McMillan Analysis Corporation. Welcome back to Traders Corner, Larry.
Hey, thanks. That sounded like a very, very nice introduction. Thank you.
You're
So
always welcome.
before we get started, just a little background on our company. I started this as a derivatives research firm 33 years ago now, after running a prop desk on Wall Street. And we were originally just selling data, recommendations, etc. But because we had quite a bit of success in the financial crisis, we went into managing other people's money as CTA and RIA. And then we also do a certain amount of option education, things like this. And we also have a mentoring division. I'll come back to this later, but the PDFs, the PDF of this, well, actually 2 PDFs are available at this website. One is in color, one is in grayscale in case you want to print it out, waste all the ink. But I'll come back to the actual offer itself later in the webinar. So there's 4 main things that we look at, and the most important one is the chart of the S&P 500. I think in this recent market that has never been more true than it is now. In other words, the S&P is roaring away to the upside. Some other indicators have not necessarily been keeping pace, especially ones viewing the broad market, and we'll talk about that later too. But you really want to be in tune with the S&P or whatever it is you're trading, but we trade the S&P. Because that is really the king. I mean, no matter what your indicators are saying, if the trend is higher, you need to be with the trend. We'll also take a look at equity-only put-call ratios, both in the broad market and some individual stocks and futures. Market breadth, where we have an option-oriented twist on that. And then what volatility is saying. And then, as I said, some interesting divergences have come up, and we'll talk about those near the end. So one very important thing is that oversold does not mean buy. Now, we really don't have any oversold indicators right now, but there's a companion saying that overbought does not mean sell. And we certainly have some overbought conditions. But until you actually get a sell signal, the market can stay overbought for a long time before you actually turn down. And obviously, the other way, the market can stay oversold for a long time before it eventually turns up. So we wait for confirmed signals from our indicators before we act on them. Here's a long-term chart of the S&P. I just usually show this so you get a kind of big picture of what's going on. We were in a year-long bear market in 2022, over on the left side here, over in here, and now we're in a bullish market. The trend line is way down here. Not sure exactly what you'd want to say about what this trend line is that we're in right now. It's very steep. Obviously, can't keep going at that pace. But as I said, it has been going at this pace really since last October, and it's really, confounded quite a few people. Now, one thing that's pretty obvious here is that it was struggling to get through the all-time highs, which were at 4,800 set in late 2021. And once it finally did, it really has accelerated. The shorts have covered, people that were underinvested are jumping in on the long side, and then people that were even long are leveraging up and a lot with options, but also with traditional margin strategies. So we had this 10% correction back there in October, which just sort of fueled this whole thing that's going on right now. Here's a 1-year chart, and same thing's going on. You can see there's a little support here, perhaps at 48.50, where we pulled back to right at the end of last month when the Fed, right after the FOMC meeting, when they indicated they probably weren't going to be lowering rates immediately. There was like a 90 point sell up in one day, bounce back, of course, but that is a little support area. This area in here that we worked in really for over a month in December and January is doubly important. First of all, it's a nice support area for this breakout rally that's going on right now, but also the December lows here at 46.40 are really pretty important, because there's an old saying that if you break the December lows in the first quarter of the next year, you're going into a bear market. So it's important that those hold. And you know, on the other hand, if we do break that, we probably are going into a bear market. In case you attended the last one of these webinars here, I was mentioning these various gaps that existed. They're still there, and it doesn't look like they're going to be filled anytime soon. So on a big index chart like the S&P with all the large caps, it's really rare to see those gaps, but there they are, 4 upside gaps, and I'm not expecting them to be filled. So just to kind of summarize this, we had this 10% correction, which turned around really because there were some heavy oversold conditions, but also very positive seasonality in October, November, December. That's all played out quite well this year. So left that base there at 4640 to 4800. The breakout of 4800 is where we are now, and so those gaps were relevant. So the bottom line on this is that we generally try to maintain a core position in line with the broad market, and this should be 4640, not 4740. And so that bullish core position is in place. Even if we pull back to 4800, it was still normal, you know, within the normal course of things. So another thing we look at on the S&P chart is what I call modified Bollinger Bands. When John Bollinger invented Bollinger Bands, he decided that his measurement of volatility would be the standard deviation of closing prices. And that's certainly a reasonable way to look at it. Unfortunately, the math guys don't really look at it that way, like Black-Scholes and others. They calculate the standard deviation of percentage price changes, so daily percentage price changes. So it gives you a little bit different band, but this is the way we look at it. So here's the, so I get this, find my, oh, there we go. Okay, so, no, I thought I had it, there we are. So this is the +4 standard deviation band right there, the high band. And the next one inside it there, that's +3 standard deviation. So a sell signal occurs when you move outside the band and then back inside the 3, and that's a sell signal. Buy signal is the opposite, like here and here. Now the red letters are successful buy and sell signals, the blue ones are not. Typically this has a very high percentage of successful signals. It's run into a couple of losses, but everything is limited here. So this basically stays on the signal until it reaches the opposite band right in here. So the buy signal is terminated at that point. There was a sell signal here, which didn't pan out. And now right here, as of Friday's close, we're above the 4 standard deviation band again. So a whole new setup will be coming for another sell signal. It's a little bit of work involved with this. What happens is, first of all, we need to get the standard deviation or the S&P to close within the 3 standard deviation band. That gives us what we call a classic sell signal. But even that we don't trade. We wait for further confirmation to get the total McMillan volatility band sell signal. So that's something that's in progress right now. We'll see. Every classic sell signal doesn't even produce an MVB sell signal. Now we can apply this same methodology to any chart, any stock index, future, what have you. And so we do this and sell it as a subscription service. Here's how it looks on, this is sold through TradingView, and this is the chart of the S&P 500. So these are those signals that you saw on the other one. There were 3 buy signals there, and the 1 sell signal recently, and now we're outside the band again right here. So if you're interested in this kind of thing every day, and by the way, then we tell you, what stocks are giving new signals. You don't have to go through the entire list of 6,000 stocks or whatever. We tell you which stocks are giving you signals. Anyways, let's move on to put call ratios, because these are always pretty interesting. Put call ratios were invented as an indicator by Marty Zweig back in the 1950s when he was getting the put and call volume from the broker dealer ads that ran in Barron's on Sundays. We use the equity only put call ratio, that's all stock options that trade, to predict the broad stock market. You'll see why in a minute. But it's a contrary theory. What Marty found was if there were a lot of people buying puts, pretty soon the market went up. And if there were a lot of people buying calls, pretty soon the market went down. So of course, the trick is to figure out what's too much put buying, what's too much call buying. And so we do it this way. I'll show you how, let's just say it's IBM, for example. We sum up the volume of all the puts traded at the end of the trading day, separately sum up the volume of all the calls. That's your weighted put call ratio for the day. Obviously, since puts are in the numerator of that fraction, if there's heavy put buying, the ratio will go higher. But when's that likely to happen? Well, there's going to likely be heavy put buying when the stock is going lower. So the put call ratio and the stock price are inverse to each other. We post about 1,650 of these charts every day on our website in an area called the Strategy Zone, which is available at a pretty low price. I think it's like 25 bucks a month or something. And you can work through those. Also, we tell you there, again, which stocks are giving, and stocks, index, futures, whatever, are giving new signals. I keep a moving average 21 days just in case there's something to Fibonacci. And this is how we get the buy and sell signal. So let's say the stock is falling. As the stock is falling, people are buying puts, forcing the put call ratio higher. And, so the public is making money during the trend. This is why you want to find the end of the trend. But eventually, the put call ratio is going to make a local maximum and roll over and start to head back down lower. That is the buy signal for the stock. And so now the stock starts to move higher, move over to the left. The stock is moving higher. As the stock is moving higher, people are buying calls. That forces the ratio lower. Eventually, you get to a local minimum on the put call ratio chart, and that's a sell signal for the stock. So that's the theoretically, ideal way the chart should look. Many of the charts do look that way, but sometimes they don't. Sometimes there's arbitrage. Sometimes there's other distortions caused by outside factors. So when we publish our put call ratio charts, we also have the stock chart on there. And if you don't see this inverse symmetry, then you want to stand aside on that particular one. So this is not a current chart, but on top is the S&P 500. And on the bottom is the equity only put call ratio. So you can see the inverse symmetry that exists most of the time. And that's why we use the equity only put call ratio to predict the S&P 500. So here's where we are today. You can see, for example, we had a nice local minimum, a sell signal back there at the beginning of that 10% correction in August. The buy signal came in a little early here. Local maximum gave us a buy signal, and that was in place for quite a while. Then we hit this sell signal right around the beginning of the year, and the market, S&P, really just ignored that thing, kept on going. You can see, though, that there was some put buying, forced the ratio up, and now it's just recently rolled over again, started to head lower. So I mark that as a lowercase b for buy because it's so low on the chart. Anything down in this area would be considered overbought, and anything up in this area would be considered oversold. You'd like your buy signals to be in when the market's oversold, and you'd like your sell signals to be when the market's overbought. When you get a buy signal like we just have now, where the market's really kind of overbought, you have to sort of question it, but I wouldn't go against it or anything and say like ignore it, let's say. But it does indicate that the push on the broad market from, let's say, IWM, Russell 2000 kind of stocks like that has been slightly different than what's going on in the S&P 500. But in any case, this is saying we're on a buy signal now, and we'll be on that again as long as this ratio is dropping lower. Wherever it goes to, eventually it'll make another local maximum, local minimum, and we'll get a sell signal. Now with computers, we can compute another put call ratio called the dollar volume, or the weighted dollar volume put call ratio, or sometimes just the weighted ratio. And so the way we do it is this way. At the end of the day, we take for every option, again, let's say it's IBM, we take the option's closing price and multiply it by the volume that traded that day. And then we sum those up for all the puts, sum them up for all the calls, divide the two, and that's the weighted put call ratio. And you could do this on a tick by tick basis. It's pretty extremely computer, it bogs down your computer a lot, takes up a lot of resources. So we do it this way. It doesn't seem to make any difference. We back tested, and this is just as accurate as using every trade. So what we're doing now, though, and importantly, is that we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. So here's the current chart of this. The signals seem to come in more or less the same place. Like here's a sell signal again, late August. This buy signal is a little bit later, more probably in tune with when the rally started to take place. But again, here you had a local minimum, so a sell signal in early January. It didn't really force the ratio very much higher. And now you're dropping again. In fact, you're right now at the lowest point on this chart. And it's actually the lowest point since November, and that should be 21, sorry, November 21, right before the bear market started. So we're down to levels that are pretty overbought. But again, overbought does not mean sell. We need to see this thing roll over and start to go higher before we'd have a sell signal. So just to summarize there, I want to point out one other thing too. Some people follow these ratios on their own, and one of the easy way to look at the equity only put call ratio is to use the CBOE's equity only put call ratio. There have been some serious distortions in that caused by arbitrage in the last couple of years, certainly in the last year and a half, and it's still continuing recently. So be careful when using that ratio because it's distorted by this arbitrage. Eventually the arbitrage will go away, but it's still in place right now. So what do we buy when we actually have these signals? We buy SPY options to trade the S&P 500. And I like to buy an option that's going to behave just like my underlying is. I'm in the business here predicting the underlying, so I want to see the option go up if the underlying goes up. So one way to ensure that is to say that I'm buying an option with a fairly high delta. Now the delta of a call ranges between 0 and 1. 0 meaning it doesn't move at all with the stock, and 1 means that it was exactly with the stock. So you don't need to have 1. But we tend to buy an option that's a little bit in the money and say have a delta 0.7 or higher. In terms of SPY, that would be an option that's a SPY option that's at 1 or 2 points in the money. And if we're going out a little bit longer, say on a put call ratio signal, which might be extending out 3 or 4 or 5 months, then I might buy an at the money option. But even an at the money option has a delta of 0.55. So if the stock goes up, the SPY goes up, I'm going to be making some money here. I don't want to buy some option that has a delta 0.1 and then see the stock go up and yet my option doesn't make any money because it was too far out of the money. Now on TV, almost all the option traders there spread their option. I don't know why. You shouldn't be doing bull spreads all that often, but by spread I mean this. So let's say you're bullish on this stock, so you buy a call at this strike, and instead of just holding that call, you also sell a call up at this strike. So basically you cut off your profit potential when you reach the higher strike. That's a pretty burdensome thing to do yourself, and the only time it really makes sense to do that is if the options are expensive. And again, we have free volatility data on our website, updated every week. For paid subscribers, it's updated every day, but once a week is probably good enough. And you can determine whether the options on whatever entity you're looking at are expensive or not. So if you just bought the call, you'd have this red line. You would have maybe you'd have paid a little more debit than you would have for one spread for one call. But now, if the thing really takes off to the upside, you're making a lot more money up here, whereas the spreader has locked off his profits. And so oftentimes they'll say, well, you're risking less. You're not risking less. You're risking 100% in both cases. Your broker will ask you for 100% of the risk if you do the spread. That's this loss right here. That'd be 100% loss. And on the call, it also asks you to pay for the call. That's also 100% risk. Now, it's not the same dollars, but it's the same percent. So you can equal out the dollars by, let's say, buying 4 calls instead of doing 5 spreads or something like that. But it's a fallacy to say that it has less risk in the bull spread. Yes, less dollar risk, but it's percentage risk that you really should be looking at. Now, even if you do spread, you can mitigate the negative aspects in 2 ways. One is to widen the difference in the strikes, and 2 is to roll if the short strike is hit. So what do I mean by this? Well, let's say you're talking about SPY right now. With VIX back down here near 1213, the options are not expensive. As you go a little farther out in time, they are. So if I'm buying SPY options that are expiring before March 22nd, then I'm just buying the call or the put. I'm not spreading it. But if I'm going out farther than that, then I might want to, because the options are starting to get pretty expensive out in that time frame. So I would use a spread that's 15 to 20 points wide if I'm doing calls, or 25 to 30 points wide if I'm doing puts, because there's a distortion between the price when out of the money call and an out of the money put. Meanwhile, what do I mean by roll if the short strike is hit? Well, let's say you start at today, S&P closed at 501. Let's say you buy the April 500 call and you sell the April 520 call. That's your spread. You're starting out with that. And you're fortunate enough that in the next couple of weeks, SPY trades all the way up to 520. So at 520, this spread that you bought here is starting to top out. This is 520 right there. It's not a whole lot left in that to the upside. So sell that spread and buy a new spread if it's still expensive options there, and move both strikes up 20 points. So you take a credit out of the position and you still have further upside potential. In fact, if you however you're trading, if you're long calls, they get deeply in the money. I'm always a fan of rolling them up, because you do take out some credit, but you still, which is good, put money in your pocket, and you still have maintain an upside potential. Meanwhile, here's some interesting individual put call charts. Now, for individual stocks and futures, we don't trade every little local minimum or local maximum on the put call ratio chart. We only trade the extremes. So, for example, this is Baker Hughes. There's only been 3 extremes in the last year on this chart, 2 low extremes and 1 high extreme, and now we're just now getting another high extreme. Where, this is a local maximum here, and this buy signal is marked in green, meaning that it's open. So we just bought these calls, well, actually yesterday. So, but you can see that this is the last buy signal is a pretty good one. And the sell signals have worked out pretty well too. This is slower moving, but longer on that sell signal. And this sell signal here was a quick dip, and then probably back up here might have been stopped out even in there, but profitable. Here's another one, Henry Schein. It's a dental supply company. Not that I care what kind of company it is. But you can see that there was a strong buy signal last November on this one, and now, people are pretty excited, I guess, about that buy signal. So they bought a lot of calls, pushed the ratio all the way down here to its lows. That was your first local minimum. It's kind of messed around and not only made another local minimum here, but it finally seems like it's starting to move to the upside. So that's the sell signal that I'm looking at. In addition, if you look at the chart, you can see that it's had support at 82. So I would actually wait for it to break 82 if I was going to buy puts on this. Sometimes we combine, traditional support and resistance levels and technical analysis with these put call ratio charts. And just one more, Under Armour had a nice buy signal last October. This sell-off that it had at the end of the year really caused quite a bit of put buying. They forced the ratio all the way back up to near its highs of the year, and now it's rolled back over, giving you a buy signal. Plus, you can see that just yesterday it broke out over a little resistance area. So again, buy signal on that. Now we can do these put-call ratios with futures options too. And oftentimes there's an ETF on the stock side of the ledger that will let you trade futures without actually trading futures options. So for example, corn, if corn gives a buy signal, there's an ETF CORN. This is cattle though, and there is no ETF for cattle. There was one that sort of simulated it, but Credit Suisse closed down a lot of their futures-based ETFs a while ago. And so here, this buy signal, this is not a current buy signal, obviously it came last December, but you can see there was a downtrend in place, so we were waiting for the downtrend to be broken, and then the buy signal has started now more recently to accelerate to the upside. And you can see the put-call ratio is all the way down here now, but it's not on us, so you might consider it to be an overbought condition, and probably is, but it's not a sell signal until it rolls over like that. So again, we're rolling calls up as the futures move higher. But this one, you would actually have to have a futures trading account or a composite account like an Interactive Brokers where you can trade both futures and stock options, because there's no other way to trade this except for trading live cattle futures options. All right, so third thing we look at is market breadth. Going kind of slow here, I want to speed it up a little. So we can either keep a cumulative total of market breadth, or we can calculate an oscillator. We do the oscillator thing, and here's our current oscillator. You can see that this oscillator most recently actually gave a sell signal. Oops, right here, because it wasn't very overbought, and then it fell back out of overbought territory and gave a sell signal. That's unusual. With the market making new highs, the breadth is really not keeping pace at all, and it's a bit of a warning sign. You know, is it an all-out sell everything warning sign? No, but it is a warning sign. You can see here when we first broke out above 4,800, the oscillator got very overbought. In fact, the most overbought it ever was in history. That's the kind of thing you'd like to see when it's breaking out to new highs, but you certainly don't want to see it falling back and giving a sell signal. So this is a bit of a warning sign, I think, that breadth is not keeping pace, and we'll take a look at a chart later that might show you why that's the case. But right now, these breadth oscillator sell signals are still in place. The breadth was a little more positive on Friday. It's possible that these breadth indicators get stopped out, but still, breadth has not been the kind of indicator you like to see keeping pace with the S&P 500. New highs versus new lows is another thing we look at. This chart shows 3 sets of data: the New York Stock Exchange, which is what we use for our signals; stocks only, which is all optionable stocks; and NASDAQ. So when there's 2 days in a row of new highs greater than 100 and greater than new lows, that's a buy signal. So we got a buy signal here on January 22nd. That'll stay in place until there's 2 days in a row in which new lows outnumber new highs. So there was a previous buy signal. If you look over to the right here, there's a previous buy signal in December, which ran all the way through this place right here, was stopped out. Now we're in a new one. There was 1 day right after the first of the month when there were more new lows than new highs, but not 2 days. So this is still long. This indicator is still long. The market, it's only trades a few times a year. It's pretty good usually, and it's not always in. So it can be stopped. It can go from buy signal to neutral and not necessarily go right to a sell signal. But right now it's long. So what about VIX? What's it telling us? Well, 2 things are important with VIX. One is the trend of VIX, so the VIX should be trending opposite to the market. And second is spike peaks in VIX are buy signals for the market. So VIX right now is low. It's overbought. It's causing a lot of people to be worried. You read articles on Bloomberg about, oh, we're, VIX is too low. This is danger. It's not dangerous yet. It's only dangerous if it starts to go up. It can stay low for long periods of time. There's a couple, if you go back in history, there's like 10 months VIX is below 12. I mean, that's a long time to try to be shorting the market. And believe me, in those 10 months, S&P was going up a lot. So just because VIX is low is not a sell signal. This is a one-year chart of VIX. All those B's on there are spike peak buy signals. The red ones are profitable. The blue ones are losses. We have a trading system we built around these. And the secondary colored ones, we don't trade. So when we get this buy signal here, it's good for a month. So there was a second buy signal within that month. I just mark it, but we're actually not trading it. So it's an orange B. Same thing there. And same thing here, actually, on the one that was not profitable. Meanwhile, I talked about the trend of VIX. So we say VIX is trending if VIX and its 20-day moving average are on the same side of the 200-day. So right here, this is the 200-day moving average, and this is the 20-day moving average. And right here, you can see the 20 crossed below the 200, and VIX was already below. So that's a trend of VIX buy signal right there, and that's still in place. It'll still be in place until VIX finally closes above its 200-day moving average, which is right now at about 15.15. And it's obviously, you can see it's trending lower. So as long as VIX doesn't close above that 200-day moving average, I'm not worried about VIX giving any kind of bad warning about the stock market. In fact, I'm a little surprised VIX is not even lower than it is right now. Back in the 2019, when VIX was making new highs, or 2016, so years like that, VIX was heading towards 10. So VIX at 13 is, somewhat elevated. In any case, this trend of VIX buy signal is still in place, and we don't have a spike peak working right now, but this is all bullish unless VIX starts to rise. And of course, the first sign of rising would be for it to go above the 200-day moving average. Now, you can't trade VIX, but there are VIX futures and VIX options. The options are technically options on the futures, even though the CBOE calls them cash-based options. The underlying is the futures. In any case, the futures that do trade on VIX can give us some clue about the market. If the futures prices look like this as we go out in time, that's called an upward sloping term structure. That's bullish for the stock market. But if this happens, which the last time it happened in any great degree was March of 2020, that's very negative for the stock market. So we watch for that. But right now, things are all very nice. This is where everything closed last night. The Feb VIX futures are the front month, but they're going to expire next Wednesday, so they'll have a couple of days of life left, trading days. But you can see that each futures contract is higher than its predecessor, and they all have a premium to VIX. So all this is bullish for stocks. And when the February's expire, that really isn't going to affect anything there. If you can get the futures prices by just looking on the CBOE futures website, or there's a simple way, I call it the poor man's futures way, is to look at the CBOE's volatility indices that they publish. So you're all familiar with VIX, that's a 30-day index, but there's a 1-day, a 9-day, 3-month, 6-month, 1 year. And again, we look at the prices of these as of last night, and they're all sloping upwards again, bullish. So that's all bullish as well. And in fact, the first warning sign would come if the front month were to rise in price above the second month. So beginning with next Wednesday, March will be the front month. It's trading at 1467. The second month at that time would be April. Right now, there's 90 cents April over March. That's no worries at all. But if it were to invert, that would be a pretty big warning sign. You should definitely take some bearish action if that happened. So here's the summary of all these indicators. And we only have one bearish indicator. That's that breadth oscillator sell signal that I talked about, and even it might be close to being stopped out. We don't have a VIX spike peak by signal right now, nor do we have a McMillan volatility band signal. Those are neutral, but everything else is bullish. The chart of the S&P is going higher. The trend of VIX is going lower. New highs are dominating new lows. The term structures are sloping upwards, and the put-call ratios are heading downwards after having made a recent local maximum. So, bullish. I mean, there's not much bearish evidence there. Yes, things can happen and change, but right now, at this point in time, we're still holding our core bullish position and trading other things around that. Yeah, as I said earlier, a pullback towards 4,800 would be okay. The close below 46.40 would not. That would be definitely a deal breaker and a change of position. But I did want to point out just a couple things that are giving us a little bit of a warning sign, and maybe some more than others. But first of all, February is often a very ugly month. So this is the last 21 or 22 Februaries here. You can see in recent years, this is the point gain or loss on S&P. Pretty bad a bunch of these years. This is the percentage gain or loss. And the same thing had been happening back in the early part of the century. But then right in here, it wasn't. It was like there was a period of time when February was all bullish, but now we're back in the negative area. Again, not something I would actually trade on, but if VIX closes above its 200-day moving average, I said before that, that would be a negative. That coupled, let's say, with this would indicate to me that we want to buy some at-the-money puts if VIX closes above its 200-day moving average. Another thing, here's the chart of the Russell 2000 index. It made an all-time high back in the end of 2021, just like S&P did, and now it's fallen off, and it really can't seem to get going again. It's well below its all-time highs. Meanwhile, S&P is roaring way to the upside. So is QQQ, and so is the Dow. But there's a lot more stocks here. And this represents, the broad stock market. So this is why breadth is not so good and other things like that. Again, not a trading signal per se, but definitely something that is not going to be healthy for the market in the long run. And then finally, one last thing, cumulative volume breadth. So cumulative volume breadth is just the daily running sum of the volume on advancing issues minus the volume on declining issues. So there's two ways to use this. One as a bullish indicator. If cumulative volume breadth makes a new all-time high before S&P does, then S&P usually follows. So that's a bullish thing. And then number two, as a bearish divergence. If S&P is making new all-time highs and cumulative volume is declining, that's a problem. So here's a chart back. This is not the current chart. This is a chart back in several years ago. First of all, here's the bullish thing. You can see coming out of the pandemic bottom, the cumulative volume breadth made a new high right here, but S&P you can see was lower, and S&P then went on to make its own new high. So that was the bullish scenario. The bearish scenario set up at the end of 2021 when S&P was making new highs right here, 2021 into early 2022, and cumulative volume breadth was going the other way. So sometimes these cumulative volume things can last a long time. They're not exactly a sell signal per se, but they're a warning sign again. And so what I usually say is when this happens, don't ignore any sell signals. You might be tempted to ignore a sell signal, but don't. So here's the current chart. We had two of these positive things. This one did not work. This cumulative volume went to a new high last, I don't know, I guess it was August, and the S&P did not. But then it kind of resurrected itself partially. It went to another new high in early December, and then the S&P, of course, followed along. But here's where we are right now. Cumulative volume breadth is not making a new high currently. This is a current chart, and S&P is. So again, we've got this negative divergence in place. Again, not a sell signal per se, but don't ignore any sell signals that might come along. So I mentioned that you can go to this URL and get the PDFs of this webinar. There's also a special package that we're offering for customers that attended today. And it's for $249. You get a copy of the book Options as a Strategic Investment, autographed, no less. I'm sorry, that's here. This is the Option Strategist newsletter. So that's a six-month subscription to that. That we cover really everything about option strategies. We have calendar spreads and naked puts and put credit spreads and other things like that, including all these other indicators I talked about today. Perhaps if you're not an option expert, you'd be interested in this. There's a 14-part intensive home study course on streaming videos, and that is part of this package. And then if you're interested in our asset management, we can you get a free consult on that too. I will tell you that our minimum account size for managed accounts is $100,000. So you get the option strategist. We've just updated the tracker. Again, there's a full track record on the website. The 14-part home study course. Each of the 14 is about 1.5 hours in length, and then the book. So that's the deal. Otherwise, visit our new website. We've put up a lot of new information on the website. We also have a couple of daily letters where we cover all these sorts of things daily. We have a YouTube channel. I update that every Monday, and then a couple of other sort of different kinds of newsletters. There's a daily put writing newsletter and another one that handles special situations. So I think we're just about finished. 2:15 I'm showing. So let me send it back to you, Rob.
Larry, thank you as usual for being here. The incredibly informative information. I get something new from your presentation every time I see it. I'm just astounded with how brilliant you are. Ladies and gentlemen, this is Mr. Lawrence McMillan of McMillan Analysis Corporation, and we refer to Larry as the E.F. Hutton of options trading here on Traders Corner, because when he is speaking, it is a real good idea to listen. I guarantee you will learn something. Keep up the great work, Larry. I was waiting all the way to listen to your perspective on the current environment. You know, we're soaring higher, but the warning signs are present.
Right.
Please come back and see us. I wish you a great weekend, Valentine's Day, etc.
All right. Same to you. Thanks.
Thank you. Ladies and gentlemen, if you want to learn how to trade options from the author of the Bible of trading options, or just start receiving Larry's weekly trades, I put a link to his website in the chat box. That will bring us to our next presenter. And as I mentioned at the top of the show, we have a great lineup, and he is certainly no exception. He began his career in 1980 and was one of the original market makers in the pit at the Chicago Board of Options Exchange. He's traded all the major exchanges in Chicago and is currently a member of the Chicago Board of Trade. He spent 8 years as a mentor and educator to traders of all levels. He's also developed a program for high school students that allows them to learn how to trade the financial markets. Ladies and gentlemen, it is my pleasure to introduce a seasoned pro who is always entertaining, never bashful, rarely filtered, my poker buddy. Here to present Saturday Options Call, Weekly Options Trading, is Mr. Todd Bubba Horwitz of BubbaTrading.com. Welcome back to Traders Corner, Bob.
What's up, Rob? How you doing, buddy?
I'm doing pretty good. I started playing 2-3 nights a week, and I broke a game twice in the last month, so I walked out with every penny both times.
I'm running bad. I had a guy call me down for 2,500 with 4-6 of diamonds and bought a diamond in the river to beat me, but it happens.
Hey, you love the call and being an 83% favorite,
I'll take it every day. And by the way, Larry McMillan, he was the Bible. In fact, when we were as a floor trader, that was the first book I ever read on trading.
Oh, thank you for giving credit to another one of our presenters.
Options is a strategic investment. Larry McMillan.
Amen.
And I know him well as well, but before I knew him, I read the book. So he got a lot of good points, and a lot of things I agree with, some I don't, but it's all good, and we'll get ready to rock. You ready for me to go?
I'm ready for you to go, but I just want to say too, as the host of this show and or for our regular attendees, the chances to see, speak with, and hear the takes from, you know, accomplished professionals as well as people like yourself and Larry, man, do I love it.
Listen, Larry's
But
great.
Take it away, brother.
We got it. What's up, everybody? Welcome aboard, and it's great to be here as always. Love hanging out with you guys, even on Saturday afternoon when I should be playing poker, but here I am. But I will be there afterwards. So in the meantime, I am Todd Bubba Horwitz, and this is about trading options. And just full disclosure, I trade everything. But the first thing I always like to tell everybody is trading is hard. Listen, you're not stealing anything by becoming a trader. It takes work, like any other job. It takes work. The nice thing about trading is that you have the opportunity to work your own schedule, run your own business, have your own franchise. And if you want to carry inventory, you can. If you don't want to carry inventory, you don't have to. So, but just remember that you got to become a professional like in any other job that you have. If you want to be good at it, you got to become a professional, because as we know, amateur traders want to be right, pro traders want to make money. Which do you want to be is the question you have to ask yourself. You know, as Larry was talking about, you know, the markets are going up. No matter what you believe, no matter what news you hear, the markets are going higher right now. So you want to fight that? Do you want to get in front of it and go broke, or do you want to, you know, if you're determined to be short the market, then you're best to sit out, because I assure you, and I will guarantee you, you'll have plenty of time to get short when the time is right. And to be first is usually to fail, because even if you're right at the beginning, you'll get out far too fast, because that's a bad habit that you create by trying to predict the markets. Let the tape, let the chart tell you. And as a floor trader, I didn't have a chart. I had to read the tape as it was moving and watch the order flow on the floor. So remember that don't fight it. Just become a professional and learn to make money doing it. And one of the offers I have today, and just for all of you, we have a deal with Trade Your Brokerage. If you're not familiar with them, they're great. $10 a month flat for commission saves me about $100,000 a year. Okay, so just remember that. And it's a great brokerage house. The disclaimer is, I'm sure you've seen many times already, whatever results I show you, which I only show you very few, because I'm not interested. If you're only worried about the results I'm going to share with you, then you're probably not a very good student and a very good member. And I want people that want to learn and understand and be able to create their own, because what I teach, you can just learn to create and do your own thing. Okay, but there is no guarantee of the future. We can only tell you what has happened in the past. And again, if you don't remember me, I am Todd Bubba Horwitz. I've been doing this for 45 years. I was one of the original market makers in the S&P, and I trade all my own recommendations. If it goes out of my office, you can bet that I'm in that trade with you. Okay. So, and in fact, I put new trades out today. I'll show you a couple of them, and we all get in together. So there's no funny business. We do everything together, and that's how I like to do business. Drawdowns, look, there is no way to avoid the ultimate drawdown in markets. They come, they happen. And listen, if you can't deal with them, and you're not prepared for them, then it's probably not a good thing. Okay, because again, this is a risk business. It takes risk and it takes capital to play. Okay, and when you play, you got to be able to put yourself in a position to actually learn how to take advantage of drawdowns, not be worried about drawdowns. Okay, and that's one thing that many people do not understand, is you can actually take advantage of a drawdown in a market, because if you understand what your win rate is, okay, then you're going to put yourself in a position to know how to add to your position when the probabilities are the highest in your favor. Okay, and that all starts with your trading education. Okay, you got to learn everything you can about trading. Okay, now you might migrate into specialized types of trading, because of course in the derivatives market there's a billion trades you can make, and you may want to specialize, which is fine. Okay, there's nothing wrong with that. Fortunately for me, I understand all of them, and I trade a little bit of all of them depending on the market. That opens up more markets for me to trade. But of course, I also day trade futures as well. So I trade it all. Okay, I often say that if I had a liquid cockroach market, I trade those too. It doesn't really matter to me. Just give me a liquid market and I'll trade it. there is a lesson to be learned from every trade. And I think if you take the time to do a post-mortem on your trade and take a look at it, sometimes you'll make a bad trade that'll make money. Sometimes you'll make a good trade that'll lose money. But you need to learn the lesson of every trade so that you understand if you made a mistake, even if you made money. Again, the scorecard is important because that's how you pay yourself. But knowing that you're not making a mistake and making a bad trade and just getting lucky in the beginning is very important, because the business itself is a grinded out business, all right? There is no gigantic, you'll get a couple of big winners, but basically you're constantly on the grind, okay? It's like being a professional poker player. You're constantly grinding out, as he says in Rounders, one big blind an hour, okay? In the meantime, options trades are simultaneous and often mixed buying or selling of one or more options that differ in one or more of options variables. Call options, simply known as calls, give the buyer a right to buy a particular stock at that option strike price. Now, I don't ever trade naked calls or puts. I create positions and I create synthetic stocks. I do a lot of things which we'll get into. Okay, decision making is an integral part to trading. Our philosophy emphasizes concepts that help us make more informed decisions. And here are some general examples of those concepts that we relate to trading. Okay, well, the first thing you got to start with is a plan. Okay, you got to have a plan to understand what you're going to do and what you're trying to do. And if your objective is to come in with a small account of, let's say, $5,000 and turn it into $100,000 tomorrow, you have no chance. You might as well just write a check to your favorite charity and give the money away. Okay, you got to grow that account slowly. Okay, you got to grow it percentage by percentage. 5%, 8%, 10%, and you'll get the occasional. If you're prepared, you'll get the 20% winner. You'll get the 50% winner. You'll grow that account. But if you try to get rich quick, there is no such thing. Okay, and it all starts with setting goals. Okay, and what is your goals? Well, your goals in the beginning should be to learn and understand the process. Okay, and to be able to make little bits of money when you start. Okay. Again, the amount of money you make is not important at the beginning. The concept of learning the process, understanding the risk management, understanding the strategies you want to use, understanding how to enter, okay, analyzing the trade and managing the trade, those are the things that are first more important. And just in full disclosure, my first 6 months on the trading floor, I didn't make any money, okay? In my first 6 months on the floor, I made my money playing backgammon and gin. So again, you have to learn the entire process. You have to understand it. You have to know what to do. You have to know where you're going. And if you do all that, you're going to set yourself up to be a successful trader. Okay, you want to put yourself in a position to be successful. You don't want to set yourself up for failure. So what do you need to do? Well, first, you got to have some analytical skill. And it doesn't mean be anal. It means you just have to know how to analyze, take a look at any given chart. What do you see on this chart? The markets are going straight up, okay? In fact, on a couple of weeks ago, I said, I will guarantee you that the NASDAQ will trade 18,000 and the S&P will trade 5,000. Well, here we are. Now, what is that? What, does that make me a genius? No, but you look at the tape, you look at the direction, and the markets want to go higher. Again, you can make all the cases you want in the world of why they should go lower, but at the end of the day, the markets don't lie. Remember, the market's an inanimate object that trades 241 days a year, okay? It's all driven by paper flow, order flow. You gotta do some research. Now, again, I'm not thinking about researching fundamentals. You gotta research strategies. You gotta research the chart. You gotta research what's going on. And when I'm trading, I could care less about the fundamentals of a company. The only time I ever look at the fundamentals of a company is if I'm putting it in my retirement account and I'm gonna hedge it. I wanna make sure that company's gonna be in business 20 years from now, okay? Because what do I know? I know that in history, the markets have gone off 8.5% year over year. Okay? You got to have focus. If you're not focused when you're trading, then you should walk away. Don't trade that day. You don't, just because the market is open doesn't mean that you have to trade. And I'll give you an interesting quick anecdote. I trade live futures every morning with my members that are part of my futures group. Half the time, we're done in 20 minutes. I go, hey, there's nothing to do. We're not going to get involved. There's no reason for me to be here, okay? And I have that control to walk away, okay? And you got to keep records, okay? You want to know, when I give you a trade, you want to know how to track the results yourself, and not through the brokerage house, because you'll drive yourself nuts because the numbers will never match, because part of your trade that we're going to do expires every week while you still hold a core position. So you have to know how to calculate out so you know exactly where you stand. So when I say to you, if you can lock in a total profit in that trade, take off this piece, that'll give you the profit, okay? You got to understand option premium, and Larry did a good job with this except for one thing, okay? Options are never cheap. Volatility is never cheap. It's always fairly priced except when it's expensive, okay? That's one thing you want to remember, okay? The option premium, the implied volatility, which is for forecasting future movement. The most important thing to know is there are certain times when it gets way, way too expensive, especially around earnings time. And again, if you think I'm kidding, you know, they build in too much price movement during earnings, okay? And if you saw Microsoft a couple of weeks ago, I'm going to pull it up. I guess I got to do a little magic here, but I actually took a screenshot of it because I made the statement before it happened. Okay, so let me just pull it up for you. Hold on a second. You'll see my cartoons. I'm a big cartoon guy. There we go. There's Microsoft. Okay. I said the day before these earnings, if Microsoft does not meet or beat, if they don't beat expectations and the stock doesn't move farther than the expectation of movement, all of the calls and all of the puts would be lower on the day. And sure enough, except for the very deep in the monies, which were probably mispriced to begin with, they were all underwater. They were all negative. And too many people think that they can jump in and buy into these knowing they're going to get a big move. I got news for you. Market makers don't make those kind of mistakes. If the buying is too heavy, the bid offer spreads are going to continue to widen away. Volatility is going to rise. And of course, you're going to be in a problem because it's going to collapse if it doesn't move farther than, and think about it, the amount of risk you are taking for the amount of money you're going to make. Okay. And of course, there's the expected move. Okay. Now, if you have Thinkorswim, they show you the expected move. Okay. You look at the Thinkorswim platform, and I look at this, and it says, I don't know if this is blocking you guys, but it's blocking me. But I happen to know that for this week in the Qs, the expected move by Friday is about $7.50 plus or minus. I don't know which way, but if you just take if you don't have Thinkorswim or you don't know how to do it, you just take the at the money straddle and you multiply that by 1.07%. That is actually the Black-Scholes calculation. That'll tell you what the expected move is for any period of time. You can go a year out, you can go 5 years out. If you have options, you can price what the expectation movement is based on the current volatility, okay? And that's important to understand because you want to make sure that every stock that you're trading is not being overpriced at that time. Because again, remember, options are always fairly priced except when they're expensive. Okay, that's the expected move. The Greeks, I'm not a big fan. Okay, I don't use Greeks with the exception of one, Delta. Okay, and I don't really even use Delta. I just talk about the at the money call or the at the money put because 90% of our trading should be at the money. That is where the biggest advantage for option traders comes is at the money. And the at the money option, no matter where you are, no matter how far out in time you go, the at the money option is going to always be around 50 delta here. Here's the one for Friday, a week from Friday. Okay, there's the same delta. Okay, you're going to see this consistent. I can go out 2 years from now. The at the money call is going to be 50 deltas. Okay, and if you don't really understand what delta is, they will tell you that that's the expected move of the option price for every dollar move in the stock. To make it easier and simple, I'll just tell you that delta really is what it is. It represents how many shares of stock you kind of own. So a 50 delta option, you own like 50 shares of stock. And options are the one tool that you can use that you can buy a 50 delta option and that position size can increase while you're holding the position because it can go to a 60 delta option, which means you're now representing 60 shares. It can go to 70. And of course, obviously you can go down as well. But in the meantime, it's the one derivative that grows when you're right and it goes up faster and it goes down slower when you're wrong. It still can be a loser again. because of course we have the time decay. And I don't have to talk about theta, I can just say it's time decay. I know that there's an expiration coming, and of course, we've got lots of expirations now, including the 0 DTEs, which we'll address. Probability model is really what we're trading, okay? All we care about is the probability. Am I putting myself in the highest amount of probability to give me a chance to win? Okay, that is really all I care about, okay? And just a quick example, if you ask most people, and you ask them how many different combinations of rolls are on the dice, most will say 6, okay? But the true answer is 36, okay? Because a 4 and a 3 is 2. There's a 4 and 3 on each die. So, but anyways, we only want to be in high probability situations, okay? Now, it's not always going to work out. We're not always going to win, but at the end of the day, if we put ourselves in a higher probability model, then we're going to be winners over time. And again, that's what we're trying to accomplish, is to be winners over time. Derivatives, now, we've all heard, or maybe not heard, of derivatives, but derivatives are a product that is derived from something else, okay? And of course, mortgages are a derivative, options are a derivative, and of course, if you saw the movie The Big Short, they were writing derivatives on derivatives, but it is an asset class that helps you create something, and you can create a position for less than actually buying the underlying, okay, and still have risk, but of course, you can use your money and your capital a lot better. Okay, and that's what when you're creating something that's derived from something else. Okay, now the process of making a trade, okay, you have to have the reason why or the rationale, the trigger, and your risk analysis. Okay, you have to execute the trade, you got to manage a trade, and whether it's a winning or a losing trade. Okay, and again, they're not all going to be winners. I mean, it just happens. That's life in the big city. But when you learn and understand exactly what you're doing, and you have a step-by-step process to put yourself in the best position, it helps you in creating derivative products. Because does anybody know, if I short the stock and buy a call, what position I've actually created? Just out of curiosity. Let me know what that is. No big deal. I'll get back to it. I'll answer it in a few minutes in case somebody knows. I don't want to steal your thunder if you know the answer. A hedge, okay. Actually, a collar, okay. Actually, when you buy a call and you sell the stock, you're creating a synthetic put, okay? Because you get no benefit to the upside and you get dramatic benefit to the downside, okay? When you short the stock and buy a call, you're creating a synthetic put, okay? And there's ways to create synthetic stock and then create synthetic protection around it, which is part of hedging, okay? But good job, good guesses. Hey, again, you don't know unless you guess. And I love when people participate because it allows me to teach things that we can do, but we can create derivatives. We can create a synthetic stock, okay? There are positions called risk reversals, okay? Now, we don't trade risk reversals as retail traders because you might as well buy the stock. But as floor traders, when you don't have the same margin problem, you use risk reversals, but we've actually learned how to create risk reversals that have we call it a broken wing that reduces the margin. So I can create ownership in this SPY, in the S&P, the spiders, okay? And I can create ownership of 100 shares of stock for $5 or $500, okay? And I don't have to put up $50,000 to buy 100. I can create 100 shares for $500, okay? And again, there's all kinds of things that we discuss and we cover and we close. Obviously, I can't get to them all today, but there's a lot of basic positions by learning how to use the derivatives, because we never want to give up the overall upside of the market, okay? We want to have the benefit of potential gain to be unlimited. And that was something that Larry had mentioned, okay, about people, they talk on TV all the time about the idiots who put on debit spreads all the time. You never want to put on a debit spread. It's a waste of time. It's like selling a covered call, which is one of the worst strategies in the last 30 years because it doesn't protect you from anything. It does take away your potential profit, though, okay? So there's no reason to do these short, small little debit spreads, okay? Because I will assure you that when you learn how to sell credit in credit spreads, okay, thank you. When you learn how to sell credit spreads, okay, I will tell you that on like a $5 wide credit spread, if you're selling a put spread instead of buying a call spread, your profit's going to be about the same, but you don't need the same type of movement in the stock. When you're selling credit, if you do it properly, you don't need movement. You just need it not to go against you. Okay, that's the key. You don't need it to go against you. And there's also, you know, if you have a position you want to create an option here, I'll do one real quick. I don't know if I'm running out of time, but I get on tangents and I want to show some stuff, so I can't help myself. Sorry, Rob. It's just life in the big city. So let's just say NVIDIA's been unbelievably on fire. Okay, and full disclosure, I've lost money the last 3 times I traded it. Okay, because I keep thinking that it's a blow off top. Okay, now I don't think of that because it hasn't blown off recently. But again, if this was higher volume, I'd look at it. But let's just say, for the example, that I thought that it was going lower. Okay, so let's go out to February 23rd, which is 2 weeks from now, and I'm going to sell a deep in the money call spread. Okay, so I'm going to sell a vertical, and let's say I'll sell the 705, 720. Okay, so I can collect for this trade 875. My risk is 1750, so my risk is 875 for 875. Okay, but what I'm really buying is the same. I'm buying the put. Okay, I'm buying the 70250 put, which I'm paying 875 for. Okay, here I'm paying $27 for, which is a better trade. Now I am giving up the potential of an unlimited gain. Okay, but which is the better trade? Okay, again, you got to understand the risk and the exposure that you're taking when you do these. Okay, and again, what is the likelihood of it having that big a move where it's going to come into the unlimited position? When you're only using that strategy when I would call it like a blow off phase where the market's going straight up or straight down, and I want to make sure that I can participate. Now we also have the big short. I referenced it earlier, but big short was, the problem was, of course, banks were well over leveraged and they were writing derivatives on derivatives, and AIG was selling, if you know the word teeny, okay, that was what market makers used to sell, teenies, okay, those are ridiculous to sell as a retail because you'll get killed, and all it takes is one move to wipe you out. And exactly what happened in 08, and I would suggest will happen again. When? I have no idea. Okay, I would suspect at some point we're going to get another 50 to 60% haircut. But again, it's an election year, and there's only been one non-election year that I can remember in my lifetime, which was 2008. But we'll see. Again, I don't predict markets, I just trade them. Trading psychology that nobody talks about. Okay, again, you have to be able to think and move on your feet. You can't get frozen by a move against you. Okay, you can get greedy if you use the strategy of rolling your options. Okay, again, I'll give Larry credit again. If you roll them, okay, we use a method called the 80-50 delta roll. When one of my 50 delta options that are long get to 80, I sell the 50, I buy the 80, staying in the position, but also taking money off the table. Okay, and we do that all the time. We roll options all the time. Okay, but the psychology behind it is it makes you feel better when you take some money off. It makes you feel better when you reduce some risk. Okay, versus sitting there and going from, oh, I'm really profitable, I'm having a great time, to, uh-oh, I lost all my money. Okay. Again, just you buy a call, you think the market's going up, you buy a put, you think the market's going down. But the creation of trades and the diversion of trades is what you're trying to do. And when we look at it, so what strategies should you use? Do you buy calls or puts? You can do 80-50 in long straddles. Is it a good time to buy long straddles because of the volatility, low volatility? I'm never a fan of buying a long straddle, and I'll tell you what, okay? A long straddle is you're pricing in the expected move. So if it doesn't move that far in the expectation, you're going to lose money, okay? You're much better off trying to pick an initial direction, okay, instead of playing both ways. Or I'm going to actually share with you in a couple of minutes a mimic of what you're talking about, but with a hell of a lot less risk, okay? Give me a few minutes, I will get there, I promise. That's in my presentation. buy calls or puts, sell calls or puts, buy debit spreads, sell credit spreads. Out of these choices, the only trade that I would make here is to sell credit. Okay, out of these choices, because again, I don't buy calls naked because I have to pay too much juice for them. I don't want the time to kick. I'm never selling naked. And for you naked put sellers, whether you become a member or not, stop doing that. You're getting way less than a fair edge. Okay, you're giving up a dramatic edge every time you sell a naked put. You want to own the stock, great. Sell a wide put spread. Okay, for example, on Apple, I can sell a $30 wide spread for the same credit almost that if I sold a naked put. Okay, so do I want to put up 19,000 for margin? Or I want to put up 3,000 for margin. Which is better? You tell me. Okay. And buying debit spreads not for me, except in certain circumstances, which we'll share with you. Trades to use. Now these are what we use, and these are kind of our bread and butter every week trades. Okay, for now until things change. Weighted double diagonals. Okay. Weighted double calendars. Double calendars by themselves. Okay. A lot of zero DTEs. You know, that's the latest new phase, right? And the Qs and then the SPYs and the SPX and now the NDX or excuse me, they have zero DTEs. And if you understand how to read the chart, you can sneak out a lot of premium. Okay. Because when you sneak out the premium, because you can read the expected move, you can understand where it's going. And we know one thing for sure, the sum total of the daily premium will always be greater than the sum total of the weekly. The sum total of the weekly premium will always be greater than the monthly, and the sum total of the monthly will always be greater than the quarterly. So if you're doing something like in our hedging program, we use quarterly for the hedge because we don't want to pay all that extra premium to get involved with it. But when we're trying to sell premium, we want to sell it as close as we can. Okay, which is why Fridays are a great day, even for the ones that don't have zero DTEs, because with weekly expirations, you get a lot of action there. Okay, now this is last week. I showed this morning. I did my weekly call this morning. These are our open positions right now. Okay, and what I'm showing you here, here's a trade in Apple. Okay, that we have a $35 profit no matter what happens this week. Okay, it happens to be, and this is a question that I asked this morning. I said to everybody, I said, well, what do we need Apple to do, okay, to work? And the trade revolves around the short 182.50 put and the 187.50 call. We're long 190 call and long 197.50 call because we were able to roll it up. And we're long 180 puts. Okay. Now we've locked in $35. So, but what we really need to make another $250 per contract is it to fall below 187.50. It's not a big stretch from here. It's only $1.35 from here. Okay. And even if it sits here, I'm still going to make another $115. Okay. On this trade that's open, I have zero risk. I can only make money, and God forbid it would collapse, I'd make a lot more. But that's, again, I don't count on those things. The Qs, we've got a $364 profit with about $800 of operating profit in the trade. But no matter what happens from here, I got $364. Boeing made $1,000 on it. And again, the one loser on this board that's 100% for sure loser is First Solar. Okay, it's going to expire. The best I can do on First Solar is to cut this loss to 234, and I doubt that it's going to get there. I'm assuming it's going to be a $500 loss, and that's going to be the end of it. Okay, I'm going to show you my strategies right now. Okay, so this is a strategy that I like to do. So let me just finish this real quick. So this is my initial debit. Now, one of the things we like to do is we reduce our debit depending on the option, either daily in the SPY and Qs, every other day in the IWM, or weekly, because I only trade weekly, stuff that has weeklies because I want to sell premium. So right now, Advanced Micro Devices, which has earnings coming soon, I think, we took an original trade that had 2670 worth of risk. We've collected $565. We've got 2105 worth of risk now. I have 4 more weekly rolls against it plus earnings. Okay, and I have extra options. And I'm pretty confident that it will make money by the time it's all said and done. Okay, but that's what all this means. The one the money is it rolls every day. So there's too hard for me to put a number on. Now, a trade we put on today, or we're putting on Monday, okay, is in DraftKings. Okay, now this is a weighted double calendar. So what am I doing? I'm selling the 46-41, 46 call, 41 put, which really what that is doing is it's taking the midpoint, okay, which is where the stock is trading right now, around $43, 43.5, and we're going down a little bit and up a little bit to sell. We're taking in the expected move for this week, okay, and we're buying twice as many in March, which is 4 weeks expiration from here, okay, and of course, if we get a big move, either way, we're going to get paid. If it stays inside of that range, we're going to be selling that 46-41 every single week between now and March the 16th or March the 15th. Okay, so we're going to make money on this trade almost no matter what. Okay, it takes time, it takes patience, it has to set up your rolls, and the first thing we do is gotta get filled on. But again, this is a $566 debit with no spread risk. Okay, it's almost like your straddle type of trade. Okay, it's not right at the money, but I could do a straddle as well, which if I go back here real quick, this trade Bubba was a straddle, buying a straddle in the future and selling a straddle weekly. Okay, but again, so here is a trade, and if you understand options, you've done this here. This trade is open, is neutral. Okay, it is basically a neutral trade that will take advantage of a move in either direction, but will also take advantage if it does nothing. Okay, I understand time spreads, but what are your? I'm buying an extra call and an extra put. Okay, so I'm basically have on 2 1-by-2 ratio spreads. So I'm accounting for a big move. I know there's earnings coming, so I'm accounting for an earnings move, but I know that even if I don't get the earnings move, that I can sell these weeklies, cover and resell, and I'll be able to cover my net debit cost. That's the weighting. The outsides are weighted. Does that make sense? Okay, and here is another trade for earnings. Again, I like to do a lot of earnings trades. Okay, now this is a little bit different. The last one I showed you was a double calendar. Okay, I'm buying a double diagonal, a weighted double diagonal. Okay, but I have a little bit of risk. Okay, although my debit is only $10. Okay, my risk is actually $15, $1,500, $1,510, because I have a $5 strike risk on each side. I can only lose it once, okay? But there is a strike risk on either side, okay, of $5. So my debit becomes 1,010 plus 500, okay? So, but I'm willing to take that risk because again, that keeps me within the expectation of movement, which is again, the only evidence I can make or keep is to have what the option market is pricing in, okay? The expectation of movement, okay? So I can only know what they're telling me based on what the options are priced at, okay? And right now I know, so we're going to short, we haven't done it yet, but we're going to short the 232.50, okay? The stock is trading at 240, okay? So here is the 240 straddle, okay? And that is trading at 1160. So I'm just outside of range on either side, okay? But that will give me enough premium to sell that next straddle. And I can base on this premise right now that the 250, the 250, 230, okay, is at 452, okay? So if we do the math, okay, I get 452 a week approximately, okay? If it stays inside the range, okay, and I click 452 times 4, that's 1,800, okay, for 1,010 worth of risk, because if it stays in range, it means it's not going outside of 230 or 250, okay? So I'm going to collect that way. That's how I do the math to calculate if I want to make that trade or not, okay? And then of course, there is the big move that can come because there's an earnings play coming in here. And let's say the stock goes to 200 or goes to 270. Okay, I'm going to get paid on the extra option that way. And the interesting part is it can still come back down and get back inside that range after I collect and I roll up my extra callers, sell it. Okay. So you sell high volatility. I do this regularly. Okay. But I do use a lot around earnings as well. If the trade makes sense and there's not too much expense, because again, I have to account for everybody's account size. And not everybody has the same account size that I have. So I don't put on trades that are too much in value, because again, I want everybody to be able to participate in all the trades that I put on. Okay. But yes, that's one of the things we do. We're selling the high volatility going into earnings, and we're buying out in the future. Okay. When you're waiting the longs, that offsets the theta of the shorts? Yes. Okay. It's basically a neutral trade. And remember, this trade reduces risk every single week, because every week you're covering the short options and you're selling a new set for the following week. So your highest risk is the day you put the trade on. And no matter what happens, that risk comes down on a weekly basis. No matter what happens, there is going to be an event to occur, whether it stays inside of the range, gets a little bit outside, you're still going to collect premium, or if it explodes one way or the other, you're going to get paid. These are extremely profitable trades. Nobody uses them, not many understand them, but fortunately I do. And that's what I teach, because again, this also helps us maintain a rather large position in something so that we are equipped and ready to handle movement in either direction of the market. And we don't have to be on the right side to start with. We start out with a neutral position. Okay. Now, we hear a lot about the zero DTE options. Are they here to stay, or are they just a passing fad? Well, I'll tell you this. I think that zero DTEs will be within the next 2 or 3 years. I think they'll be in every major option. Apple, Amazon, Google. I think they'll all have. Okay, because you know what is it? What do zero DTEs mean for the brokerage house? It means more commission, more expenses. Okay, more trading opportunities. Okay, again, I love them. I think they're great. Okay, again, zero DTEs, they expire. They're basically one day. They're almost, if you know what binary options are, they're almost binary. Okay. No, I like selling zero DTEs because again, I'm going to use the chart, and in fact, I do a couple of shows a week for Tradier, and of course, I talk about selling zero DTEs every day, because if I'm overbought or oversold, I'm going to sell call spreads or put spreads, and if I'm going to get 40% or 40 cents on my dollar, I'm very comfortable with that, because I'm very comfortable with the read of the chart. Okay, again, works very well. Okay, it's a very solid strategy as long as you're not taking naked risk. Remember, anytime you sell naked, you're exposed because you don't know what's going to happen. Okay, you got to have some protection. So to be successful, you got to have a plan. You got to treat this like a business. Okay, if you're not feeling well, there's no reason you have to sit in front of the machine if you're not feeling well. Okay, learn something new every day. Protect your trading capital. Study the markets. Risk only what you can afford. Develop a trading methodology. Know when to stop trading, and keep trading in perspective. Okay, again, you can't let it get you. Okay, you got to keep it in perspective. So if you'd like to join me, I know this is quick, but I'm almost out of time, so I have to get there. Okay, if you'd like to join me every Saturday morning at 9 Eastern, I do a webinar teaching. Okay, and give out new trades every single day. Every morning, I send out at least one update. Okay, tell you what we're going to roll to, tell you what we're going to do. Okay, I give you access to my Monday night strategy call, which is just general market commentary on everything. I go through about 40 stocks, and a lot of you people get to send in what they want and all the futures. Okay, I teach you how to use the options properly. And if you want to be a member, it's $99 a month or $1,000 a year. BubbaTrading.com/options or BubbaTrading.com/options year. Love to hear from you. And if you don't become a member, hey, good luck to you. Again, you can catch me all over the place. I do a lot of media. I do a lot of training, because this has been a very fortunate business to me. And I've done it my whole life, basically. After I quit my first job when I was 21 and told me to go scratch because they didn't want to promote me. I was too young. And in 1976, they could say you were too young. So you get away with it, not anymore. Okay. But again, it's a terrific method. It's a money-making method that keeps you in the game, and it will teach you how to use options properly. So if you'd like to come aboard, again, it's bubbatrading.com/options for a monthly, or bubbatrading.com options year. And anybody who signs up today who happens to trade futures, you can join me for a month as my guest as I trade 5 days a week for an hour. I trade at 9:30 to 10:30 Eastern every day, okay, with my members. And I will let you, any of you who becomes a member today, you can join me as my guest for a month. In the meantime, right on time. I put you right on schedule. How's that, big boy?
You're even ahead of schedule, and I want to go an extra mile for you. And me analyzing the trade you had in my head about selling the higher priced option and buying two of the lower, you basically have zero risk, and you make a small profit if it stays in your range. And if it has a breakout to one side or the other, granted the option sold loses, but the fact that you bought two, turns it into a winner. And it really looks like almost a no-lose opportunity. Bub, I don't know if you've got that patented, what it is, but I think I'm going to experiment with a couple of earnings plays myself and do what I'm going to call the Bubba spread on it.
I think you should, big boy. It's better than pocket aces.
Yeah, pocket aces are still only one pair and they can get cracked. Don't get married to them.
That's right.
But everybody here knows I'm a
Trade, you
big
get to
options.
reduce your risk each and every day or each and every week, depending on what you're using. So
No, it's brilliant. And I mean, I know I've used that word a lot today, but I'm a big options trader myself, and I love the leverage of zero DTEs, and have found a profitable niche and doing them myself. But great stuff. It looks like your service would be perfect for any investor, including those with limited experience, time, funds. I love the way that you keep things cheap, so even people with small accounts can participate.
I want everybody to do well. That's the thing about it. I want everybody to do well, which is why I have my high school program as well. So.
Me too, except when they're in a hand against me or in a trade that goes the other way of mine.
That's a different story. Then I'm looking to bury them, but that's not here.
Hey, thank you for making such a generous message.
For having me on, and thanks to all the audience. I appreciate you all. Thanks so much. If you have any questions, you can always email me. I'll be happy to answer them.
Hey,
thanks, Rob.
Thanks for being here. Thanks for making such a generous offer to our audience today. I loved your program for the high school students. That's something to be proud of too. God bless. Ladies and gentlemen, Mr. Todd Bubba Horwitz. You can learn more. I put both of his links in the chat box, or you can go to bubbatrading.com. He's truly a great guy with over 40 years experience as a trader. We hope to have you again, Bub. Have a great weekend, and happy Valentine's Day to you, sir.
Thanks, brother. I appreciate it. Have a good one, man.
Thank you. That brings us to our next presenter, who's very modest but somewhat of a legend in the trading industry. To name a few of accomplishments, he's the author of Trend Trading for Dummies and many other valuable trading books. He's also developed the Top Dog Trading 5 Energy Method plug-in stock for Metastock. He's given seminars at many wealth expos and traders expos around the world. Here today to present trading pure price action like the pros is Dr. Barry Burns, founder of Top Dog Trading. Welcome back to Traders Corner, Barry. It's always an honor to have you on the show, sir.
Well, thank you so much. Let's test our technology here. I want to make sure, first of all, I'm not getting feedback, so I'm going to change my speakers. Okay, can you hear me and can you see my slide?
I've got your splash screen up, can hear you loud and clear, no feedback. And I'd like to throw in an extra thank you. I've gotten some of your advertisements where you are offering the rubber band trade. Great strategy.
Oh, thank you.
Welcome.
Thank you. Yeah, that's the way that we operate here at Top Dog Trading. We totally understand that there's all kinds of offers out there, all kinds of teachers, and there's many great ones. There's no one that is good and all the rest are bad, that's for sure. And I've learned that in my journey, that there's many different ways that you can trade profitably. But, for the new person out there, they just don't know. It's hard to evaluate. So to buy one course and then buy another one to try to find out which one's the best for you, boy, that's a tough road financially for people to go. So the way we decided to do it was just give away one of my favorite trade strategies, the rubber band trade, that I still use every day personally. And just give it to people for free and let them try it. And people also get access to me if they have any questions about it. And that way it's black and white, no money up front. They either make money or they don't make money. If they do make money, then, frankly, for full disclosure, they usually come back and buy something else from me. They don't have to, but it starts a good relationship. And if they don't make money, well, then they traded on a simulator demo account, and they didn't lose anything. So it's always about results, and we just want people to get results and without risking anything up front. So yeah, that's our little business model, if you want to call it that. But thank you for that acknowledgement. I appreciate that very much.
That's all right. Very admirable. Go ahead with what you came here to do today.
All right, let's rock and roll. Hoochie coo. Yes, that's how old I am. Okay. So today, let's see, I got 45 minutes. Well, I've got 41 minutes now. So how to trade pure price action. So we're going to start with just the basics, and then we're going to go to intermediate level, and then I'm going to finish in advanced level, all in 40 minutes. So whatever level you're at, I've got you covered today. And so it's going to be, we're going to move right along. But what I'm focused on when I talk about trading pure price action is the price bars and the logic, what I call market logic, behind those price bars. So first of all, important disclaimer at summits like this where we have many different speakers. I know that people come and go throughout the event, so I just want to post that up there. I'm not going to read through it all, but I do want to just say very important that you read these disclaimers. The regulators require that we post these. That should be your first clue of how important it is, and it really is. And I totally understand it's not the most entertaining language, but it is part, and don't think of it as just legalese. I find that a lot of people just dismiss it. That's just legalese. No, it is where education begins. And even those of you who have been trading for a while, really important to go back and read these disclaimers periodically, just to keep you rooted and grounded in the truth. Another way of saying it is this is the anti-hype. This is what the regulators are saying. Keep this in mind. So very important for that. So there's my ugly mug. Again, I'm Dr. Barry Burns, owner and founder of Top Dog Trading. I'm a published author, wrote the book Trend Trading for Dummies, part of the famous Dummy series of books published by Wiley & Sons. Keep getting Reader's Choice Awards from Stocks and Commodities magazine. Very proud of that because that's voted on by real traders, people like you, every single year. I've helped other authors with their books and work with brokers, exchanges, software companies, on and on it goes. I'm not going to spend a lot of time talking about myself here, but I do have some credibility in the industry for sure. My YouTube channel is very popular. Actually, we've gone over 100,000 subscribers now. This is a bit of an old screen capture. So true to what we were just talking about, I like to begins people's experience with Top Dog Trading by just giving away free things. And one of the primary channels of that, actually my primary channel for doing that is on my YouTube channel. So go there, hundreds of free trading tutorials from, gosh, I think I've had that channel for over 10 years. And even the old stuff, I'm not proud of the video quality, but the content still holds up today. So go enjoy. I've got a podcast. Feel free to enjoy the podcast. So let's get right into the price action stuff. So we're going to start out with the simplest of the simplest, and then we're going to build it up. Okay, so we're going to start with the foundation and then add pieces. And I'm going to actually invite you to participate with me in doing some exercises so that it's not just a monologue. But I'm going to lay the foundation first, and then I'll invite you all to participate through the questions box here, and that back and forth, do some quizzes even, will help you learn. So one bar logic, let's see here. Let me do this. You know what, I'm just going to use the pointer instead of trying to bring up any of the fancy drawing tools. So one bar logic, this is the basic of the basic. So for those of you who know this, we'll go through this very fast. So basically, one price bar has four major components: the high of the bar, the low of the bar. Now this is a candlestick. So then the open is down here and the close is up here. So because this part is called the real body, because the real body is green, that's how we know that the top of the real body is where it closed. And then this part is called the wick, And that's how we know that was the high of this time period, whatever it was. So if it's a daily bar, that's the price action of the daily, open, high, low, close. 5-minute bar would be the same thing, but just during that 5-minute period. So this we would say is a bullish bar because the market price started down here, went up, 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 and then it came down a little bit, but it still closed near the high. So during this period of time, let's say it's a day, then during that period of time, that was a bullish day. Opposite when you get a red bar and it closes near the low. So notice again, we opened up here now because it's red. That means down here is the close. That's the low. And after all was said and done during this, now let's just use the example of a 60-minute bar. So let's say this is a 60-minute bar, and during this time period, during that 60 minutes, after all was said and done, rumors, gossip, people yapping on chat rooms, whatever, the market participants decided, nah, we're kind of bearish, close near the low. All right, now, next price bar, 1 bar logic is this. So now you'll see that that real body, the colored part, is very narrow range. And we had a wick that's really high on the top side. So what happened during this time? Well, the market opened here. There's your open. There's your close. We know that because it's green. So it closed above the open. But during this period of time, market went all the way up there, went all the way down there, and then closed there. Now, this is a bearish bar. And this is trick number, I don't know if I want to call it a trick, but it's where a lot of people get tricked up because they think, oh, green, red. Green is bullish, red is bearish. And it's not that simple. Do not get caught up in that trap. This is a bearish bar because the market tested all these price levels, went up here, and trades happened. Trades were consummated, trades were exchanged. But again, after all was said and done, by the time this period ended, let's say the day, the market participants decided, you know what? We don't think the market's worth any of these prices. So this is called, in market profile, they call this rejection of value. And so all these prices up here are rejected, and because those higher prices were rejected, the time period is bearish. And then the opposite. And by the way, I'm using the opposite colors here, very intentional to drive home that lesson. So even though this is a red real body, it's still a bullish bar because this rejection of value, this long wick, by the way, sometimes these are called shadows, wick, shadow, synonym. So if you see that term, means the same thing. So it goes all the way down here, tests all these lower levels, but before the market closes in this period of time, it closes up here. So in the top, you could say like in the top 25% of the bar. And so therefore, because all these lower prices were rejected before the market closed that day, it's bullish. So now let's go to 2-bar logic, all right? Building the foundation, got to start with 1. Now we go to 2. So first bar is bearish, second bar is bullish. So this is a bullish pattern, 2-bar price logic. See, I'm not using any of the flowery Japanese candlestick terms here. Nothing against them. I think they're actually pretty cool, but we're just dealing with logic of price action and how the market participants are evaluating the market based on the action of price movement. And the close is always the professional number. There's an old saying in trading that the open is the amateur number, the close is the professional number. So market went down, it was bullish this day. Bearish this day, sorry. Bullish that day. So reversal pattern, 2-bar bullish pattern. This one just the opposite, 2-bar bearish pattern. So we get a bullish bar, then a bearish bar. So put the 2 bars together, bearish pattern. Now, let's do a quiz, all right? Let's do a quiz. So, and by the way, if you get something wrong, don't feel bad. I'm not going to call out anybody who gets anything wrong, so nobody's going to be embarrassed here. In fact, if you get something wrong, I want you to be excited about it because that means that you're learning something. And god dang, that's why you're here, is to learn something, right? So if you got everything right, I'd be personally disappointed. So this 2-bar logic, what is the sentiment when you put these 2 bars together? Bullish or bearish? Go ahead and type that in. And let's see how you guys are coming along so far. By the way, this is part of also testing me to see if I'm communicating clearly. All right, so we've got, again, I'm not going to call out any names because I don't want to embarrass anybody, but I'm just going to, you know what, I will call out names just to thank you for your participation. So Chandu, Joseph, Rajesh, Kumar, oh my gosh, I'm so sorry. I hate when I mispronounce names, so I apologize in advance for that. Jim, Suba, Ryan, Thomas, Peter, Farouk, thank you all very much for participating. Major respect. It shows you're serious about your trading. So this 2-bar price logic pattern is bearish. And the reason it's bearish is because, yes, we started out bullish, but then this long wick up here, again, means we've got a rejection of all these high prices. And by the time this bar ended, the price closed way back down here. So it rejected high prices. People said, oh, you know what? No, I'm not willing to buy up there, not willing to buy there. Too expensive, too expensive, too expensive, too expensive. And so now the sentiment has shifted from bullish to bearish. All right, now let's try this one. What do you think about this one? Go ahead and type in your answers. Bullish or bearish 2-bar price logic. What is this, bullish or bearish? Go ahead. Yeah, Robin says, love watching Barry butcher names. Yeah, it's embarrassing. I feel bad. Hey, we got, wow, very good. All right, yay, I'm excited. I think we've got 100% correct answers on this. So John, Joseph, Pranaya, Farouk, Rajesh Kumar, Jim, William, Ryan, Suba, M. We do, Jurgen. Wow, very good. So it is bullish. Again, started out bearish. So, and then the market decided, okay, let's try these lower prices, oh, wait, no. And so, remember, when people are selling, someone's got to buy. So you've got to be able to have a buyer who's willing to take your price. And what's happening in the market exchange is that people are saying, no, I'm not going to sell to you for that low price. Nope, not going to sell. I want more. I want more. I want more. I want more. And so finally, the price comes all the way back up to here. So the 2-bar pattern is bullish. Lower prices are rejected. No one's willing to take the other side of those lower trades anymore. All right. Now this one, I won't do a quiz on this one. I'll just tell you. So this 2-bar price logic is neutral. So whenever we have a bullish bar and then a narrow range bar, so notice it's narrow range in both from the low to the high, and the real body is also narrow. So that's just a neutral bar. Nothing really significant has happened. It's not wide range from low to high. It's not wide range in the real body. So when we have a neutral bar, then the previous bar's sentiment carries over. It just sustains. We're still in a bullish market. All right. So now let's do another quiz. So now we're getting into multi-bar patterns. Let's bring it out, get a little more intermediate. This is the intermediate part of the presentation today. And I'm not going to go through all of these because I only have 45 minutes total. So let's just do this first one. So prices come down, 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 down. Then we get a green bar here, obviously. So my question for you is this. And the way I have it worded here, does this green bar validate or invalidate the 2-bar price logic? So I'll also say it this way. I'll reword it in a little different way. What does this green bar tell us? Let's say we're on the hard red edge of the screen. What does this green bar tell us as far as bullish? I'll make it multiple choice. Bullish, bearish, or neutral? There we go, multiple choice. Go ahead and type it in. Okay, oh, people already are doing it. Fantastic. You guys are ahead of me. So, very good. Good point, Erez. Good point. Good point. Okay. For time's sake, I'm not going to read through all of the names, but I'll LB, thank you. Joshua, thank you. I'll just do a few new shout outs there. So it is neutral is the correct answer. And it is neutral because remember, we're not focused on red or green. So for it to be, if this were to be bullish, we would need it to be wide range, and we would need it. Now we do have it closing toward the top, but again, remember the last slide, we talked about neutral bars. Neutral bars are narrow range from low to high and from open to close. And it's actually inside this bar. So if I drew a high off of this red bar and a horizontal line off the high of that red bar and a horizontal line off the bottom of that red bar, this bar would be inside of it. So no significant movement. So the markets, in order for there to be a significant signal, there must be a significant movement. So you've heard of the signal noise ratios. So if there's nothing significant going on, narrow range, then it's just neutral because there is a noise to the market. Now, over here, this is a bearish bar because wide range from high to low, and it closes near the low. So that caused a reversal. Okay, boom, neutral, 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 boom, keeps going on. Now here we've got a bullish bar, wide range again, significant movement up from low to high, close near the high. Okay, now let's go do another quiz. I'm watching my clock here pretty closely, but we're doing good with our time. So now I'm going to make it harder for you. Okay, we're going to continue to increase the difficulty. Don't you love that? But we want to get more advanced, and I made it easier for you because, well, I let you see on that last chart what was happening afterwards. Oh, by the way, that's another point I wanted to make. I forgot. Another thing to look out for as you're learning to trade is that some people might say, oh, this is bullish, without realizing that the reason they're saying it's bullish is what's called forward-looking bias. Because you can see what happened afterwards, it creates a bias on in your mind. And you can then kind of go back and justify it, oh, green or red to green, and the market went up. And even though you might not be thinking that, subconsciously, you know, obviously it's there because you can see it. So this is why when you're studying anything, price formations, indicators, anything to do with trading, and you're analyzing charts and trying to put together a good trading system, if you can see what happens on the chart after a pivot or a low or a high, that can create a forward-looking bias. It's not objective. It's kind of the difference between, well, it's why in science they do double-blind studies. Okay, so when you're trading and you're creating a system, you kind of want to use that double-blind study type of scenario. So that's what we're going to do now. All right, so now we're blind to what happens afterwards. So the question here is, based on price bar formation of this bar right here with the blue arrow under it, what would you expect to happen next? And again, make a multiple choice, go up, go down, or go sideways. All right, what do you think? Type in your answers. And I kind of feel like I'm on a trading game show. You know, that's not a bad idea. That'd be kind of fun to have a trading game show, wouldn't it? Win prizes. Okay, let's see what kind of answers we got here. Again, I'm not going to call out any names, except I do see some new people typing in, so thank you for that. I'm just going to read the answers without the names. Bullish, sideways, up, bullish, bear, greater than, down, up, sideways, goes down, bearish, go up, bullish. Okay, by the way, the reason I did that, and again, I'm going to do it again. Okay, listen to this, it's very important. Sideways, bearish, sideways, go down, bullish, sideways, up, bullish, bearish, up, sideways, goes down, bearish, bullish. See all the different answers? I mean, it's pretty much evenly split. We do not have a consensus among the people in the room right now. And this is another subtle lesson, an incidental lesson in this presentation. This is what makes a market. People looking at the exact same chart and having completely different opinions. Because remember, to buy, you got to have someone sell it to you. To short, you got to have someone to take the other side of your short. And then sometimes people just stay out of the market. So we've got pretty much even distribution of different answers of all three multiple choice. Interesting. So what is the so-called correct answer? And let's see what happened here. All right. So it's all nice and well to say that, oh, okay, the market went up. But was there any, again, logic, reading the price bars, that would have indicated that? And the answer is yes. First of all, as it says here, we had a gap. So it gapped down. Now, gaps usually eventually close, but they don't always close right away. Sometimes you have what's called a gap and go, where the market will gap down and then it'll keep going down. So the gap is one piece of evidence, but it's not enough to trade with. So it's one piece of logic, but not enough. What we need is some other price action indication that the gap is going to close. When is it going to close? Is it going to close, an hour after the market opened, or is it going to close, the next day? So we watch price action. So it gapped down, went sideways for a little while, came down, came back up a little bit, and then this is the key bar. Obviously, I've got my little blue arrow there. And what do we have? That long wick again. Remember that long wick indicates rejection of value, meaning they tested these lower prices. These lower prices were traded, but there weren't enough people there that were willing to take these lower prices. So people were bullish. And secondarily, it came down. Why did it come down to here? Because of the support of the first pivot low of the day. So they tested that support level. They said, nope, we think the market's worth more than that. And that's what it's all about, is how does the market, when I say market, by the way, I'm referring to the market participants, the people trading. How do they value the market? It's all that matters for whatever reason. It could be earnings, it could be rumor, it could be news. I mean, there's all kinds of reasons, but it all comes down to how do people assimilate all that information, decipher it, interpret it, and then put their money on the line. And it's all about follow the money, honey, because people will interpret the same information in different ways. So that's all we're doing. So again, gap close, okay, that's one piece of evidence. First cycle low, comes down, rejection of value at that support, and that's what tells us that most likely, yes, it's going to close the gap. Now, what about this one? I'll do this one as a quiz now that you've got that information. What do you think? We're on the right side of the screen again, hard right edge of the screen, as we say. I'm not letting you see the future. So what do you think? Do you think the market's going to go up, down, or sideways? Go ahead and type it in. And, yeah, Piranha saying be more helpful with volume. We're doing pure, I agree, volume is helpful, but today we're only focused on price action. So only so much I can cover in 45 minutes. However, stick around. You will be surprised, or you'll be delighted, because I'm going to bring you I am going to talk about volume a little bit, okay, at the end, with the most advanced part of what I'm going to be teaching today. Okay, so now we've got, okay, very good. So excellent. All right, so pretty much everybody is saying down on this one. So I'm loving this, because as we're going through these quizzes, y'all are getting better. You're getting the right answers. So you're putting together these pieces, these blocks that we've put together. So actually, yes, we have resistance here. I didn't draw this resistance on the last chart. I did that intentionally, right? Because the chart will not draw resistance for you automatically. When you see it, it's going to look this way. So you have to be the one who identifies that and then draw your line and say, oh, okay, there's resistance there. And we've got a engulfing bar, big wide range red bar, closes near the low. And there we go. Awesome. Now, what about this one? What will happen next and why? Like this bar right here on the hard red edge of the screen. What do you think? Type it in. And we're going to go through these here pretty quickly right now because I think you guys are getting the hang of it. Okay, very good, very good, very good. All right, and pretty much everybody said go up, and you are correct. Now again, you'll notice that I've added one more element each time that we go through these quizzes. I'm adding another element. So I added resistance. In the last chart, I didn't really show that. I didn't draw the line. It's there, and it's up to us as traders to recognize it. And one more thing I will say, resistance levels and support should be drawn off of the real bodies of the candles. Because remember, if you draw it up here, this price was rejected by the market. So the real value of the market is the real bodies. And that's why when we go back here, you'll see I drew the resistance level off the real body. And on this big wide range bar that was on the hard red edge of the screen before, it sliced through it like butter, and it closed above resistance. If you look over here, we see the opposite. Again, wide range red bar, but the difference on this one is it stopped at the support, the previous support level, didn't close below it. And so wham, slammed its head in there. Little bit of attempt to go back down there, but no, that was it. That support held. Even though there's a lot of price action, hard price action selling into it, but again, support. And people tend to buy off support, short off resistance, and take profits into support and resistance levels. So we don't want to buy into, or we don't want to short into support. We don't want to buy into resistance. But once we close above it and slice through it, then, okay, cool. Now we got clear sailing. So now let's talk about volume logic. And here we go. I told you we talk about volume, so now you got it. So we're going to use the 5 energies, and there are different aspects to volume. We've got large volume versus small volume. You want enough volume, but not too much volume. And we don't want just large volume. And by what I mean by that, and this is why I didn't put the volume bars on the bottom of the chart, because I wanted to cover this part of it first and get you to the advanced level of volume, because just because you have a large volume spike is not enough. What really matters when you're combining volume and price action is not if it's just large, but if it's smart volume. And by smart volume, I mean the professional participation. So professional traders, well, by definition, that's our profession. We trade as professionals to make money. So you could call it the smart money. And that's the money we want to follow. So lots of orders could come in, lots of shares, lots of contracts, lots of, whatever you're trading, whatever the word would be for whatever market you're trading. But that could be a lot of retail traders. And most retail traders lose money most of the time. So even though there's a lot of volume of retail traders, we don't want to trade that because they're almost always wrong. So we want to then compare, and this is the ultimate, and I'll show you exactly how I do this. The technique I use to do this is now to actually compare professional volume versus retail volume. So ready? Hold on to your hats. So now we're going to use a different tool. Now we're going to bring up what's called the time and sales tool. And different trading platforms, whenever I talk about this, I always get a lot of questions about how do you find this, where is it located, and all of that. So you will have to ask your particular charting platform about this because it varies from one charting platform to another. And just contact their support team or go to their knowledge base or their discussion boards or whatever, or their tutorials, and just ask them, hey, do you provide a time and sales module? Most of them do, by the way. And if so, where do I click to get it and download it and all that kind of stuff? Okay, so I'm going to teach you how to use it, or how at least I use it. So the first thing is I edit it. I right click on it and I edit it because by default, it will bring up all trades. So well, let me explain the columns first of all. So this column is just time. So the time the trade took place. Right, so it's pretty simple. And you notice it goes down to the seconds. Now the trade type. So by default, it'll bring up trades, bids, and asks. I don't want to see the bids and the asks, so I right click on the window and I just uncheck bids and asks because I only want to see where real money was committed, where it was traded. Because again, people are very serious about their money. So I don't give a mouse's left patootie about a bid or an ask that doesn't get filled. But I do give a mouse's right patootie about, sorry, I'm a dad, so by California law, I am required now to do at least one dad joke an hour. So there we go. Now I've kept that law and can't turn me in. But anyway, in all seriousness, I want to follow the money where people have committed and they're serious. So that's why I changed type to only trade. I don't want to see the bids and the asks. And then here's the prices and then the size. Now with this is very, very, very important. So what do we got here? We got the NASDAQ 100 futures contract. So this is where you can edit the number of contracts in a trade. So each one of these rows is one trade. One person placing a trade, an individual. And so this is different than like a level 2 or a level 3. This is not those. Those show cumulative volume, and it's different than the volume bars on the bottom of your chart. Again, that shows cumulative volume. What I'm doing here is it's like a microscope, and I'm zeroing in on individual trades. And so what I've edited this one down to is I only want to see trades of one individual, or it could be a company or an algo or whatever, that has a trade of 20 or more contracts. See, there's none less than 20. If I didn't edit this, it would mostly be ones and twos. And why am I doing that? Because I want to see the professional money. Most amateur traders are not trading 20 contracts of the futures. Most amateur traders are trading 1 and 2 contracts, maybe 3 or 4, but not 20. They don't have big enough trading account. All right, so now that we've done that, let me show you another little tip here, which I love. And again, certain trading platforms have this functionality, others don't. But in some of them, like this is, I think this is NinjaTrader on the left, they have it. And I think they call these block trades. I don't know, different term, again, different terms on different trading platforms. But what we want to do is we want to see these trades plotted as volume bars, what you normally think of as volume bars on the bottom. But you notice most of these price bars don't have any volume bars below them. That's because I'm not plotting the volume, or at least all the volume. I'm really just plotting the block trades. So this is showing me where just the big individual orders are coming in. And that means high probability, these are the professional traders, the people with big trading accounts. And what do you notice? What you notice is, oh, a lot of the professional traders, the smart money, they're getting in early. They're not coming in during the middle of the trend. And then lots of big orders coming in here. This is probably where they're getting out. The trend is your friend until the end. And so this is a hallmark of professional trading. We always get in before the amateurs and we don't overstay our welcome. Now, This is what I promised on how to compare retail trading or retail trades versus professional trades. So you'll notice I've got 2 time and sales windows up now, one on the left, one on the right. Prices are the same, 1205.75, 1205.75. So people are trading the exact same price. Now let's go to the one on the right. So on the one on the right here, let's see, on this one, looks like I put a minimum of 10 contracts. Okay, so 10 contracts. Again, you can change that to whatever you want. So this one I did 10 contracts. And it's not going to show me any trades of anyone who traded less than 10 contracts. So somebody's got a large enough account to do that. Now on the left time and sales window, I did just the opposite, and I filtered it to say I don't want to see any trades over here that's anything more than 2 contracts. So this is going to show me the people of small accounts, the small money traders, which again, on average is going to be the retail traders. And what I'm looking for, again, I'm not trading this constantly, every minute of the day, but I'm looking for this disparity. I'm looking for, when is there a lot of professional buying, green? At the same time, there's a lot of amateur selling, red. So 2 time and sales windows, one set to only show small size, the other only the large size. And I'm looking for that imbalance. Professionals are more often right than wrong. That's why they make profits. Retailers are more often wrong than right. So here I have an X-ray, that's a good term, an X-ray into what the retailers are doing and versus what the professionals are doing at the exact same moment. Pretty cool, huh? Now, there's one more step and some, again, each trading platform has its own variables as what it can do, its functionality. This one is NinjaTrader, and they have even another level you can go. And I use NinjaTrader for this personally, by the way, but there's others that you can use. But this one is really, really great. So now what we look at is I can use a couple of different colors. I mean, we can get really macroscopic if you want to. So you've got your green, and then you got lime green. And these colors are customizable. So what does lime green mean? Lime green means that they are buying above the ask. So that's very, very aggressive buying. They're not just buying at the ask, they're buying above the ask. They really want that trade. And then down here, this one's a little harder to see the distinction, but we've got red and then we've got magenta. And so magenta means that they're selling below the bid. So a very, very aggressive sell. Now, if we just look at the big picture here, okay, this one we've got, let's see, minimum contracts is 20. And this is what I call a Christmas tree. And I just call it that because it's pretty, pretty evenly balanced between red and green, okay, for lack of a better term. So I'm not seeing any, and when I put my money at risk, I want to see a real imbalance, right? A very clear imbalance. I don't want to say, oh, well, there's 19 greens and there's 18 reds. No, that's just mixed. So this is not a clear imbalance. This is very, very balanced. So then I put in another column, and these are, I just put in the term block. And so what I can do here is filter them at another level. And if you notice, all the block trades have 50 contracts or more. So in this column, I allowed it to show me anything 20 or more, but in this column, I'm requiring it to show me only those that are 50 contracts or more, and then it puts the word block, 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 block. Notice all the block trades, wow, there's one for 100. Somebody's got a lot of money. All the block trades, 100% of them, red. So now we're taking it to the next level. We're saying, yeah, but what are the really, really, really big players doing? Oh, that's homogeneous. That we do have a clear, it's 100%. It's 100%. And I'll give you one more example here. I've only got 2 minutes left. So for those of you who like to trade breakouts, here's an extra tip for you. So here we've got the market just channeling. Okay, we get a little breakout. Question always is this going to be a breakout or a fake out? So here is a tip. Don't just look for big volume spikes. Remember, that's just the number of contracts, shares, or lots. Could be amateurs, could be professionals, could be a lot of retailers all jumping on because, you know, somebody in a Discord group said, buy, 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 and they're pumping and dumping on you. We don't know. Or it could be legit. But if you use the breakouts with block trades, that tells us, oh, big money traders are buying this, and it's more likely to be a successful breakout to follow through. So there you go. I'll take my last 60 seconds and just offer my rubber band trade to all y'all. I'm not selling anything today, by the way. If you want to buy anything from me today, you're forbidden. You're not allowed to buy anything from me today. I forbid it. So, but what you can do is get my free rubber band trade strategy. As we said at the beginning, I love to prove myself to you first, and I prove myself to you by giving you a trade strategy, having you make some money. Obviously, please only trade it on a demo or simulator first. You have my email address here, barry@topdogtrading.com. So when you get it, if you have any questions about it, feel free to email me with any questions. There's 5 videos that come with this. It's actually a little mini course. And just like I did today, there's some interactive quizzes. I find that interaction is very, very important. With this, you'll also get my cycle indicator. There's a free webinar that's about 45 minutes also, so that's separate, but it's free. It's also free, and this teaches you how to time your entries. So yeah, the link is already in there. So just go to topdogtrading.com/free, and my gift to you. I hope you found the presentation helpful, and over and out.
Barry, if you'd like another pat on the back, I know I say when I watch presentations over and over, I always get something new. Those 2 windows showing the big orders and the institutional money versus the retail traders and the small money, you hit one out of the park again in my book. We get such great feedback from our audience regarding the services and the educational material you provide to the trading community, and most of it for free. Bear, you're truly a great mentor who loves what he does. It's always an honor to have you on Traders Corner. Ladies and gentlemen, Mr. Barry Burns of Top Dog Trading, and you can find him at topdogtrading.com. I did put the link in the chat box. Bear, I hope you have a great weekend, great Valentine's Day, a great everything. Please come back and see us again.
Thank you so much. I sure will.
You're very welcome. That is going to bring us to our last 2 presenters of the day. And as you can guess, as always, we save the best for last. Up next is a professional trader who's been trading and mentoring for over 13 years. He has a Reddit verified performance and has consistently maintained a 90% win rate over the last several years on trades he takes and is giving in his options live trading room, and is one of the most successful options alert services in the industry. His calm and confident demeanor lends to a trading environment that's stress-free. Ladies and gentlemen, here to present how to leverage Heiken-Ashi candles is Mr. David Wyse of Right Line Trading. Welcome back to Traders Corner, David.
Hello, and thank you. Thanks very much. I appreciate the nice introduction.
Oh, David, we know I'm a fan of yours as well.
I appreciate that. And I know it's getting late in the day, and I've been listening to some of the presentations, and I probably watch more of Barry's videos than anybody else so over the years. But again, I appreciate that. Thanks very much, and I'll try to get started. I want to try to squeeze this into 45 minutes if I can.
You're very welcome, and go right ahead and please do.
Appreciate it. Thanks a lot. So again, my name is Dave Wyse, and I have a Compass Option text alert service and a live trading room, and I've been doing this for about almost 14 years now. And just to give you a quick, I know a lot of people like to do introductions of themselves. I don't like to talk about myself that much. You know, I'm not a professional presenter. I'm a professional trader. I've been doing it for a long time. But one question I always get asked is, when did I decide to go from part-time trading to full-time trading? And it's kind of an interesting story. This is about coming up 14 years ago now. I was working in IT. I had been working in IT for many years. And about 14 years ago, my boss who I was good friends with, actually called me in and told me that business had turned down and he had to lay me off. And this was about 2 weeks before Christmas, actually, when it occurred. And I said, fine. I had been trading part-time. Looked like a nice opportunity to do a little bit of trading, even though it was the end of December, which wasn't that great a time to be trading. But I had a setup at home, so I started trading full-time. I had been, like I said, been trading part-time. I started trading full-time, and I had a really good January. And then February was going along even better. And about midway through February, my ex-boss called me and said business had turned around and things were looking up, and he wanted me to come back to work. He said, you can come on back, start Monday. And I told him I really appreciated the offer to come back to work for him, but as it turned out with the trading, I really couldn't afford to work for him anymore. And that's how I started becoming a full-time trader. And it was not really a plan. I had been doing it for a while, but it's an interesting story, and I like to share that that's kind of how I got to where I am right now. So we'll get started here. And again, I'm gonna talk about my alert service and the room that I have, the Compass options room. But I'm going to spend some time on Heiken-Ashi candles. I have a lot of interest in that. I use them all the time, so I wanted to spend some time on that and present some educational materials around that. So we'll get started here. Again, we want to do the usual disclaimer that we have to do. All signals and trading opportunities we provide are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors. All right, so we'll move along here. By the way, if you have any questions during the presentation, I'll try to monitor the questions, but if you have questions and you need somebody to get back to you, if you just put your name and number in the chat box or in the question box or your Skype username, Rory from Right Line will call you back. No pressure, just to answer your questions. All right, so we'll move along here. And this is just kind of a SPY super system. It's one of the methodologies I use. We do track institutional money flow. This is the key to finding high probability trades. And again, this is just a graphic of the alert service that I provide. I call it Take Trades on the Go. You get an SMS alert to your phone with all the information on the stock or option that we're taking. And I'll go over the details of that as we get into the presentation. All right, so the first thing I want to cover, and this is really important, I do this every webinar I do, to make sure that traders understand what drives markets. A lot of retail traders, and this graphic shows these little marbles here. These are the retail traders such as myself and probably most everybody here. And we, as retail traders, we do not have the ability to move the market. It's impossible. When the retail traders are in the trade and the institutions are not in the trade, you get nothing but chaos and chop. Market chops all over the place. There is no defined trend. Now, when the institutions jump in, that's when things change. The institutions are the people or the computers basically that can move a market up or down. Any stock, any index, they can move it. And this is people like Goldman Sachs, JP Morgan, HSBC, and then, but it just isn't the banks like that. It's also hedge funds. There's hundreds of hedge funds that have billions of dollars to invest. They can move the market. Vanguard, T. Rowe Price, mutual funds, billions of dollars that they are putting in and out of the market all the time. And then big pension funds. So for state pension funds, state workers pension funds, big hospital chains pension funds, this is what makes up the institutions, and this is what moves the market. So this is what our job is as retail traders, is not to try to beat the institutions. Our job is to find out what the institutions are doing and join them. I mean, that's really the most critical thing that we want to do. And that's what I focus on in my room and with the alert service. This, I just kind of wanted to just throw this up. I use a charting program for technical analysis called TC2000, and then I'll show you I use a Thinkorswim for the compass system. But this is as a week ago. This is the SPY, the SPY daily standard candles. You can see we were breaking out here. This is a week ago Friday, but I just wanted to show it to you in presentation of these are standard candles, and I want you to see these are Heiken-Ashi candles, and this is what we're going to be talking about. In Heiken-Ashi candles, I'll go over all of the benefits to Heiken-Ashi candles and how you can use them in trading to improve your trading. But I just kind of want to give you an example of it before we get into this. So again, that's the SPY from last week. You can see what it did here, moved up from here, and we know what it did this past week. We put basically in new all-time highs almost every single day. And Friday, we closed at the all-time high on the SPY. All right, so I do have in the room and for the alert service, I have specific rules that we try to trade by. First one is we trade the best and skip the rest. And this is an easy way of saying what I'm looking for is the very highest probability trade setups to trade. Those are the only ones I take. I don't take trades that I considered minimally beneficial. I'm not taking something that I might have a small edge. I'm looking for very, very big edges in the trades that we take so that we're going to have a much higher win rate. And the other thing, and I say this in the room almost every single day, and a lot of people, this strikes them as funny. Our objective is not to make trades. Our objective is to make money. That's why we're trading. We're trading to make money. We're not trading to be right. We're not trading to try to be better than somebody else. We're trading to make money. So that's our objective is. We make trades to make money, of course, but we only do it by taking the very, very best. All right, so as profitable traders, profitable retail traders, we need an edge over the rest of the retail traders because remember, we're taking money from other retail traders. We're not taking money from institutions. So what we have at edge here, we have 4 different edges. I use the compass system, which I'll briefly talk about, but this is the methodology, a system that lets me know whether institutions are in a trade or not, whether they're short or long, or if they're not involved in the trade. And the second thing we use, once we know the institutions are in the trade, we trade stocks that are relative strength and relative weakness. That doesn't mean RSI. That means a stock that's strong versus the SPY, that's outperforming the SPY, or weak versus the SPY. For example, the SPY is moving sideways or just bouncing around, and the stock is moving up every 5-minute candle. That's got relative strength. That gives you an additional edge to the trade that you're taking. We trade with the market trend if there is one. The market, you know, the market, about 75% of the stocks follow the market. So if you can be trading in the same direction as the market when you take a trade, then that's going to add to your edge. So if the market is trending up during the day, you want to focus on longs. If it's trending down, you want to focus on shorts. And one other thing is to buy, this is actually near support or sell near resistance. So try to get into a trade when it's going long, when it bounces off support and heads up, on going short when it bounces off resistance and heads back down. That way you're not chasing a stock up multiple green candles or down multiple red candles. You can try to avoid what's called FOMO, or fear of missing out. So you're not getting into a trade near the top and having it reverse on you. So that's important. So this is basically the main edges that we use here. This is just kind of a graphic of the compass system that I'll briefly talk about, but this is how a methodology or a system that I use to find high probability trade setups, knowing the institutions are in there. So it allows us to see when the institutions are in there and then sidesteps the ones that are not. It's really important to avoid trades that are not as probable winners for you. It's very important to skip those. And this does this by identifying when institutions are driving the move and when they're not. And again, it's visually, you'll be seeing the charts when I'm showing examples of our trades. You'll see what the chart looks like, but it's all done visually. So even a new trader can actually understand whether institutions are in the trade or not in the trade. All right. So again, we're trying to get an edge over the retail traders. Remember, that's what we're trying to do here. So we only want to trade the very highest probability trade setups. So we're only taking trades that are being driven by institutions. And we're trading stocks that have relative strength or relative weakness versus the SPY, or the Qs if you're trading tech stocks. And we want to trade in the direction of the overall market. And so how does it give us an edge? Well, our trades are going to be supported by the institutional buying and selling, obviously. The stocks will be outperforming the SPY, and the stocks are moving in the direction of the overall market. That's a big deal to have that. Okay, so moving forward here, this is basically a funnel, and I did videos on this, but this is a funnel of how to find high probability trade setups. What you do is take a stock you're looking at and run it through this funnel. If it comes out the bottom, then it's a good high probability trade setup. The first thing I look at when I look at a chart is I look to see if the daily chart and the 5-minute chart are aligned. If I look at a 5-minute chart and I think the stock looks good, bullish, but I look at the daily chart and the daily chart is not bullish, it's bearish, then I'm not going to take the trade. I need to have the daily and 5-minute chart to align. And the reason for that is I want to be able to stay in the trade during the day if it goes against me, or overnight, or even for a couple of days if I want to. And the only way I can do that is if I've got a daily chart that is aligning with the direction I want to take the trade. Then a trade with a trend in both stock and market. Again, is the stock bullish and is the market bullish today? If they're both bullish, then that's another check mark. That stock is now becomes even a better candidate. Then you look at my compass indicators to make sure the institutions are in the trade. If they're not in the trade, it's out. I can't take it. If they're in the trade, I move to the next one. The next one is, okay, does this stock have relative strength or relative weakness to the market? If it does, I look for is it at support or near resistance? And if not, I'll put an alert on it so I know that everything else is intact. When it gets to a support or resistance levels, I want to get into the trade. Now you can run 5 or 6 stocks through here, and you may get 2 or something that come out that look good. But this is going to eliminate a lot of trades that you might take if you didn't have that funnel set up. All right, so we'll move along. And again, this is what the funnel method is for highest probability trades. I'll skip over that. Basically, it's just what we just went over. There's a few other details in there. One of the key things I always focus on in the room is to have patience. It's really important to wait for trades to come to you, wait for setups. Don't be antsy to make trades. So a lot of times it's best just to sit on your hands. Sometimes not taking a trade is the best trade that you can take. All right, so these are the strategies that I use in my Compass Options room and on the alert service. So if you're an alert, this is going to be made up of one of these type of setups. Typically straight calls and puts. We do a lot of straight calls and puts. I also use debit spreads using weekly options expiration, and I have videos on all of this, but this is one that not a lot of people use, but I've had really good success with it, and I've got not back tested, but I've looked at all the results that I get from my trade log, and I know what this is about an 87% win rate on these. Over earnings, the only way I trade earnings is I trade what's called time spreads. The calendar spreads. And all that is doing is capturing the volatility crush when the earnings are released. The market makers jack up the price on the options prior to earnings because they don't know how far the stock's going to move, and they don't know what direction. So how do they get around that? They protect themselves by increasing the volatility, which raises the price of the option. This method here actually captures that volatility crush when the options, when the earnings come out. In fact, we just had one of these on Friday that we got the 50% win on, so that was pretty good. I also use a strategy called the weekly ATM strategy. This basically is selling puts week after week against a stock that's neutral to bullish, and having a longer term put out in time to protect you against that. It gives you basically a spread, but with the long put expires weeks or months later than the short puts that you're selling every week. So it limits your exposure, and it's really a good strategy on neutral to bullish stocks. And we also do credit spreads to capture premium. We just do these over usually 3 or 4 weeks. We have a credit spread on Netflix right now that's working out really well. And the only other thing I do inside the room that I don't alert on is what's called the SPY super system. This is when we have a setup that I see on the SPYs or the Qs where it's bouncing off support or bouncing off a resistance to the downside. The Compass system is telling me that institutions are also driving this trade, and I also know that the market internals are in our favor. A lot more stocks moving up, for example, on bullish than stocks moving down. But these I just call them out. They're typically only 3 or 4 candles, and but it is a method a lot of people that trade the SPY like to use. All right, so let's talk about the alert service first of all. The Compass Options Alert Service. It's basically designed for day traders and short-term swing traders. That's obviously who would get this. This is not an investment strategy. This isn't for long-term investors. This is for folks who want to do day trades and short-term swing trades and not worried about what the stock's going to be doing 6 months or a year from now. You're going to get real-time alerts on the highest probability trade setups. Again, as I said, I only trade the highest probability trade setups, so those are what you'll see. And the highest probability trades, how do we find them? Obviously, institutional involvement, market internals, and then I go through some detailed technical analysis to find the best of the best. Yeah, that's just that's my P&L the last. That's actually from the fall, so to show what we were producing basically in the room. So, and this is just a blurb I put in here. I probably should have just taken it off. This is something we had that I did from March and June just to show what my win rate was, what our win rate was in the room, and what our profits were based on $2,000 in each trade. So it's pretty good, and this is fairly consistent. This is pretty much what our win rate usually runs, between 85 and 92%. All right, and I'm going to show you, and I'm going to show some results of what we've produced in the room and on the alert service. But the reason I'm doing this, this isn't really to brag or anything, but I want the members and anybody who's thinking be a member, I want them to understand what the realistic returns are on any kind of trades that we take. I'm not going to sit here and tell you that you're going to get 2, 3, 4, 5, 600%. You hear that from enough people when you get these emails with these videos attached telling you how you can turn $500 into $500,000. No, you can't, and unless you hit the lottery. But this is typically what kind of results you're going to see. And, UPS 23%, here's AI 43%. So typically it's going to run 20, 25, 30, 35%. And we have losers. Be aware. No strategy is perfect. Nothing's 100%. We do have losers. But this was our September trades right here. And you can see the percentages. We did have one at 108%. But most of the time they run 20, 25, 30, 35, 40%. And we had 25 wins and 2 losses in September. That was a 92% win rate. And 2,000 invested in each trade created a profit of about $7,700. It was pretty good. And again, nobody necessarily uses 2,000 each trade, but I have to have some sort of a baseline to follow. And actually, I thought these results were really outstanding because September was a really difficult month to trade. Here's October. You can see the same, every month you see the same kind of percentage gains. And you're going to see a few losses sprinkled in there. 24 wins, 4 losses, 86% win rate, $2,000, 44.80. And the amount of profit that you make on the trades obviously is dependent a lot on the market. If you've got a nice trending market, you can stay in the trades longer. You can take bigger profits. You can't do that on choppy markets. You've got to take profits more quickly. Here's November, very similar here, 84% win rate, little lower win rate, but a little higher profit. And I have a few different strategies I use in here. That was a put credit spread. And we had, again, a few losses in there, but that's just 4 losses. That's all of them right there. This Roblex was basically break even, 1.2%. In December, didn't do a lot of trades in December. And again, remember, I'm only taking the very highest probability trade setups. So people ask me all the time, how many trades are we going to get a week or a month? I don't have any idea. I'm not going to just send out a trade to send out a trade. It's got to meet the criteria. It's got to be a high probability trade setup before I'll take anything. So we had just 14 wins and 2 losses in December, still 87% win rate, $3,100 profit, a couple of small losses, but basically the same here. You can see 30%, 36%, 25%. Microsoft 63, that was pretty nice. And January actually was kind of a bang up month for us. I had 20 wins in a row in January. We didn't have any losses. This is pretty rare, but it's just one of those things. But we had 20 wins in a row and no losses. 2,000 in each trade was about a little over 10,000. And you can see the percentages, however, hanging right in there around the same all the time. There was a time spread on earnings here. We made 39% on WDC. But again, 20, 25, 30, 35%. Mara was a nice 65% gain. So that's I just wanted to cover that just so you have an idea of what can expect. These are actually specific trades that we sent out on the alert, so you can see exactly what the alert service is producing. But again, some of the trades are overnight. This one was overnight. Some of them are 3 days. Some of them done during the same day. This was STX. So again, this was the one we did 108%. Get in for 370 option price, out for 770. That's a pretty big profit, and 16% here. So this just kind of shows you that the trades can be overnight or they can be same day. This one we entered at $81 cents or $81 a contract here on BNTX and out for $1.21 the next morning. That was an overnight trade. So we do have a lot of overnight trades. So if you happen to be a trader that can't trade every day, doesn't have 25,000 in their account, so they're under PDT or pattern day trader rules, you're going to get a lot of trades that are overnight trades that don't impact the number of trades that you're taking as far as day trades are concerned. All right, so I'll just zip along here because I want to get into some of the other things here. Again, this was workday. This was a fairly recent one. We get in for 1170, out for 1470 in 2 days, 26% profit, but you know, $300 a contract, pretty nice. And Meta here 24%. So you can see again, percentages are the same. They're not going to vary on the alert service because we're taking the same trades that we take in the room. We don't take every single trade on the alert service that we take in the room, by the way, because if a trade I think is going to be too quick, you know, maybe a half an hour, 45 minutes, I don't alert on that because it's really not fair to the people on the alert service. They're not going to have the proper time to respond to it. All right, so this is just kind of a recap that I did of the 2023 trading results using this $2,000 basic investment in each trade. Investing $2,000 in each trade taken in the Compass option room produced a profit of $60,000, $60,208. So if you were using an account of $50,000, when you started the year, each trade was using 4% of your account balance. And of course, the percentage used was lower as the account grew. It produced 120% return on the initial 50,000, growing to over 110,000. So at the end of the year, if you were still doing 2,000 a trade, you were only using 2% of your final account balance. So that just kind of puts in perspective what we did in 2023. And the 2022 was almost exactly the same. All right, so this is a kind of a description of what the alert service is going to look like. Every alerted trade is going to include the stock symbol, the option strike price, obviously, the option expiration date, and the price to pay for the option, which may be a range. It may say $1.05 to $1.10, but this is what you'll get. And this will come out as soon as I see the trade and I send it out. It shouldn't take too long. I have them on my phone so I can see how fast it's coming through, and it's usually about half a minute to a minute or so. I sometimes will put the exit price or the profit target price on the initial alert, but generally I actually send out a second alert with how much to sell it for. So when you get an alert that tells you to put a sell order in there, make sure you mark it as good till canceled, so that it's working when the market opens the next morning. All right, so again, how do we achieve such stunning results? I pretty much told you. We look for institutional trading, and we look for the highest probability trade setups we can find. Obviously, was trading the best and skipping the rest. And just quickly to let you know how the comp system defines institutional trades, because a lot of people ask me, how do you know when institutions are in there? What it does what's called a triple screen assessment. Triple screen assessment is really just a fancy way to say multi-time frame assessment. We're looking across multiple time frames. We look at three things. We look at momentum, trend, and money flow across 3 different time frames. If all of these are lined up in the same direction, the likelihood that the institutions are in there is extremely high, well up into the upper 90s that the institutions are in there at that point. All right, so I'm gonna kind of go into some Heiken-Ashi information here. This is a 5-minute chart on Tesla. This is a Heiken-Ashi chart. I have these candlesticks set up as Heiken-Ashi right here. All right, so this is the compass system. And this, when it's green like this, that's telling me that it's all bullish. The institutions are in here buying. So what I look for is I look for a stock that, you notice how we have a couple little red candlesticks here with wicks and tails, and then we get a flat bottom right here. You see how this is a flat bottom? Heiken-Ashi reversal candles for bullish have flat bottoms. And if you look at the candlesticks on this trade, you notice that every single one of these in this trend has flat bottoms. That's how Heiken-Ashi helps you identify trends. It's very easy to see the trend here. Now you're getting a wick and a tail. If you're in the trade, you think about taking profits right here. All right, so this is the main advantages of Heiken-Ashi candles. And I don't know if you're familiar with them or not, but it's something that you can really use to help improve your trading. Excuse me. it identifies confirmation of trend reversal. This is what I use it for the most. If I'm looking to get into a trade and it's pulling back to support, I want to be able to confirm the reversal. Heiken-Ashi candles lets me do that much more easily than regular candles. It allows trade entries on a confirmed reversal, avoiding failed breakouts. This is really important. If you've ever traded and had a stock break, looks like it broke through resistance and you jumped into it, thought it was going to take off. This is going to keep the reverse on you from occurring. You don't get in until Heiken-Ashi tells you that the reversal has occurred. So that's going to avoid failed breakouts. It smooths out the price movement to eliminate noise, like we just saw. And it allows traders to stay in a trend longer, avoiding shakeouts, and identifies waning trend momentum to exit for profits, and it makes it much easier to visualize the current trend. This is all a big advantage of using Heiken-Ashi candles. And again, I'm just saying here, if you haven't used them, you ought to try using them in your trade. I think you'll find out that it's very, very helpful. Heiken-Ashi candles, by the way, means average bar in Japanese, and it smooths out the price action, so identifying trends and reversals is clearer. It eliminates the noise, which makes it easier for us as traders to stay in a trade and not get shaken out. Again, bullish Heiken-Ashi candles have flat bottoms, and bearish Heiken-Ashi candles have flat tops. So I'm not going to go into all detail here because I want to show some actual charts of some Heiken-Ashi candles. All right, so these are Heiken-Ashi. This is just a graphic of Heiken-Ashi candles so you can kind of understand what they look like. This is obviously a bearish Heiken-Ashi candle. You see the flat top, and then we get a wick and a tail. Now you notice that each Heiken-Ashi candle starts in the middle of the previous candle. They always start in the middle of the previous candle because it's using two candles to create a Heiken-Ashi candle. But as we come down here, this, like we had a wick and a tail and a wick and a tail formed by a flat top. Okay, so that's a Heiken-Ashi bearish reversal, but it's really not reversing in the trend. This is basically a Heiken-Ashi reversal confirming the trend. So it keeps on coming down with flat tops, flat tops, flat tops. Now we're getting wicks and tails. Wicks and tails, we're getting green candles now. So if we were short this, we'd want to be out now. Now we get a Heiken-Ashi reversal to the bullish side right here. Right? You see how we've had a wick and a tail, and you see how we get a flat bottom. That is a Heiken-Ashi reversal to the bullish side. This is where you would enter the trade, and now you get flat bottom, flat bottom, flat bottom, flat bottom. This is giving you the trend. So that's how we identify Heiken-Ashi candles. And again, there's a Tesla setup showing you a Heiken-Ashi candle, and you can see that trend smoothly. And again, I traded this because the Heiken-Ashi candle occurred, and I knew that the institutions were buying. Look at all the green. I knew that. This was a Gilead. This was a trade we took. This was a Heiken-Ashi candle. This is on the daily chart, so you can use it on daily, or you can use it on 5 minute. You can use it whatever time frame you want. But this was a Heiken-Ashi reversal, wick and a tail, flat bottom. And GE, we also took this. We had this one. We took this Heiken-Ashi reversal right here, stayed in the trade, went against us for a couple of days, but the daily chart was still bullish. So we were able to stay in the trade, and then we took profits about a week later in the trade. So, but that's again what we were looking for here. And again, you can see that it was a green here, and institutions were in it. All right, so I'm going to look at some live chats. So what I'm going to do is I'm going to drop this down right here. Drop my charts off here. Okay, so I'm going to move over some. This is live charts. This is live from Friday. And what I want to show you is and this is the T2000. I'm going to use this because it's easier for me to see show the Heiken-Ashi reversals on here. So I want to show you some actual charts. This is actually as of Friday. This is Friday's close here. Now on this trade here on Mara, if I look at the regular candles, this is a Mara on regular candles. See the gap up. One thing you'll notice is that Heiken-Ashi candles don't show gaps. They'll never show gaps because they're using two candlesticks. So there's no gap here. But if you notice on this Mara trade, this right here was a Heiken-Ashi reversal. All right. So that was Thursday, right? There was a Heiken-Ashi reversal. If you look back here, you look at the one that's right here on this trade. Now, if you're looking this and you're charting this and you're looking to say, okay, this looks pretty good. There's a Heiken-Ashi reversal. I'm going to take this trade at the end of the day on Thursday, you take it on the end of the day on Thursday, this is what happened to you on Friday. You got a really nice move to the upside. It gapped up, so the gap up would have given you some pretty nice profits. And you see how this over here, we had Heiken-Ashi reversal, and you see how smooth that pattern is going up. That's what Heiken-Ashi candles will do for you. Nice smooth move, and then you start to get wicks and tails. You want to be out. Here's a bearish move in it right here, but this was a bullish stock, so you probably don't want to trade it bearishly. But there's a bearish reversal, Heiken-Ashi reversal. Wicks and a tail, flat top. All right, so that's Mara. I got a couple of them I wanted to show you. I got to keep an eye on my time here. So this was Path. Again, Heiken-Ashi reversal right here. Nice move the next day. Right there, another gap up. So I look for these at each day to see if I can find some that will qualify for that. Okay, so if we look at Lily, I like to show as an example of what a trend can do for you here. Here's a Heiken-Ashi reversal right here. This white line, by the way, is the 8 exponential moving average I use on my charts. But here's the Heiken-Ashi reversal. See the flat bottoms? All the way up, all the way up. Nice, and really, really nice trade in Lily. Look at Flex. Flex was another one. See, we had a Heiken-Ashi reversal here. Stock moved up, kind of compressed, and here's another Heiken-Ashi reversal right there. And this is on the daily chart. And here's what the daily chart looks like standard, and here's what it looks like Heiken-Ashi wise. All right, and let's do another long one here, IBM. This is a nice on IBM. Okay, this is Heiken-Ashi. This was I've got some lines drawn on here. This is a bull, what's called a bull flag. You see the big volume, see the big candle here, and we got this is what's called an algo line or a trend line, and it broke above it with a Heiken-Ashi reversal right here. Get a tail, flat bottom. So IBM is a decent setup for Monday morning as a long. Look at some shorts as well. Is RCI. This was Rogers Communications. See how nice, you see this Heiken-Ashi reversal right here. Then we got a wick and a tail and another Heiken-Ashi reversal right there. And that's the Heiken-Ashi candles. Here's the regular candles. It's below the 50-day moving average, which is this red line. So nice setup there on that RCI. So you can use it for longs and shorts, obviously. Here's EXAS. Big bull market, right? The market's really strong. Look at this stock. Does this stock look strong? I mean, it's been drawing. This is the 8 exponential. Has been trending down. But here you go, right here on this. This was a Heiken-Ashi reversal candle right there. Wick and a tail, flat top, moved down again on Friday. And here's the actual chart that shows you that. So again, that's Heiken-Ashi candles, and that's an EXAS one right there. All right, so I'll show you one more short. Is GIS, General Mills, Heiken-Ashi reversal, Friday. This becomes a good short for Monday. All right, we switch over to the candle, see what it looks like. Here's what it looks like. You can see this big drop down. You notice Barry was talking about support and resistance levels. You see that support level right there. You see how it broke through it. If it's below there on Monday morning, after doing a Heiken-Ashi reversal, it becomes a really, really good entry. I have this noted down as a potential trade for Monday morning. Now I want to show you, switch over to the 5-minute chart here for Heiken-Ashi. So I'm going to switch over to the 5-minute, and I want to show you some how you can use this intraday as well. And again, this was, we'll do this on, let's see, RCL, Royal Caribbean. And I had noted here at 11:20 in the morning. All right, so right here, here's a RCL coming down pretty weak. See it's chopping around here. You see this Heiken-Ashi reversal right there at 11:15, 11:10. It comes right down. And again, if you're just day trading this short, you could get out right here. But the fact is that this stock is really, really weak on the daily chart. Because if I switch to the daily time frame on this, this is what I'm seeing. So I could easily stay in this trade, even though it made a reverse on me on the 5-minute. But I can stay in that because I'm still looking to hold this thing overnight. But that was a Heiken-Ashi reversal on the 5-minute right here at 11:30, and again here at 1:15. But this was a nice reversal on that. And I'll also show you Pepsi. And Pepsi reversed at 1:25, right here. Right, so here's Pepsi kind of, this was off earnings, it was chopping around, but here's a Heiken-Ashi reversal right there, and keeps on coming down, compresses, another Heiken-Ashi reversal right there to the downside on 5 minutes. All right, and I think I got Amazon too, which we took Amazon in the room on Friday, but we took it as a swing trade. But I wanted to show you at 12:20 the basically the up move to the upside. You see how it comes down here and compresses on the 8, and right here you get a Heiken-Ashi reversal. Wick and a tail, flat bottom, takes right off. Continues up very nicely on Heiken-Ashi candles. So that's what Heiken-Ashi candles look for. That's how they can be used for your to improve your trading. And let me get back. I need to get back. I'm gonna probably have to go back to the beginning on this thing. So bear with me just a minute. All right. So let's get you dizzy and move you down here. But I wanted to. I think it's better to look at real charts than just phony chart. You know, they're not phony charts, but copies of charts. So this is what I'm going to show you now. Is I'm going to show you some of the trades that we've taken in the room and how well they worked out for us. This was when we just took American Express just recently, and I want you to see this Heiken-Ashi reversal on this trade. Now we actually get in here and get out here, because I was waiting for the stock to break through this resistance level right here. But even here, you could have taken the trade on a Heiken-Ashi reversal. And we took 25% and 2 days in that on AXP. This was a Heiken-Ashi reversal on AXP. This is the compass system. This again was my TC2000 chart. This is the compass system, which was showing me that on a daily chart that this is where I wanted to get in. And you notice that the compass system is telling me that this is multi-time frame momentum, current time frame momentum, long-term trend, this is money flow. All of these things are lined up green. And it also puts out a dynamic compression zone right here that it breaks out of, which is that shaded area. The compass system does a lot for me as far as giving me compression breakouts, etc. But that was AXP. So I'm going to just show you some of the trades that we've taken recently off of these charts, and then I'm going to wrap it up because I've only got about 5 minutes to go. So this was workday. This was a 5-day trade. This is a daily chart. We were in it for 5 days, took a 30% profit. Notice that it's coming here off of this dynamic compression zone and popping up off of the 8 right there and moving up. MDT, 25% profit on a swing. We took it right here as the compass system went to all bullish, went to yellow, and went from yellow to blue. This means the institutions are now in there. Took the trade, 25% on a swing trade. MDT is VKTX, very strong move here, 30% in 3 days. And then these are all trades that we took in the room and alerted out on. This was a nice one. I think I showed you this one. This was an overnight trade from 8 out in for 8:30, out for 11:30, $3 per contract gain, 37%. And again, here's where we got in right here as it broke out of the dynamic compression zone, and we grabbed that and we get out right there just overnight. Nice gain. Datadog coming down. This was bearish. You can see everything is yellow or red, so it's bearish. And the breakout was right here, both through this dynamic compression zone. We get in here, we get out for a 21% profit overnight. Amazon, a nice 32% profit in 45 minutes. You can see this nice, this is a 5-minute chart. You can see this nice move. This little green line here is what I use. It's called the 15 EMA. It's basically a short-term trend. And this is a pop out of the box symbol that the compass system produces. This shows me that the compression is being broken. So that's where we took it, and we were in it for 45 minutes and get out with 32% profit. Taking calls, of course. ENPH, another one, again, just so you can see, this is over and over again. You can see how the compass system is telling me that this is bearish, and then I'm going ahead and finding these pop out of the box symbols and take this, and we're in 20% in an hour. Verizon, this was a really extraordinary trade. Verizon is doesn't trade an awful lot. It doesn't move an awful lot. It moves pennies. But we were able to get in the money call for 45 cents right here. And as it broke down, and we were able to get out in 1 hour. And that 45 cents, which was $45 a contract, went to 67. That's a 50% gain in an hour. just reading this information. That was a really nice one. And this was SPY. Again, we use the SPY for this. We had a 50% profit in an hour. This Verizon, I'm sorry. This was the SPY right here. This is what's called the SPY super system setup for anybody who's interested in that. I call them out in the room when we see them. They're fairly rare because you need to have market movement, you need to have market internals, you need to have the stock, the institutions in there, and you also need to have the SPY coming off a support or resistance level. And this was Netflix, 20% profit here. So I'll move along. And this was Tesla. This is one we actually took this overnight based on the this breakdown right here. Pop out of the box signal, everything red or yellow. We gapped down the next day. It fell from 120 to 112, and the puts exploded. Of course, options went up about $7 a contract overnight, and we took the profits. I believe that gap ups and gap downs should be taken immediately. So there's a few more in here, but I'm not going to go through them all because I want to get through to the end of this thing. We want to get the presentation done so we can let the next speaker have the time that they're alerted to or have that they deserve. So again, there's the alert service, and this is the kind of trades we take in the room. And this is what the offer is for anybody who's interested. For the Compass Options Alert Service, 50% off for this New Year's sale, $7.98 for a whole year for the alert service, and just $2.96 for the quarter. That will come with the alerts, of course. You get all of my videos. I do have about 25 videos on the strategies we use and how to find high probability trade setups. And we also have a Discord room that you will have access to, and you get 1 month in my live trading room as well if you sign up for the alert service. And if you want to be a member of the trading room, you also get the alerts automatically if you trade in the room. 50% off. It's $8.49 for a year and $148 for a month if you want to join this for a month. And again, you get the alerts, you get the Discord room, and you get my Wise Way to Trade options. And I think I'm right up against my end of my time. Yeah. So again, if you have any questions or you'd like to get more clarification, put your name and number in the chat box or in the question box, and Rory will give you a call. There's his number right there, 786-732-4656. And I know I had to kind of rush through this a little bit. I had some more charts and things, but I did want to give you some educational background on Heiken-Ashi candles. I think that's really kind of important. So I know I have a lot of questions here, but I don't think I can really take time to answer them. One person, do I take trades at the end of the day when the Heiken-Ashi candle completed? Yeah, that basically was when I would do it. Depends on the rest of the technicals. I may wait till the next morning to make sure it opens green.
David, I want to say thank you. Great information. I know that your take on Heiken-Ashi candles actually got me to start using them.
Call it afternoon here. I know some questions, but we can come around to it later. You can always fire something off the right line, and they'll forward those questions to me. So thanks very much, everybody, for listening to my my presentation. I hope the Heiken-Ashi candlesticks presentation helped you a little bit to maybe find a way to improve your trading. So thanks very much. Appreciate it.
David, if you'd like to stay in the room and type answers to some of the questions, you're very welcome to. But the system looks incredibly powerful. Great tools. I can definitely see how it provides a clear edge in trading. Thank you for making such a generous, half off offer to our audience today. Ladies and gentlemen, if you're looking for an edge over all other retail traders and finding stock tickers being influenced by institutional money, or if you just want to have the hottest options trades sent directly to your phone or mobile phone device by the industry's hottest alert service, Mr. Wyse at Right Line Trading has a solution for you. I'll have his link in the chat box momentarily. David, thanks again for being here. Happy New Year. Happy Valentine's Day. Have a great weekend, sir. And that will bring us to our last presentation of the day. Our anchor presenter, who is born and raised in New York, where he fell in love with trading with visiting his then girlfriend and now wife Lisa at her job on the NYMEX floor in the fall of 1982. In 2008, he moved from New York to Las Vegas and established Omni Trading Academy, where he teaches select students the Omni triangulation in trading. He's filled with vast knowledge of trading, analysis, and trend formation. By simply following the trend lines and identifying formations, the chart will tell you all you need to know. As he's said many times before, the chart is just a graphical representation of the day's news. Ladies and gentlemen, here to present, according to the charts, not the word on the street, is Mr. Oscar Carboni of Omni Trading Academy. Welcome back to Traders Corner, Oscar, and I love your outfit today.
Well, thank you. This is my usual garb. This is me.
gotta have the colors on while you're doing the thing.
So, Rob, I'm looking at the old presentation still and my camera above it. Should I be seeing that?
Let's see if that makes it your presentation.
I think that will work.
Sorry about that.
No worries. Are you now seeing my screen?
Yes, and I see it looks like the ES daily and a nice severe uptrend. Woo!
Rock and roll. Well then, I thank you very much for inviting me. For traders around the world that have been sitting here for all these hours, why are you not at a Super Bowl pre-party right now? Why are you here? I don't get it. But being that you are here, I promise I'm going to give you some really interesting tips and tricks that you can use moving forward. I will illustrate, if I can, in the next 45 minutes, the power of technical analysis and how Wall Street loves to use market geometry. I mean, it's right there before our eyes. I started on Wall Street as an 18-year-old kid. I helped the exchanges put charting, which was point and figure, held by hand. I helped them get them on computers and worked with the exchanges until we were able to get trading onto the internet, and they sent us home and closed the exchanges. I was there for the whole gamut. I am Wall Street, and I've learned some fantastic tricks, tips, and techniques that basically Wall Street wouldn't want you to know about. They're simple, and they will help you make money moving forward. So I promise, as a consolation for you sitting here all these hours, I will not offer anything to sell you at all. In fact, I wouldn't dare sell my Omni. I've got something called Oscar's Market Navigational Indicator. It has been working since the, mid-'80s when I developed it. I wouldn't dream of boxing it up or putting it on disk or putting it on Zoom. If you build a program that works, you don't mass produce it. So I will show you some great stuff here. What I will promise you is that this is my technical analysis 101. I am laying on a cot pre-kindergarten, drinking warm milk and eating cookies with what I'm going to show you. But I promise with that alone, it will be effective, and there will be tricks that you can absolutely use moving forward. So you probably want to grab a pen and a paper and write down some of what you may see. It will be effective, but I promise to keep this simple. So what is technical analysis? Technical analysis is the cornerstone to knowing where any market is going to go. There are algorithms out there. There's everything you can think of from Wall Street, but that's nothing more than following price action, which you can do with a good pair of eyes. So let me show you what I mean by that. Each year, now I've been doing this for a lot longer, but for 16 straight years, I've been putting out what I call the Omni's year-end call in January. Come up with the year-end call. In fact, January 24th year-end call is right here, but I'm not showing it to you. And I tell people in January where the market will go by December. Now, I have done this for 16 years. There's 2 years out of 16, the Omni has not nailed it perfectly just using the technical analysis. 1 year, the market went up, came down, and settled at the same spot it opened for the year. Nobody could make that call, right? It was a nothing year. The only other year Omni didn't nail it perfectly, it got within 300 points of it, and then the year ended. So I am going to show you something, the power of technical analysis, and the fact that you don't need a trading system, you don't need a program, you don't need anything but a good pair of eyes, and understand a few of the tricks that Wall Street is using to come up with trades. So a chart is a visual look at all government reports, any report, fourth quarter, first quarter, third quarter, anything that's going to be reported from companies, traders' reaction to such, it's all built into a chart, and the chart is pure and honest. The chart can do something that a human can't. The chart can take a fire hose of information like we get coming at us right now at every moment, fire hose of information blasted at you. You're supposed to take it all in, disseminate it, and say, that means the market's going to 50.22, which is impossible, right? It's not possible for a human to do. But the chart takes in all that information and shows you what's coming next. It doesn't have alimony, child support. It doesn't have a reputation. It doesn't have bills. It's pure. Let me show you what that means. The beginning of 2023. Does anybody remember what the world looked like in the beginning of 2023? Well, I should say the end of 23, beginning of 2024. The beginning, so let me change this because we're going to go backwards for a moment and then we'll go forward. This is the beginning of 2023. Now, in 2023, if anyone recalls what was going on, we had rising interest rates like crazy, runaway inflation, everyone was losing their minds, and most fund managers took their money, took it out of the stock market and slammed it into bonds at 5 to 5.5%. And that's what was going on in the beginning of the year 2023. It was a total panic out there. And I come up with my year-end call expecting it to be the downside, and here's what happens. The market's trading at 3,800 and the call tells me we're going over 5,000. Now I'm going to sound crazy if I say that to people. We're in the middle of a crash, but that's the Omni call. So I put the call out and I started to receive phone calls from fund manager friends of mine and others who said, Oscar, you're going to be absolutely wrong this year. You're going to embarrass yourself. We're billionaire fund managers. We've got the information that you don't. You're going to be wrong this year. And I said to them, the only information you could possibly have comes off the chart. Everything else is in your head that you've concocted. I will prove to you I'm going to be right. And I put out the target when we were 3,800 that the S&P would go over 5,000 for the year. Well, guess what, kids? Look where we are. The S&P made it to 5,030, 29 days past December. Kill me, I know I'm the worst at this, right? 29 days late. No one can do this because they use fundamentals. Technicals will tell you where the market's going to go every year. Honest to God, everyone watched me tell them where the market was going to go in 2023 to 24, and they laughed at me. Well, who's laughing now? Kiss my Omni, people. Let me show you what this is all about. So the E-mini S&P did exactly what the Omni said it would do, and I've got no magic. I do. You know what? I do actually have a crystal ball. But, you know, I don't use it when it comes to trading. I just kind of leave it on the side here. So before we get started, I'll remind you, this is a very risky game. Risky, risky, risky. I don't care if you trade options, futures, crypto. I don't care what it is you trade. You need to put protective stops in first before you ever get into a position. The traders in 43 years I've been watching that do not use stops, that use a mental stop and they'll get out and they get in trouble. Here's what I tell them. This is for you. This is a tombstone for your trading account. Just put the number of your trading account right here, and this will help you because that's where you'll end up. Put your stops in first. Let's get moving. So what's going on out there? Okay, so you see analysis can call these tremendous year-end calls, right? But we want to know what's going to happen tomorrow. And what I do for these webinars, I don't have a PowerPoint. I don't have anything predetermined. I wait for Friday's close. I go through a whole bunch of charts and figure out what it is I would use next week, and then I present it to you. And that's what I'm going to do right now. So we saw the S&P year-end call was magical, like it has been for 16 straight years, based on technical analysis only. So what else is out there? Well, let's take a little ride. If you'll humor me and watch what's going to happen, I promise I'll show you some cool stuff. Here's the dollar index. Wall Street, you have to know what they're using. And once you see what they're using, you run with the ball. I do not care why they use it, and I do not care how to reinvent it. So in other words, they're using 103 bar moving average on the dollar index. Why? I don't care why. That's their use. I'm going for it. I'm not going to try to reinvent the wheel. The idea is to find out what wheel Wall Street's using, slam it on your car, and go. So watch this. First of all, if you're looking at the US dollar, and I just showed you the stock market going up, you might think something like this. If the dollar is going up, why would the stock market go up? Because we've had a nice fat rally in the dollar from 100 to 108, well, 103, I should say. Big rally, right? So why would the stocks go up if dollars are going up? Well, first quick lesson, simple, is A, use the 103 bar moving average to time your dollars. When you are above it, the dollar rallies right here. When you are below it, it drops. I mean, it's simple. Easy for you to use. It's called the 103 simple moving average. Write that down. What would you use it for? We don't trade dollars. We trade euro, right? Lots of people, lots of futures traders trade the euro. If you see the dollar get above that line, the euro will go under it. If you see the dollar get below the line, the euro will go up. You can use this to time your euro. Don't let the rising dollars scare you. You know why? Because while dollars are rising and the stock market's rising, traders all over the world, if they're not in the US, have to purchase US dollars to buy US stocks. It makes sense that the dollars rally with the stock market. So don't let that scare you. Use the 103 bar moving average. That's what Wall Street is using right now to time dollar movement. What else is out there? Let's go to another chart. I think right here I left the chart up for you, and that would be crude oil. Watch this one. Now this, I've shown many of you these tricks over the last few weeks so that you can use them. You want to see a really simple trick technique Wall Street uses on crude oil and crude oil pricing? It's the 200 bar moving average. It's the simplest thing to use. Look at the action around the 200. If you get above it, Wall Street plows in. If you get below it, they sell. You can't get above it, they sell. You can't get above it, they sell. You get above it, it gets a little frenzied, but it gets below. We just had a signal on Thursday. Got above Friday, it went higher. Simple stuff that you can use next week. Wait till you see the market daily bar drop. So when near the 200 bar moving average on crude, then sit and wait for your signal. Let the market tell you where it's going. Never try to tell the market where it's going. It will always tell you. So that's a simple technique. What else did I find? Oh, crypto traders, you might like this one. Let's see if I can show you something cool. Bitcoin, check this out. Now, Bitcoin's got a very simple to use moving average that Wall Street has adopted. They seem to love it. It's called the 21 bar moving average. Why they like it, I don't know, but I spent all last week telling my traders, get ready for the signal, it's coming, get ready, it's coming. Put out a YouTube video on Tuesday night to say the signal is in. Look at Wednesday, Thursday, and Friday. The signal worked. Wall Street has adopted or adapted the 21 bar moving average to Bitcoin, and if that's going to work, that's what you use. When it comes back to it, gauge what's going to happen next. If it gets under, down you go. If it gets back to it and holds, it settles above the rally. Simple. But I've also mentioned that it's all about market geometry. So these I call them algorithms. You could call them averages, but they're algorithms. Believe me, that's what they are on Wall Street. This 21 bar simple algorithm is one use. But when I tell you that it's all about market geometry, what Wall Street does is they're watching every low, every high, everything in between, and they're using it to calculate, and that's how they create what they want to call algorithms. But it's all based on market geometry. Watch. I'm going to show you something simple. You can use stuff like this every day. I have a trend line that goes from one high to the next. That's how simple 101 analysis. If you're going to draw a trend line, you draw it from the high of one bar to the high of another. So I've got a trend line right here. I'm going to darken it in so that you can see it. Make sure it's nice and thick. Change the style a little bit so it's one line, and apply. So now you see that trend line, it only goes from one high to the next, right? Here's the simplicity behind Wall Street. I kid you not, this stuff is simple. You just got to know how to look for it. Watch this. I am simply going to extend and look what happens here. How does Wall Street know? How do they know? Because it's all in the geometry. Look at how it got a little bit crazy right here. It hit, went through it a little, and it used it again here, it used it here. All I did was go from one spot to another, move it forward. Wall Street has this all programmed in. They're waiting for the market to get back to that geometry spot or that angle. And when it gets there, they are going to react. I could show you this 1,000 times, you'll see. So the tip on this one, use the 21 bar simple moving average or algorithm for Bitcoin, and realize that Wall Street is watching the geometry. I promise you that is what they do. And it's not difficult. You can see that with your eyes, right? No calculator. You didn't even need a calculator to figure out where to buy Bitcoin next. You just needed to have your trend line out there. You'd know that support was going to show up because trend lines tend to work over and over again. What else is out there? Let's see if I could show you something else. Oh yeah, there's another chart I ran into. Now I did all of this on Friday night. What I did was Friday night, looked at a bunch of charts, found cool stuff. Saturday morning today, spent a few hours going over these charts to show them to you. Went inside, played my drums for 2 hours, and thought I'd come out and present to you. So I'm all psyched and ready to go. Now check out this next chart. So we are at the NASDAQ. Now we're going to look at the NASDAQ. And there's an adaptation. Wall Street on this is an interesting thing. They are changing the average, if you ask me, that they're using. And I want to show you what's happened. So let me pull this chart to focus and show you exactly what that is. All right, so let's go like this and just make the chart full, and then we'll come out and show everything to you. All right, so again, because I have no PowerPoint, this is me doing live analysis before your eyes. So deal with it, okay, kids? I'm going to move stuff around. So check this out. The 22-bar moving average has been used by Wall Street to climb NASDAQ for months on end. I mean, they're all over it. If it hits it, they buy. If it gets under, they sell. They have been all over this average. It is simple. You can see it. It's right before your eyes. But things have shifted. So I wanted to tell you that they have shifted. In fact, I showed you this in my last live webinar. But Wall Street has adapted something else. Check this out. They decided to go with the new average, and I want to show it to you so that you can use this yourself. Boom. They are now going with something smaller. And let's check what it is. They are now going with the 12-bar moving average. They switched from the 22 to the 12. I'll show you. We'll remove the 22 for a moment. Let's just, you know, we can make it invisible so it doesn't go away. So we'll make it invisible so I have it here later. And watch, they have now adapted a new one. They're now keying off of this average right here. Simple 12-bar moving average. So we leave the 22 and we go to 12. Wall Street changes all the time. You just have to know what they're changing to. So use your 12-bar moving average to climb NASDAQ. That comes back down to that line. By the way, the signal was there on Wednesday. If you look, we came right to this spot on Wednesday. And why that's happening, I don't know. Let's do that again. We came right to this spot on Wednesday, and that was it. The low was in. Came right to the average here. The low was in. Broke the average. The market dropped. So they've switched to the 12. Write that down. No more 22. Use the 12 to climb the NASDAQ. Simple, right? Is there anything else on this chart? Let me see. Oh, yes. Actually, I can see it with my own eyes. Want to see geometry? Look, I can see this line happening. I don't even need to put it in. But I'll put it in for you. Watch this. What do you think will happen when I extend this line? Watch, I am going from one high to the next. What do you think will happen when I extend that line? And if I get that line drawn in perfectly, you will see it went right to the high here. Isn't that amazing? How does Wall Street know? Because they're following the geometry. It's simple, I promise. I am from Wall Street. They don't want me to show this to you. That's one thing I can tell you for sure. All right, but I'm in the trenches with the boys, so to speak, right? I'm in there, I got my machine gun, I'm shooting with you guys, doing my day trading. I don't care about Wall Street. I care about making my Omni hacks, make money every day. So these are techniques I look at. I hope some of these will help you. What else is on here? Oh, okay. So stock market is going up. And there's a lot of talk about how can it go up? There's inflation, inflation, inflation. Well, you know what, kids? There is not inflation right now. This is a measure of commodity inflation. Might as well call it deflation at this point. When COVID hit and supply chains were wiped out and you couldn't get anything anywhere, this was the measure of inflation. We are now down here. Let's see if I can grab that and just pull it. We are now down here in the 96.50 area. Up here, we were, what's the height? 140.55. Now, you might not see it in the supermarket. The supermarket does not indicate it, but the measure of inflation is proving to you that, yes, they raised prices since COVID started. They haven't lowered them, but the supply chains have given them the supplies much cheaper. This actually tells you there'll be a price war on products coming to supermarkets soon enough. You can't just keep overcharging when supplies have gotten so much cheaper. But the bigger thing about this is to show you that it's not really possible for the market to go down if all the products that are being used, or all the raw materials that are being used to make products, are getting cheaper. The companies are paying less for their raw materials, but they haven't dropped their prices yet. They will. Now, imagine the stock market, how much money it's making now, because you've got companies that raised prices during COVID and haven't lowered them yet. But their supply chain's gotten better, and so has the price of their supplies. But we're still paying top dollar. You better believe the stock market's going up. It all makes sense, right? So don't worry about inflation. Is absolutely out of the picture now. They just have to go on a price war in stores, and it will happen. At some point, someone will say, we are getting supplies cheaper. Let's lower our prices so that the A&P lowers theirs, and it will just turn into a price war. We'll get there. For now, we're just looking at charts. What's next on this? What else did I find? Oh, yes, check this guy out. Apple. Apple's signal is in right now. It's giving a signal, so this is perfect. Some of them gave a signal on Tuesday, Wednesday, Thursday. This one is offering a signal for next week. Now, Apple, for whatever reason, keeping it simple, Wall Street just loves this 21-bar moving average. They are in love with it. How do we know? Well, just look at the action here. I mean, oh my God, they are just all over it. If it gets near this 22-bar, Wall Street steps right in to do something about it. All right, so easy tip for you. We are right at the 22-bar moving average of 21. I'm sorry, I said 22. 21-bar moving average right now. If you can settle above that on Monday, basically your signal's in. If you settle below it for 2 days, you will drop lower. So if you are about to trade Apple next week, this should help you. 22-bar, 21-bar moving average, simple moving average or algorithm that Wall Street is using right now. Let's see if there's something else. Oh yeah, wait till you see this one. There's another one. Any PanW fans out there? So Palo Alto, probably the best use I've ever seen of a simple moving average, a very short one on Wall Street. Look at how far back we can go. Look at how well this average works. It just works forever. I mean, it started really working well at the first blue arrow, so of course I'm going to point it out from there forward. But look at the action. Have you ever seen anything so simple? How do you not know what to do when you get to that average? And guess what, kids? On Tuesday night to Wednesday, we got the signal. If you were with me this week, you would have seen that signal. Simple, easy to use. Why? Because Wall Street's going to crowd into that spot. That's where you want to go. You don't want to outsmart Wall Street. And you know what else you don't want to do? You don't want to bring a complicated system into an already complicated business called trading. You bring a complicated system into a complicated business, you're creating more complication. I have learned from all the pros, and I have been with all the pros that you can imagine. They have taught me that simple is the way to future price action. And believe me, it is. I'm proving that to you right now. So if you are trading Palo Alto, PanW, just grab the 9-bar moving average, slap it on your daily chart, and when you get to it, you've got a signal. Take that to the bank. It's been working for several years. Beautiful trade, beautiful usage of that. Go Wall Street. Now, again, I only want to know what Wall Street's using and then use it too. I do not want to create something, a box that's me in a corner trying to figure out what's going on and no one else is using it. You know why analysis works? It's called a self-fulfilling prophecy. If you've got enough analysts using proper analysis in the same direction, we're all going to come up with relatively the same work. We're going to hand that work out to all the traders listening to us, and they will react to it. So you've got to be using the most common stuff that Wall Street uses to not get yourself knocked out of the game. What else is out there? Let's see. I got to flip pages. I got so much stuff for you guys. Next page. Oh, we're going to start to go out to weeklies now. Let's go look at a weekly chart. NASDAQ on a weekly. So you are looking at a market that couldn't possibly be bearish, right? You see anything in this market that looks bearish, broke out of a big bull flag, taking off, got above what was previous highs, right? All-time highs, you're above that. Nothing in this chart is bearish at all whatsoever, right? So the NASDAQ chart can tell you a lot of great things. In fact, I used a NASDAQ chart for the last 2 years in many webinars, many seminars, and in my live trading room to show people where this market would go. In fact, let me show you that. I think that is on, let's see where I'm at. QST20, check this out. This is a weekly NASDAQ chart. We have called this chart masterpiece because it has made more great calls than any other chart I've ever used. And let me show you what that means. If you like what you're seeing, kids, you need to come subscribe to my trading room. I think you're going to like what you see. I'll show you some stuff at the end where you can find me. No credit cards will be required. Just jump in the trading room and hang it. But here's what I want to show you. This is a weekly chart of the NASDAQ, which means every one of these bars is a full week's worth of trading. The market was, well, every time the market's going to crash, you'll find me doing something like this, like I did in 2008, 2009, you'll name it. We're going to go all the way back to 2008. In 2008 was about the only time the weekly NASDAQ was able to get under the 200 bar moving average. That is it. It does not get under. It does not get under. That's that. That's the rule. I don't know why. It just doesn't. Breaks for 2008. The crash comes back out to 2009. What happens after we hit the average? It has an extended rally, runs up again, hits the average, extended rally, comes back down near the average, doesn't even get to it yet. And look at the extended rally that takes place next. Insanity, right? Watch, this will just continue on. Gets near it again, extended rally. Gets near it again, extended rally. Finally gets back to it. You know when? COVID. Right here. And guess what I did during COVID? Ask anybody who follows me. Told them the bottom was in. Now we can get long. Ask anybody. It's in videos. I've got 2,405 videos out there. They're all labeled. You will find me calling this absolute as it happened. The bottom is in. Look what happens from there. Up, 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 up. What do? Check this out. Comes back down to the average. Gets through it a few times, and then boom, we hit 2023, and it just goes into my year-end call, just like it was supposed to. Now, speaking of future, if you take a look at this rally after hitting the 200 bar moving average, you rallied for a year and a half. This rally has only gone for a short amount of time so far. It's got a long way to go if it's going to do what this one did after hitting the 200. And it's on its way. You can see the two lines around it. It is on its way. It's baby food of a rally compared to the one on the left. So it will go. Now, nothing goes straight up. You're going to get your pullbacks, but this is destined to go much higher. So that's another chart I wanted to show you, the 200 bar moving average on the weekly NASDAQ. There is nothing better in technical analysis than that since 2009. Is there anything else? Oh, yeah, there's some other good stuff. I'm looking at my list. Let's go here. And well, let's go here, different program. Let's look at this chart. Back to a weekly. Now, Wall Street has its way of jumping from average to average. One of the things I want to make sure you guys are well aware of. So Wall Street will jump from average to average. They jump all around the place. We used to use the 200 bar moving average because that's what was working. Then they morphed to the 170. That was working perfectly. Well, rallied even more, and they went to the 50 bar moving average. If I remove some of these, you'll see how well they work. The 50 bar moving average became the darling. Well, I'm here to tell you they've gotten a lot shorter term than that. Now they're using the 8 bar moving average to time the Dow on a weekly. It's there, it's working. Go with that signal. So we went from the 200 to the 170. Currently now, neither of those are working. And the one that is the 8 bar. And that's the one that you will be using. Well, we're not done with these weekly charts because there's more great stuff to show you on the weeklies. Let's see what else was there. A8. I think I have a chart called A8. I do. Check this one out. Oh, this is a very interesting chart. Okay. This, for some reason, the transportation average is in love with building flags. Flag, 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 flag. They work really well, but flags also work in conjunction with other things, right? So I don't know how many people like using flags or even know how. You can spot one right here. I mean, there's a bear flag sitting right there. Many people won't know how to find that, but that is what it is. You ask for a parallel trend line, and boom, you've got a flag right there. You see it, right? And the market did what it was supposed to do after creating a bear flag. It dropped. All right, so this loves to create flags, but it also likes geometry, and it likes averages, and I'm going to show you what those are. So check this out. Let's go with the flags, right? You can see when you get to the bottom of the flag and it breaks, they get short, gets to the top of a bull flag and it gets out, they get long. So they are using these flags for signals, but not just them. Watch this. Remember market geometry? Well, I only have a trend line from this low to that low. I don't know what's going to happen in the future, but I do know that if I extend my trend line, it's going to tell me where the bottom comes in. Not only did that work, check this out. This is how analysis comes together. I am now going to show you that there was also a fantastic moving average coming in at the same spot. Let me make that thicker for you. So check this out. You tell me Wall Street's not paying attention. You had the 55 bar moving average come right in with a trend line and the bottom of a bull flag. Very simple, very easy to spot. Wall Street is all over it. But let's get rid of the voodoo-ness of the flags, right? Let's just get rid of those. So if I could delete trend line, cut, let's get rid of the voodoo there. Who needs that? Let's just cut that out of the way. Let's say flags don't even exist. I'm with you on that. They don't exist. Well, then all you would have had to do was have the proper trend line and the proper average, and you would have known that you were buying it there anyway. Analysis works together in conjunction with one another. The flags work with the averages, the trend lines or the geometry works with everything else. That's how Wall Street does it. I know that they're using algorithms. They calculate all of this, so it's all tabulated, right? But it's the same thing, I promise. This is what they come up with. I could see it visually. You could see it visually. Very simple. Now look at how well this average worked. Look, bingo, bingo. You knew they were going to buy it when it got there. You just have to know what to look for. It worked here. It worked here on the flag. It worked every time Wall Street went here. Or I should say Wall Street reacted every time the market went here. So these are very simple timing techniques that you can use, but the market, the geometry is the power of technical analysis. They are looking at geometry. I'll prove it to you. You'll see. You'll be convinced before we're done. Let's go to another chart. Let's see if I can find something else out there that will prove to you that geometry is the main ticket. So we are looking at, oh, watch this. Oh my God, this one's gonna kill you. This is my favorite chart that I found this morning, actually. I found this. Do you want to see how well geometry works? Remember, this is my technical analysis 101. This is my kindergarten stuff. I would never show you the Omni here. I would never show that to you. The Omni shows us how to get exactly in and out of the markets for day trading. That I teach to 4 to 6 people only 4 times a year here in my home office called Omni Camp. I open up the doors for Omni Camp. I would never teach a room full of people, but I'll teach 3 to 6 of you 4 times a year. And it's much more complicated but simple than this. But let me just show you the power of technical analysis. You're looking at NIO. NIO is a competitor to Tesla. It's doing really, really well in China selling vehicles. And even in China, I promise you that this chart will show you it is a true testament to the power of the geometry and technical analysis. Let's start with a simple trend line, this one. I've gone from this high to that high. I will extend. How on earth did they know to sell it right there? I mean, how is that even possible? How do they know? Wait, now I've got, well, let's unextend that for a moment. I've got another trend line. It goes from here to here. I'm going to extend that. It goes right to the high. How on earth would they know that? Simple. They're using geometry. Simple. Look, watch this one. Now, they had 2 trend lines coming in together. You better believe they were selling that spot. Very easy to find. You don't need a computer. Maybe a computer. You don't need a calculator for this. In fact, you could do this on paper. You could literally write these charts up on paper if you had to. So if we lost the internet, I could still do this on paper. Simple. Check this one out. I'm gonna, boom, it goes right to the low here. How do they know this stuff? Watch this. It goes right to the next low. This is months away, months away. This is October. It hit it in February. Watch this one. It went right to the low. From this low to that low, it went to, let me unextend, it went to this low. How did they know, kids? Because I promise you it's all about geometry. I think I just showed that to you here. Do you not believe that they're using simple geometry? And when the trend lines come together, it's bingo. I mean, that's their spot. You know they're going in when the trend lines come together. Like here, they'll probably take it up to the blue line. And if not, you'll have support down here when you get to the red or the orange line. That is what they're using. Very simple, but that is is what's going on Wall Street. Remember, I am from Wall Street. I know it's not supposed to look this simple, but I promise you it is. What's next? Oh my God, I have another one that's just going to make you go crazy. Look at this. Oh yeah, I remember this. All right, geometry. I just taught you a bunch about geometry, right? I showed you how it really does work. If you draw from one high to the next high and extend out, you will get where the market is going to next, most often. So with that in mind, where is Chipotle going? CMG. It's a $2,600 stock at the moment. Well, let me show you what's now. Watch this. I'm just going to extend and look. And what this tells us is that it is going over 3,000. That's what this tells us. It will go over 3,000. Simple, easy. You could do this, right? I hope these techniques will help you next week. Now, I've shown you the geometry in stocks, in some futures, or I should say some index markets, but it will work in anything. What else do we have? Look, I'll show you another. It'll work in anything. If we go here, okay, so let's go to this page 7. And market geometry works in all sectors. Wall Street is watching people. I promise this is what they're watching. How do we know? I am going from this low down here to this low right here. I extend, and how is it that they know that once you're under that trend line, the down starts? See, it's an uptrend, an uptrend, an uptrend, an uptrend. Then the down starts right under that trend line. Okay, I go from this low to this low. That's it, these two lows. None of this has happened yet. We're going to hold, and then I extend out. Guess what happens when the market drops? How do they know? Is that not incredible? So I wanted to make sure that I did a quick presentation to show you the simplicity that you can use out there. But I promise you, I am so good at technical analysis. You have never seen anyone that can work charts. I can show you things on charts that would make your hair stand, simple as can be. Now, if you want to hang out with me, here's what it would take. You come to a spot called livewithoscar.com. And if you do not have a membership, just click register. All right, so let's just start this fresh. You go to livewithoscar.com without the register link. Let's just get rid of the link for a moment. You either log in or you register. It will ask you for nothing. It'll send you an email, no credit cards or anything. It'll send you an email. I promise it's going to spam. Go to your email, get that number, come to Live with Oscar, and then join me in my free live trading room. This will be lined up with tons of people on Monday, as they always are. I'm waving to you in this trading room right now. It's live. You can come here and converse with me about any of this. Again, I haven't shown you my Omni, and I don't plan on showing you the Omni. You have to come to my, you have to come to my home office, sit with me for 5 days in person. That's another story. I am offering you simple techniques. Now, if you'd like to set up an appointment with me, go to omnibootcamp.com and fill out an application, which will allow you to check a time and have a phone conversation with me. So that's what Omni Bootcamp will do. No credit cards required. Live with Oscar will get you to see me in my live trading room. And that's it, kids. I got nothing to sell you. I don't want to sell you anything. I just want to help educate you and make sure that you can make proper trades like a Wall Street pro. I hope that helps. That's my presentation to you. I'm not answering any questions. I gave you enough goods. Take that, use it, and come join me in my live trading room if you want more. Thank you very much. With that, I concede my time back to you.
Oscar, you are the man. Thank you. That was great information. Ladies and gentlemen, you heard it here on Traders Corner. According to the charts, not the word on the street. That was Mr. Oscar Carboni. You can find him daily in his chat room or nightly in his YouTube videos, which are extremely fun to watch, or his live streaming on his YouTube channel. If you can't tell, he's as entertaining as Bubba, and you can keep up with him on Twitter, StockTwits, LinkedIn, Instagram, Facebook, Discord.
You may not want to watch these videos, people. They look like this. It might scare you away.
Who let the Oscar in?
But they're full of great information, I promise.
Oscar, I gotta say, I love your videos. I love you. You're a huge fan. I know we talk a little offline. You know, great information. Our sense of humor is just mesh. I don't know how you do it, but your analysis is spot on. And I remember you showing the pullback to the moving average. It was around your first appearance on our show, and man, did you nail the bottom. And I hope a lot of people made a lot of money on that way back up.
So the analysis nails it. I'm just the messenger boy of what the charts are telling us.
Well, Oscar, thank you for being here. I know you've been on since New Year, but I wished others a happy New Year, and there's been a couple New Year specials, so happy New Year, happy Valentine's Day. I hope you enjoy the rest of your weekend. And do you have a pick in the big game?
So, I think Mahomes is one of those guys, if you want him to lose, you're going to have to break him apart and drag him out in an ambulance. Otherwise, he's winning that Super Bowl. No one's going to stop him. I'm not that I'm a fan of either team. That's just the way I see it.
I'm not a fan of either team either, but the Niners have a real complete and perfect team, and I don't want to go against Mahomes and Kelsey either.
Fantastic. On the field and off the field, they are fantastic. They take care of the families of the players. They are a well-oiled machine who will probably lose to Mahomes. And again, I'm not a fan of the Chiefs, but this kid Mahomes is better than anyone I've ever seen in the last 20 years. He's amazing.
I think I'm going to root for them too, because Kelsey and I seem to have the same animated, laugh, have a good time personality.
Well, then there's going to be Swifties all over your channel on Monday.
Hey, whatever happens, happens. But ladies and gentlemen, I'm going to say that concludes today's presentation on Traders Corner. We'll be posting a recording to our YouTube channel, and I will put the link in the chat box momentarily. Oscar, thank you for being here. I wish I didn't start a new job, or I'd be in your trade room chatting it up with you.
Anytime you want, I'm here, my friend. I appreciate
Any day that I can manage, I think you're going to find me somewhere in the people typing to you.
Come on, hang out with us. We're here for you.
Thanks so much. Have a great weekend, bud.
Thank you as well.
Be well.